and profit. So if I'm dropping hints there, so if there's movements, if there's retraction, there's movement. If there's progress, there's movement. So either way, someone wins.
Hmm. And so, how does one? What can one do? Is there any mental techniques or practices that one can do to get over these fears? To because I imagine it could be so embedded in us for many years. Any tricks that we can do to bring
Yes.
this to light?
Once again, love your question. This is absolutely a tool that we developed, a methodology. So because we're so saturated with negative thoughts, if we turn on the news, if we go out, sometimes we just hear these things. Even turning on music that's supposed to be good entertainment has a lot of negativity. Well, we have to not only desaturate that, but we have to saturate our mind with the opposite. So how do we do that? How do we saturate our mind with positive, not only happy chemicals, but truly positive news? Well, we can actually begin to design that. So that's where my design formula began to come into play. You can begin, and I can share this here. If you sit down one day and you're like, okay, what are 100 things I want and 100 experiences I want? And I want the things that I want to be material things because I can measure it, right? And the experiences to be tangible as well. So 200 total items, 100 things I want, 100 experiences I want. Most people are going to get to 10, 20, maybe 40, and they're stuck. They're like, I don't know what else I want, right?
Mm-hmm.
But if we keep pushing beyond that boundary, what happens is we will then come up with more and more and more, and it will saturate our neurology of things that we desire and things that we want. And that makes the temperature gauge from focusing on negative to now it's all about the positive.
So, sounds like then our upbringing and our programming in this culture and our family has, in a way, limited our imagination to for new desires and experiences that we're not consciously aware of.
Pushing the cart, and her daughter sitting in the cart, maybe 3 or 4 years old. And she said, don't lean over. I'm telling you, don't lean over. Now, in my mind, I'm like, she's technically telling me, don't think of a pink elephant, right? Of course, you have to think about it. And the more you think about it, for a 3 or 4 year old, they'll act on it. So don't lean over. Don't lean over. Well, she finally fell over and she's like crying. And the mom's like, I told you not to lean over. See what happened? This is what happens every single time. It always happens. She's literally
Does not differentiate a don't, that the mind does not recognize that negative term.
Yeah, the unconscious mind has a hard time processing negations.
And you got into all of this, and then now that you've been into this for quite some time, talking to your wife, your friends and family, to always use positive wording rather than negative.
Yeah, I became aware that no matter what I say, whether I say don't or simply doesn't, just imagine that it's just there as a decoration. So for example, if I were to want to close a deal, and I'm like, hey, I don't want you to buy today, except there'll be no resistance. To something like, hey, imagine going on a vacation with us during Christmas time. But if you were, and you'd be open to it, where would you like to go? That's a great way to persuade a family member while reducing their resistance to gratification to
Mm-hmm.
everything else in between.
What would you suggest or say are struggling and how they can upgrade their minds?
Ooh, one of the first things I would do is begin to examine what they think about all day. Now, that may seem like a difficult thing to do, but there's a simple exercise. It starts with what I just mentioned. Can they sit down and in one go, maybe two go, or over the course of 2 or 3 days, write down 100 things they desire and 100 experiences they want. When they begin there, what they'll find is underperforming, and they're not getting what they want. They're most likely not focusing on the outcome that they want. And I think this would be a good explanation. Think of our physical world. Well, what's the easiest way to change what's being projected on the screen? It's not to go mess with the projector screen. It's to change the content inside the mind. So if they're underperforming, their mind is underperforming. They're focusing on what they don't want. That is one sure way to de-incentivize the mind to perform. So we tweak that and change it to what would incentivize the mind to perform. So a fast question that I would ask is, do they have a reward? Set up a reward system for when they do win, or when they do earn extra income, or when they increase their performance. Are they going to take themselves to dinner? Are they going to go on a vacation? Are they going to do X, Y, and Z for themselves? Because as we learn to reward ourselves, think of our unconscious mind like a little kid, 5 years old, who's like, I just want to have some snacks or some candy or cake. But you're like, well, you're just going to keep working. Over time, it's going to lose interest. But if you're like, hey, let me entice you, there's a vacation. If you do exactly this number. And I did that same thing when I found the one romantically. I was like, if I do this, this will happen. These are the rewards. And I was like, whoa, this actually happened. And I gave myself the reward. Now my mind trusts me even more. Do it again, reward myself, do it again.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
So are you talking about short-term rewards on a path toward a long-term goal?
Yes. And a long-term reward. In fact, how much pleasure can you endure?
But isn't the goal, the long-term goal in itself enough to reach towards? Isn't that path rewarding enough? Why do you think we as humans should be periodically rewarded along the way to our long-term goal?
I love that. So enough is the key word, because in our mind, we may set this conscious meter of what is enough, but our unconscious mind will only respond to what's actually enough for it. So sometimes we have a mismatch of consciously, I think this is enough. This should be justified, but our unconscious mind is like, no, I need more reward. So what I'm interested in is always the outcome. Can I get the unconscious mind to be incentivized? Even if I have to reward it more, I'll do it. I just want to get my unconscious mind to be incentivized.
I see. So is this part of a process of kind of feeling your way through a testing, seeing what kind of results that take a period of time, so that the person over time can realize, oh, okay, this level of reward is just the sweet spot?
Yeah, exactly. It's like a light bulb, right? If you give it just enough electricity, it might shine, but it might not be super bright. But if you're like, hey, here's more electricity, more power, it might be super bright. And then how you direct that energy also matters.
Can you share with us a little bit about kind of your typical daily habits, news consumption process, things that you did typically day to day or week to week before you came across this? And what are your habits and processes now, typically day to day, week to week, now that you've implemented or are implementing these?
Gladly. So prior to it, this is roughly 8-9 years ago, social media was not the way it is now, but I still spent a lot of time on social media, and I was reading everything that there was as a distraction from the pains of my life at the time, right? Like many people would, and speaking vulnerably. And I would say I spent a good amount of time thinking that I was working hard, but really I was just distracting myself from the pain of not getting the results I want. But I don't know the exact number. The first thing that comes to mind was probably 50% of my day was just being distracted. Yeah, that's a lot, right? No wonder I wasn't getting results. And then fast forward, and I still took action. Don't get me wrong, I still took action, but every time, I had a moment and, to sit down, I'd get distracted. Fast forward, I don't really watch any news. And if I were to watch news, it has to do with wanting information for me to gauge how the public may perceive a specific event. And I typically like to read both sides and read between the lines. Because typically the opinions of the news is the threshold in which, there's a boundary of how far the population is thinking. How far, right? And so nowadays I spend more time doing the work that I enjoy and researching how to improve the methodology. So I would say my news consumption is about 2% out of 100. And social media is something that I don't really touch much. It's mostly my team that handles it. I just spend my time thinking about these goals and designs. So my design is roughly 40 to 50% of the time. I'm constantly tweaking it, testing it. And then I spend the rest of my time essentially building the skills and or the system to test the design. And I would recommend this for, frankly, any of my clients who are just starting out all the way to billionaires. If they, and I'm not saying the exact percentage, but if they design more, they're going to find more and more of what they design show up. It's when we don't design, we're living on default of the programs that our ancestors have passed down.
I see. So by having a design, a goal, something for you to reach for in the future, that helps to kind of pull you along a path that makes it much easier to shed the bad habits, the wasting time, because you're more energized and focused on what you want rather than trying to think of how to avoid the bad things.
Yes. And our human body and mind is programmed and designed to execute on what we focus on. So think of what we focus on as the command prompt. So if we focus on these 100 things and 100 experiences, then it has a place to utilize that energy. And if it doesn't have enough energy because your goal is so big, it will actually unlock itself. Or especially with proper training, it will unlock even further. But if we just think about whatever that comes into our mind, then we just go and buy whatever that's coming into our mind. Like, toothpaste that is being shown on the internet or underwear or whatever it is that we see.
Mm-hmm. Interesting. So this helps us get more focused and discipline and creates for a much more interesting, adventurous life.
Yeah. And a quick way to also share that in a different perspective, it's what gets repeatedly shown on our stage of mind is the very thing that we're going to do next. So what we get repeatedly shown on the stage of our mind becomes what we behave towards and or execute on. Well, if someone else is in charge of what's being shown on our mind, the stage of our mind, then we do what someone else asks us to. But if we design what we want and show that repeatedly on our stage consistently, then that is why we can have the results we design.
Interesting. So it's like, this sounds like this whole process makes it easier for us to become mindful of the thoughts going through our mind. My God, am I repeating the same thing that I thought about yesterday and the day before? And therefore create better mental habits.
Yeah. And if you ask a lot of successful entrepreneurs, whether they're good teachers or not, they'll say consistency is the key. Well, consistency in what, right? Behavior? Well, behavior is generated based on our thoughts and emotions. And if we consistently focus on the desire and the outcome that we want, and if they're big enough, our mind will actually create a shortcut to get there. But regardless, it needs to be something we desire. Otherwise, someone else will dominate that attention. Someone else more skillful will dominate that attention.
Very interesting topics that you've dived in today. I'm sure we just barely scratched the surface. But William, I want to thank you very much for coming on Chat with Traders. And how can our listeners learn more about this and reach you?
Ian, it's been an honor. I love the questions you ask, and they're insightful. As I'm listening to your question, I'm like, man, this is a profound interview, and I think that the people that are listening will be greatly benefited. So to find us, it's easy. If you're into, speaking of social media, if you're into social media, you can find us on Instagram, and our account is called The Upgrade, TheUpgrd. And you can even find me, William.upgrade, upgrade spelling as UPGRD. And if you don't use social media or Instagram, you can go to our website, upgrade.com, upgrd.com. And we have some free gifts. People can jump on. They can sign up for our 21-day focus challenge, and it's completely free. And they can learn about how to design and focus on what they want.
Fantastic. Thanks again, William.
My pleasure. Thank you, Ian.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
I mean, we've all been told the same thing. Have patience. And let's not even get started about the whole cut your losses mantra. But how do we do that? How do we have patience? When do we actually cut our losses? All the seeders and traders, they all say the same thing, but they have different systems. And it's as if they were starting from these lofty principles and then magically arriving to successful trading outcomes. But the reality is it's not magic. They're starting with solid research and a solid process, which just so happens manifests itself into these trading principles.
Markets, speculation, and risk. This is the Chat with Traders podcast.
It's Chat with Traders, episode 276. Hello, this is Ian Cox, Tessa's co-host. Tessa's taking some well-deserved time off and relaxing somewhere where it's warm and tropical. I'm glad she's getting the chance to take this much-needed break. Well, I'd like to introduce to you our latest guest. His name is William Gogolak. As a risk officer with the Chicago Mercantile Exchange, William was setting margin requirements and saw a wide variety of traders' accounts and what separated the winning traders from the losing ones. Before leaving to pursue his own trading and obtaining a PhD in finance, where he shared his knowledge of quantitative analysis and market experience with his students at Carnegie Mellon University. Combining his market experience with knowledge of statistics and understanding the importance of probabilities helps William create his custom buy the dip strategy with futures and leveraged ETFs. Okay, let's get right to it. Hey, Will, where are you based out of?
I am in Pittsburgh, Pennsylvania.
Okay, great. What are you doing there?
So I'm currently a faculty member at
Mhm.
Carnegie Mellon University, teaching in Heinz College. Just some basic finance tips and tricks, I guess.
Oh, okay, great. Yeah, let's dive into your background. How did you first get interested in the world of finance and investments?
Yeah, well, it's always fascinating to hear about people's stories, their unique backgrounds, and kind of really how it shapes their path in life. So I grew up in Indiana, not necessarily a farm boy, but also not necessarily big city either. Grew up just outside of Chicago, and with that whole dynamic between the grain trade and the board of trade, it creates a unique backdrop that blends the rural and urban dynamics together. Maybe it's just like a Midwest thing, but I always had a knack for research. I always had a knack for markets. What are these ticks? What are these pips? 10 ticks, 5 pips, and just trying to figure out the lingo. It was something that always interested me. And I think transitioning to my adult life in Chicago, when you drop a kid off on LaSalle Street who's interested in markets, it's like thrown into the heart of all of it, right? It's a seed planted in fertile ground. So there's something about being that environment that just drew me into the world of finance, the hustle and bustle of the pit, the intensity of markets, the constant hum of activity. I mean, it became almost addictive, and I didn't exactly start trading from the crib. Okay, I'm not one of these trading prodigies, but the markets always had my attention. And like seriously, what other profession aside from boxing do you start the day with with a bell ringing? So it was just a natural progression, finding my way from rural parts of Indiana to the trading floor.
Uh-huh. So, were you introduced back when you were in Indiana to farmers who sold their grains on the futures contract, or did you know anyone in the business?
Yeah, exactly. And so that's right. So it was super interesting because one of my neighbors, I was a kid, he was a grown adult, set up a trading desk in his basement. I think he's a fairly well-known trader. And I got to see the speculative side and then like just also connecting the dots, 20 minutes outside of where I grew up was just farmland. So it's like, what do these two people have in common? Like nothing. So I did get to see both sides of that, and I think that provided a very interesting backdrop into what shaped sort of my career progressions.
So you got exposed to the commodity side, as in grain, soybeans, that kind of thing?
Yeah, so I'm talking grain, soybeans, cotton, cattle, corn, wheat. I guess we keep going, right? But yeah, all of the I would call them CBOT, the Chicago Board of Trade products.
So did you know where you wanted to work right out of college? I mean, what did you?
So I ended up working at the Merc at the Chicago Mercantile Exchange for CME Group. But before that, I had landed an awesome job on the floor of the Chicago Options Exchange. Now imagine a rookie being thrown into the mix, working side by side with these like personalities of traders. And what was my role? Well, I guess I was the data guy. And honestly, I had zero clue what I was doing. but hey, we laughed and learned. I take what I do seriously, but I don't take myself seriously. And whether that's in the classroom, in my work, or in trading. And I believe that this job before going to the Merc was actually a pivotal moment for me when I knew what I wanted to do, and that was research and markets, and I kind of just went off and did that.
Okay, so you knew early on that you wanted to get into research while you were at both the options exchange, and then later you moved to the CME itself.
Yeah. So then later, I developed myself professionally in what would call my first real job at the CME Group at the Chicago Mercantile Exchange.
What kind of positions did you hold when you first arrived at the CME?
Yeah. So when you work at the exchange, you see everything, and you really do see everything. So during my time at CME, my role revolved around setting daily margin requirements for equity index futures and a few other smaller ancillary markets. So back then, the market risk team was distinctly separated into asset classes. And I was part of the equity risk desk. And our primary focus was on consistently analyzing, stress testing, and ensuring that there are enough chips on the table from all market participants to cover any large potential market moves. And doing that with a level of confidence as well. In fact, it was 99% confident that there would be enough chips on the table to cover any one-day market move. So there's 252 trading days in a year. That means that our margin requirement would only be allowed to be breached 2.5 times a year, or 2 days out of the year, 1% of the time. But there's a fine balance to setting this margin requirement, because if you keep the margin requirement too high, customers complain and they say, give me lower margin. And if you keep it too low, it puts the entire system at risk. So there's a balance there. Now the role of the exchange is multifaceted, and margin acts as the initial safeguard for the stability of futures markets. And that's just one piece of the puzzle. But that's where I fit in.
So what year are we talking about when you were first at the CME?
Oh, this was probably just more than 10 years ago.
Oh, okay. And so setting the margin requirements, that was something that the exchange felt that it was necessary to have a human input as opposed to having a computer algorithm figure out the optimum margin requirements.
Yeah. So, I mean, there's a lot to setting that requirement. They have a system, SPAN, SPAN, and that system has worked quite well over the years. It's sort of a VAR-based model. And if you really think about what is a margin requirement, it is VAR. But at the end of the day, there's a human element to it as well, making sure that there's plenty of safeguards in place. And, it is just margin is just one of the safeguards. And there's more and more added each day. Interestingly, I guess for banks, the responsibility now falls on the American taxpayer, or at least the treasurer, for that matter.
Oh, so what other aspects to managing risk are there than setting the initial margin requirements? What about maintenance? Does the maintenance level fluctuate with the initial margin requirements at kind of the same rate, or how does that?
Yeah, in most markets, the maintenance margin is a direct function of the initial margin. Now, when you start adding options to your portfolio, you've just introduced a lot of new risk factors, not to mention a moving delta, right? So your gamma. And then correlation is brought into the mix as well. So if you're long S&P, short NASDAQ, you will get margin credit for that. But the way that's kind of viewed is like its own position. There are benefits to having a diversified portfolio or a delta neutral portfolio to help bring your margin down.
And how often did you find that raising the margin requirements would end up creating margin calls on people with positions?
Okay, so in my opinion, you don't want to do that too often, because what it does is it creates additional stress on the market. And there's actually a provision for this called procyclicality. And then there was a law regulations created called anti-procyclicality. So what you're doing is you're promoting the cyclical selling of additional securities. So I mean, there's a balance there to have it sufficiently high enough whereby you don't induce selling. The Merc has been on the hook for, at least in headlines, saying that at some point they have caused something. But me personally, I don't think I'm a believer in that. CME was once called the egg, cheese, and butter exchange. And now it's grown to be a systemically important financial institution, quote unquote. Mm-hmm. And I mean, they really haven't had any major disruptions, which is truly remarkable. At least to my knowledge, I mean, they haven't had a technical default of a portfolio, meaning if you make money on CME, you're going to go to the cage and get your chips, and you'll be able to cash in your for cash. So not only have they provided us an arena and a marketplace that works pretty darn well, but they've also achieved just a darn good business where they got one of the highest revenue per person in the entire S&P. And I think there's a night at at the top of that castle that runs a pretty good castle. So maybe it has something to do with the management in charge.
Uh-huh. I've often heard over the years, the gold bugs argue that there are more than 50 times as many paper gold contracts being traded than physical gold available to deliver. And they argue that if just a few % of traders stood for physical delivery, it would blow up the exchange due to insufficient physical gold available in the vaults. Do you know, is this true? And if so, why is it allowed?
Yeah. So the question of whether it's more derivatives than the physical asset really depends on a lot of factors, and specifically the risk tolerance and the diversification and the liquidity of that position. So not only does CME provide the buyer of last resort, meaning we will buy all of your gold if you want to sell all of your gold, but it's also a matter of liquidity. I mean, CME has partnerships with liquidity providers, meaning there are people that are on the exchange and are sufficiently capitalized to take on any trade that comes through the exchange. So it's not like the Merc has to, if the guy wants to sell all his gold, it's not like the Merc has to buy it all. I mean, there will be liquidity on the other side because you and I both know the firms who are actively engaging in that market. And oh, by the way, if you want to sell your gold, you're going to have to do it in that large of a size, all of the world's gold. You're going to have to do it at a very high liquidity premium. And there's definitely a market maker on the other side who's willing to take you up on that.
I see. But most of these contracts, they settle in cash, right? But as far as the people who are long gold, if a very small percentage of them, the gold bugs argue 2% or less of them actually stood for delivery and say, okay, I want my physical gold that the COMEX warehouses wouldn't be able to deliver. Is that a kind of an intentional flaw that they say, oh, that's a very low probability? Or what's the reasoning behind that? It seems like it's very risky, no?
Well, I mean, they're cash settled. Excuse me, they're delivered in physical gold on the day of delivery, but it's cash settled on a day-to-day basis. So it's not like all of that gold would need to be delivered on a single day. The gold delivery would take place at the end of the contract. And then there's limits, Ian, where if you're getting towards the delivery period, you actually have to show proof that you can sell the amount of gold that you have and or can buy the amount of gold that you own in the derivative. And if you can't, well, you would have to roll your position into the next contract. So there would never really be a situation where you would take on all of these gold bars. The delivery process and the delivery window leading into the 20, 30 days heading into delivery, whatever it might be for gold, would like stop that from happening.
Mm-hmm. Can you tell us what happened with oil and why did it go negative in price in 2020? How is that even possible?
Oh, okay. So yeah, this is a really good just economic argument. So of how derivative exchange works. When there's a central point of delivery where all the oil goes to, and that happens in West Texas. So when we talk about what the price of oil is, that's the price of oil in West Texas. By the way, there's many other prices of oil where delivery is taking place that isn't in West Texas, but the one that you see on TV is usually Brent and WTI. So what happened at the West Texas port is the boats were coming in to deliver the oil, and there was nowhere to store it. So there was no buyer who was willing to accept that oil that was on the boat. They said, we don't have anywhere to put it. And then the guy on the boat said, well, what do you want me to do with it? I was supposed to give it to you for $65. And what the guy on inland said was, here's $10, turn around and go back home and take your oil with you. So what happened was the people at the delivery point were actually paying to not store the gold, or excuse me, not store the oil. And that's what caused a negative price.
I see. So it was it's obviously once in a lifetime or once in a 100 or 1,000-year event because of the constrained ability to store the oil that was coming in at that time, right?
Yeah, I mean, the question is why were the tanks full?
Right.
is because of the coronavirus. I remember looking out my window out on Michigan Avenue, and every maybe half hour, 2 cars would pass by. And it's like, well, gee, no one's driving, no one's burning gas, no one's in factories. And we just ended up with way more oil in these tanks than we needed. So that meant that there was too much supply, and they started paying to make them go away.
So did you get a chance while working at the CME to see the different types of traders' accounts, what they were buying, what they were selling, any kind of analytics on common mistakes that losing traders do, and what separates successful traders from losing traders?
Oh, yeah, absolutely. So in my experience working at the exchange, I had the opportunity to observe a diverse range of trading strategies. And on one end of the spectrum, you've got these daredevil types who wake up, throw wind in the caution, and practically roll the dice with their entire account. And not surprisingly, this often ends in some serious losses. And on the flip side, I've had the opportunity to monitor and review trades from some incredibly skilled traders. And what hit me hard during my time at CME was how critical comprehensive risk management is for the game. Like, sure, we all chat about where to buy and when to buy. But what I noticed was the ones that were making real money, the prop firms that were true professionals, they get that it's way more than just picking a direction, right? So like even like the exchange itself does not pick a direction. You cover both sides of the trade. You come to CME, you got to cover the longs and the shorts. So they're actually directionalists, and really good traders understand that the market could go anywhere at any time. And they're actually, I believe, good traders are really just good risk managers. As I see it, and they know a lot about the big picture too. They're juggling a whole position, considering factors like their gamma, their theta, their vega. And these insights, Ian, they extend beyond just options trading. Like in the realm of futures, where we take on delta one positions, there's recognition that the rate of change can vary throughout the day, which like is by definition, like that is your gamma. So there's, and also there's obviously increased volatility surrounding specific events. So like having this second derivative approach, and I found that I think the distinction between some of these good traders and the outstanding ones lies in their ability to navigate market directions, but also their holistic approach into understanding and managing their entire portfolio. That's probably one of the biggest things I picked up while I was there.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Now, did you pick this up because you're interested in observing individual accounts, or did you guys have analytics tools that would actually analyze this, and then you would review it, and your fellow coworkers would also look at this, and then your bosses would talk about it?
Yeah. So basically, Will, where did you gather this market data? I mean, I think a lot of it was through observation of trading accounts, because we did have account level positions. The problem with that, the answer is we actually talk to these people. But the problem with reviewing their accounts is you never know that if it's actually a hedge or not, right? Because the futures market and futures and options are, by their existence from Black-Scholes, are hedging vehicles, not really speculative vehicles. So you don't know if they're actually hedging, if what's on the other side of the trade. So that's the problem with just reviewing the account. But then we did have an opportunity to talk to some of the big accounts, and the prop firms, they traded directly with the exchange and didn't have to go through a futures commissions merchant. They were an FCM themselves. Yeah, we would meet with them and talk to them, and we would do these. They still do them today, I'm sure. Might be a little different, but you would have interviews and talk to the risk managers and some of the traders and find out more exactly about what the risks there might be in their portfolio.
I see. So, so again, risk management sounds like the very key differentiator between the successful traders and the ones that lose money.
I would say that a good trader is nothing more than a good risk manager.
So how does that look then? Say you have two traders, a beginner and a very experienced one, that say they're both bullish on oil, for example, and they both go long contract of oil. What would be the difference that a successful trader, how would they manage that position versus the inexperienced trader?
Yeah, so it's a really good thing, a really good question, and it's one of the things that kind of gets under my skin when it comes to reading some of these books on trading, and definitely not podcasts. Podcasts are great. Listen to all your podcasts. It's just the consistent just rehashing of trading principles. We've all been told the same thing: have patience. And let's not even get started about the whole cut your losses mantra. But how do we do that? How do we have patience? When do we actually cut our losses? What I've noticed is that all the seeders and traders, they all say the same thing, but they have different systems. And it's as if they were starting from these lofty principles and then magically arriving to successful trading outcomes. But the reality is it's not magic. They're starting with solid research and a solid process, which just so happens manifests itself into these trading principles. So I really think it's about knowing your strategy, and understanding what hand you're being dealt and what hand you're holding at every given point in the market.
So different traders and trading the same contracts would have different risk management levels that they're looking at, that both can be effective. Is that right? Because they're applying different strategies and for this position.
Well, let's just assume that they're even just applying the same strategy. Okay, you get into the strategy, and let's say that you get into a strategy and they both have a 60% probability of win. Well, what happens immediately after the next tick? That probability changes. And if there's one trader that doesn't know their probabilities and the other trader does, well, one's going to be more successful than the other. So it's more of a dynamic process than a discrete one where we just pick on the chart, click and say go, and we all have, we make our money.
I see. So it's a process of adapting to the market changes as they change, that differentiates a successful trader from one that is not?
Yeah, I'd say so.
I see. So what are some of you mentioned that, cut your losses. Give us an example of, most traders are accustomed to, set your stop loss at, 5% below or 10% below, or set it at just below support levels and then just let it run. What's your view on that? And would you make any adjustments or additions to those statements?
Totally. All right. But before we jump into the nitty gritty, let me sketch out the different kinds of analysis that we could be diving into here. So, if I were to break down all the investment research into just three main buckets, which is kind of funny, but it's okay. And in fact, this is how I arrange my class when I teach financial investments at CMU. So first up, we got fundamental analysis. Fundamental analysis, it's like saying, I'm going to pick up this stock because of these 3 solid economic reasons and for these financial reasons. Okay, it's like saying, I'm going to put my money here because the company's financial health is good, earnings are good, overall economic conditions look solid. It's all about understanding the core factors of a company's value. Then there's technical analysis, which is a bit like reading the language of stock charts. You're looking for patterns and trends, and when certain lines cross each other, and when the price hits a specific point, it signals an opportunity. But then last, you got quantitative analysis. And quant analysis involves crunching numbers and looking for anomalies or irregularities inside of the data. It's finding those hidden patterns that might not be obvious at first glance. And when you spot those, that's a cue to take action. So honestly, not many folks can dive into all 3 of these trading methods at once, like drinking from a fire hose. But I'm pointing this out because anyone trying to step into the trading game, figuring out where to start, which one of these 3 places, is probably the trickiest part. I mean, once you find something that works for you in those archetypes, you got half the thing licked. And it's so funny because you got one group of people saying, stick with the economics, value and supply and demand, like professors and academics, while there's another camp that's like, just follow the data and price means everything. So if you're just approaching this, it's so confusing. It might take you ages to figure out what suits you best. I believe that a good starting place, Ian, to answer some of these questions: when to cut your losses, when should I get into trade, what does it mean to be patient? I think a lot of those answers is in quantitative analysis. I think when you look at the quantitative analysis of whatever position you're in, those 2 oil traders, 2 exact same people, one's not doing quant analysis, one is. The one that's doing quant analysis is going to have a better way to enter and exit their positions using some of these principles.
Can you give us an example of a trade using quant analysis? What are you looking for with quant analysis, and does it differ much from commodity to stock to futures contracts, whatever?
Yeah. So I mean, does it differ? Not really. But to get into what it is, like, I often find myself drawing parallels to a poker table. So even if you're not a poker enthusiast, you can at least appreciate the basic gambling analogy. Think about when you turn on the World Series of Poker. The bottom left, there's that little tiny screen for each player's hand that displays the probabilities of a winning hand. I'm not sure if you're familiar with this, Ian.
No, not exactly, but please continue.
Yeah. So when you're watching poker on TV, they show you the players' cards, and then they show the probability of winning. And it's thrilling for viewers because we witness the players' actions with these calculated probabilities, which offers insights into their strategies, personalities, etc. of the player. Now, imagine the same scenario in trading. Much like the poker player facing a hand, traders consistently confront the uncertainty of market returns. And the key here is to understand your probability of success. It's analogous to the poker player who, armed with a few fundamental heuristics, can reasonably calculate their chances of winning, let's say, regardless of the opposing player's hands. And I think, sadly, many traders overlook the critical aspect. They don't know their probabilities. So when to make the right move in trading, everybody knows when to make the right move. We're all waiting for this line to cross that line. And you jump in because there is a just 60% of chance. But here's the thing. You're not sure about the whole journey the trade takes, from open to close. That's where bringing in some basic quant statistics can be a big game changer for some of your listeners. Imagine if you're a technical trader and you want to add a bit of number crunching to your strategies. The first thing I would do is start by pooling some basic descriptive statistics of your trading returns. Look at how the trade has behaved at the 1 minute mark, the 5 minute mark, the 1 day, the 1 month, whatever suits your system. This simple step helps you figure out the distribution of returns post-execution. And why does this matter? Well, it's a straightforward way for you to answer some of those nagging questions, like, should I bail this trade? Well, if the position is in your favor and it's in line with what happens only about 5% of the time, chances are it's a smart time to cash out. Also, on the similar conclusion can be inferred from the downside. So adding a basic touch of quant analysis can really give you a potential edge and shine light in dark corners on making some of these critical decisions in the market.
I see. Wouldn't the quant analysis, though, be reflected in the chart action? Like, say, for example, most of the time a stock is kind of trending upward, but in this rare exception, the stock makes a huge spike upwards that looks like a giant wick on the chart. And statistically, that's a rare event. But you could look at the chart and you say, oh, I can see that's a very rare event. Wouldn't that be confirmed by quant analysis, or are you talking about something different?
No, yeah, I think so, Ian. I think if you look at the chart and you say, whoa, it's gone up a lot, right? Let's quantify that, what it means by a lot. Is that in the top 5 percentile, 10 percentile, 30 percentile? And then make some decisions based on that. If the market spikes and it's only in the top 30th percentile, that can mean that the thing still has room to run. I mean, drive this, and let's say it's just after a Fed announcement. Oh, now to really giddy up, it keeps going, right? So being aware of the context of the market also important. But yeah, you see this on a chart, absolutely. But it's unbounded, not bounded by anything.
Mm-hmm. So the use of quant analysis is done after you make the trade and you're monitoring it the whole time through? Or is this something that you do a bunch of back testing on and you say, well, based on the back testing, this is what I can expect?
Yeah. So, I mean, the back test provides a good place to start. But then what I'm, I guess, suggesting here is what to do with that trade after it's been executed, which you could also back test.
So did you have these ideas when you were working at the CME, and were you able to trade your ideas while you were there?
Oh, so good question. I mean, after grinding at the Merck for more than a half decade, I thought, hey, why don't I try this on my own? So I ditched the Merck and took a different job to pay some bills, all while diving into the world of trading. And I got so into it that I decided to take a plunge and get my PhD in quant analysis. I figured if I'm already doing the work, why not throw 150 grand at it and slap a comma after your name? So, there's this whole hype around, by the way, PhDs, I think, in the trading world. And I used to think like that, Ian. I used to idolize them. But I mean, the deal is not every great trader needs a PhD. And trust me, not every PhD is even a proficient trader. So, there's probably a lot of your listeners out there thinking, especially if they're younger, I mean, hey, should I get into this? Should I get into this PhD thing? Is that going to help me? Kind of. It's going to help you. It's going to help you become a better researcher and understand how to do hypothesis testing and setting up a hypothesis and working within. I mean, you can't really get out of a PhD without doing any programming. So you do leave with some of those skill sets. One, a prop firm, and two, academia. I decided to go to academia. So if you're not really interested in doing those things, you really don't have to. I do have the great pleasure now, being so far removed from the Merck, that I could trade my strategies on my own.
So was the catalyst for you to leave the Merck because you wanted to trade on your own, which you were prohibited due to restrictions?
I think that's part of it. I mean, I consider myself more of a professor that does trading than a trader that does professing. I'm more interested on the research side of thing. But I would say that had something to do with it, Ian. Why not?
Is there any very simple entry-level quant tools that a trader could use that you could give an example of that a trader could implement fairly easily to enhance their trading?
Oh, sure. So to become orientating yourself in the market, I think that's just a good place to start. And people in academia have been doing this for years. And really, what you're asking me is, how do I actually turn the market into a probability machine? Like, Will, how do you do that? How do you come up with these probabilities and know when to get in and out? So let's just take it out of the market context for a second and let's talk about weather. When we talk about it in the market sense, I think it brings up so many biases, right? We're all reminded of that one trade and we can't clear our mind. So I'm here in Pittsburgh and a place that has all 4 seasons. And let's say Ian comes to me and says, I want you to predict tomorrow's temperature. What's the best way that I could go about predicting tomorrow's temperature? Well, first off, tomorrow's temp is probably going to be a lot like today's temperature. Also, there's another day out there that I could use, the 365th lag. So tomorrow's temp is probably going to be a lot like today's temp, and that temp is probably going to be a lot like what it was a year ago. And then I could use the 730th lag, the 1095th lag, and so on and so forth. So even as a child growing up in Indiana, you could answer questions of when it's going to get warm. Well, it's going to get warm probably after being cold for 90 days. So sometime around the 91st day, it starts to be spring and warm up again. So, I mean, the same thing could be true in markets. When will the market turn back up? When will the market probably turn back up? Well, after being down for 9 days in a row. So there's definitely places to look. And your question was, what are some simple things that people could look into to enhance strategies through quant analysis? Look into streaks, after something happens n times in a row. Queuing theory, basic statistics of mean, median, and mode. Where's price relative to its mean, median, and mode? Cycles and waves, distribution of forward returns, given existing conditions, and then you have probability distribution. So those are all really good places to start.
Well, this is a good segue. Apparently, you have a buy the dip methodology. Would you care to share with us?
Yes, absolutely. I mean, people talk a lot about buy the dip. I guess not anymore because of 2022. Basically, defining buy on the dip is a hard part in part of these discussions, especially what you see on Twitter and other sites. Like, what is the dip? Let's define the dip. So are we waiting for it to be X percentage off its high? Or are we waiting for a certain number of days off its high? Well, all those are good, might be good strategies, but I kind of take a different approach. What I try to do is compare the current price, and measuring it from a distance to an average price. So I would define a dip as when current price moves X below an average price. That's usually a good indication to buy.
I see. Is this like where the price, the average true range expands significantly, like a violent downdraft?
I would say more so. Yeah, it's like an average true range, but I'm talking more so just a moving average. So price from the current moving average.
Mm-hmm. I see. So then, in particular, do you look for certain moving averages to be breached or held at support? What do you look for?
Yeah, so I like using a super long moving average, like the average of the last 1,000 bars. You can make that your benchmark. It's a pretty go-to average price based on some research. Now, whatever time frame you're working in, so you could simply just use the 1,000 bars. So when the price takes a dip, say 3% below this very lengthy average, there's some research to suggest on my end that it's a good signal that the market might be in a short-term overreaction. So like the 1,000 minutes. So let's say we're using 1,000-minute moving average bar. 1 minute bars, 1,000 length moving average. So that's about 16 hours, give or take a coffee break. So if the market goes down 2 to 3% from its 1,000-minute moving average, that's a pretty good time to buy. Now, let's say you're using a 5-minute bar instead. You can still roll with the average price of 1,000 bars. Quick math on that. That's 38 hours. So yeah, it's like an average price over the last 3.5 days. And when current price moves again, about 2 to 3% off of that average, it's usually a good sign to say that it might be overdone.
Speaking of being overdone, do you ever look at other indicators like the VIX index or any other relative strength?
Okay, so that's good. So You're paying attention. Thank you. You didn't. I thought you were going to say some technical indicator that says overbought and oversold on it. No, I don't use RSI or anything like that. But yes, I will use the VIX. There's a lot of information in that VIX. It tells you a lot, and you could basically apply some of these same quantitative strategies on the VIX to tell you and infer information about the S&P, which is pretty sweet. But yes, I will bring in other indicators, and there's a ton of information in the VIX. What I don't use, just to get back at what I was saying, was that I don't use like an RSI because there's additional inputs that are in there that I believe makes that indicator a biased indicator. Mm-hmm. So I use price alone with some quant analysis.
I see. How many different inputs of quant analysis go into your model? And do you frequently find that there's so many that it tells you just to wait? I mean, how often are you getting signals to buy?
So that's a great question. I mean, part of the reason that people don't like buying the dip is that you have to wait for a dip, right? Or you have to force yourself into a dip, which I don't like. But if you're using, say between 10 and 15 factors, one of the factors may just be how far away are you from the moving average, and another one might be how far has the VIX moved in the past 5 days. Like from a principal component analysis, from understanding what are the factors that really drive the returns and drive the signal, it's really those two things. So I mean, you could throw in other factors, but I haven't been able to really get much out of them. You could keep them in the model because why not? They're not harming you. If you're using the fast bars, if you're using say a 1 minute bar and you're waiting for a good setup, I don't know. Pull up my statistics here. Yeah, I mean, you get a trade at least 3 times a week. It's kind of like a swing trade. Then sometimes you get stuck in these long trades, which I guess we could go into, and probably what you're going to ask me about next.
Yeah. So what type of instruments do you trade with this buy the dip strategy?
Okay, so I would recommend, if you're looking into something like this, futures are a really good way because it keeps your margin requirement low. Levered ETFs are okay too, but you just got to be careful with those. So buy at your own risk. I mean, this whole strategy is buy at your own risk, because what you're doing is basically dropping, trying to pick up a falling knife, which will work, but you have to maintain good risk tools. And I could go into that, but you could use levered ETFs or futures. I prefer the futures because, man, we've seen what happened to some of these ETFs, like the VIX Vortex. Those things just blew up, and I don't even know what happened with those people's money. So it's very challenging to sit there and, you got to know the product really well and the risk management that they impose on the product. We have circuit breakers these days where if you did own something like the TQQ, the triple NASDAQ, 3 times the day returns, the circuit breaker is almost 10% on that thing. But I mean, you're getting whacked by 30% at least on that TQQ. Notwithstanding, you don't even know what their margin requirements are. So it's just something you got to be careful with. That's why I prefer just making your own instrument with the futures if you can.
Then what do you look for risk management when you're buying something on the dip? Is it?
Yeah, you just start with a low position size. Start with a low position size. You start building a position over time, and you kind of just have to do this, especially when you're using leverage. And you take what the market gives you.
In the email that you sent to us, you mentioned that your comprehensive research and experience in the realm of trading has led you to discern that markets necessitate contextualization within the framework of conditional probabilities. Could you expand on that?
Say we go back to that poker hand. So market setups can be deceiving. Like you could start a good poker hand with a pair of 3s, maybe a spade and a club, both black cards. Seems promising, right? You got a pair of 3s and you probably have the winning hand right now. However, when new cards are shown, much like the flop in poker, it can quickly transform your outlook. So picture a flop with a king of hearts, a queen of diamonds, a jack of hearts, all red cards, much higher than yours. Suddenly, what seemed like a winning hand moments ago becomes a losing one. And is, in essence, success in trading is like that of poker. I mean, hinges on knowing your odds. Without a clear understanding of your probabilities of success at every moment, the principles and advice often just lose their effectiveness. You got to know know your hand, gauge your odds, and play your cards wisely in the unpredictable game of the market.
Say in stock terms, if somebody's long a stock and then they go through earnings and earnings disappoint, the stock has an initial gap down, then would that then be an example of, well, given the framework of what's going on right now, just get out of the position because it disappointed earnings and the market has voted?
Yeah, I would say that just depending on what your original framework was. If you're coming from a fundamental analysis framework and you buy stocks that have good earnings and then you don't have good earnings, you got to get out of the stock. Now, if you contrast that with buy on the dip, which is probably one of the challenges with mean reversion, is that, well, if I bought it at 30, I love it at 20. and that is true in of a sense. And that's just one of those things that if you're doing analysis on a buy on the dip strategy, you could get caught up in a trade if you don't have proper risk management and position sizing. So I would say, in the context of this is what I meant by contextualizing your position. In the context of fundamental analysis, you get out of the trade. In the context of buy the dip quantitative analysis, you buy more. So I think we just need to be very clear on what we're suggesting to each other when we're talking about strategies, because contextualizing them within your framework of how you analyze the market is super important, right? It's of the utmost importance in my opinion.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
So do you ever look at Commitment of Traders report and to see the extremes in bullishness or bearishness and say a lack of reaction when on really, really good news, or actually a bounce upwards on really bad news as an indication of this contextualization that the bears have run out of steam or the bulls have run out of steam and it's ready to reverse course?
Yeah, so the Commitment of Traders, it's printed and made by the regulators at the CFTC. And what the report does, it breaks down the open interest of futures and options markets for various commodities. And it basically says, what are the activities of different market participants, including the hedgers and the speculators? So I believe that Commitment of Traders report actually is one of the features or one of the reports in the market that I think is technical in nature, meaning overbought and oversold, that actually gives us a lot of information about where price is and why it's there. The problem with a lot of these reports, Ian, is that they're so delayed. They don't get published always at the same time. It varies by market that what you're trading. So there's this huge lag effect, and then not to mention there's all these revisions. I'm not sure if the Commitment of Traders report gets revisions, but relying on some of those reports from the government they're not always timely as the market. So that's one of the reasons I don't like it. But I think it's one of the few that really does tell you about what people are actually thinking and why they're expressing their bets the way that they are.
Do you ever look at that for yourself in your own trading as times to increase your position or decrease your position based on rare extremes that you see?
Not really. I think more points towards the VIX. There's plenty of mean reverting strategies that use the Commitment of Traders. I just haven't done that. Perhaps maybe it's a good place to look into.
So what do you do then during these times with incredibly low VIX numbers that we see in these long grinding upwards bull markets.
Yeah.
How do you buy the dip then?
Well, that's the thing, right? So it's always worth carrying some position in the market. I mean, I'm talking an equity long, okay? Because in the buy the dip strategies, how the buying principles work with buy the dip, it's oftentimes what they do is they say either you're in a trade or you're not, right? So you wait for the trade. When you get the trade, you enter, and then you get out when it reverts back up, and then you sit there and you wait again. I actually don't find that to be entirely productive. I mean, what's a good thing to do is be in the market, right? Because there's this natural tendency for economies to grow and whatnot. And then once you get an opportunity to buy the dip, you could slowly begin to add leverage to that position, where you end up actually building a portfolio, a levered portfolio, as the market continues to go down. So while you're waiting, you just sit there and wait. So we went through an expansionary period in the markets right after COVID. Everything mean reverted. It went back up, and you have a long, delta one position. 2020 comes around, you begin to sort of get into a position, and then that bounces back, and then now you're sitting towards that high again, and you're thinking to yourself, okay, do I delever this position and just get back in the delta one, or do I keep letting my dip strategy ride?
Yeah, I'm just curious. Do you ever see a time where the dips in the U.S. markets get shallower and shallower because of the necessary money printing that's needed to just even service the debt with the runaway debt situation? And the reason why I ask this is because I notice other markets in the world like Argentina, Venezuela, and Turkey, their stock markets perform incredibly nominally because of the massive money printing, despite the economy not doing so well. Do you see traditional technical analysis being impacted by massive money printing that flows into the markets?
Pretty good at this. That's exactly where I was going to go. So first of all, the dips get shallower and shallower at the top. So there's actually some, based on some of my research, to suggest that perhaps maybe at the top of a market, like we're getting towards our highs again, it's actually not a bad time to do a dip strategy on a shallow dip. So that's just one thing there. I think your question was more along the lines of macro analysis on economies. Yeah. So think back to like the Depression in 1929. There was no financial safeguards. I mean, very little. And then over time, we've built up all of these safeguards to protect not only American workforce, but also support American markets and American banking systems. So yes, empirically, what we have seen is our dips are getting maybe not shallower. They are getting shallower, but I'm not totally convinced of that. But they are quicker, a lot quicker. Think about think about people that are relatively new to the market. So what I mean by that is 1 or 2 decades. We've seen some hard and fast dips, right? That's what we believe to be a dip. And, there was lost decades in the past. So they're actually happening more frequently and at a faster pace, which actually sets up for a really good trading opportunity.
Any other advice or suggestions that you would like to present that traders may not have considered?
Yeah, so I would just say, if you're getting into trading, starting with a research frame of mind is a good place to start. That doesn't mean you need to go get a PhD in finance or go spend a bunch of money on courses or whatnot, but pick up books on games of chance. There's actually a book called Games of Chance that's worth reading. Pick up books about how systems work. Those are really good things to help orientate yourself in your trading. Like if you're obsessed with this and you're obsessed with researching the markets, you're going to find a way to start to connect the dots with anything you read and do. So I would just urge people to, especially if you're new to the market, to hone in on how your system behaves and just general market behavior in the context of quantitative analysis.
Great. Will, what are you most excited about now as far as any goals that you're working on right now? Or
Yeah. So I'm working on creating all these probabilities and figuring out a way to always know what the probability in the market is, whether it's an up or down. Like if you think about the scale from negative 100 to positive 100, meaning negative 100 is completely short, always be short, pressing your short, and positive 100 is 100% long, more than 100% long, and pressing your long. Where are we right now? Like, what is the market presenting? What price? The market is showing us a price right now in the S&P. Where is that on that spectrum? So I'm super excited to look into where I should be orientating myself at any given time in the market, which I think is really impactful to make some research and trading decisions.
how often do you get impacted by paralysis analysis?
When you have an idea and you have an inkling that it might work, just you could go with it and you could start trading that idea in low numbers. Definitely continue to research that idea, but I find there's no better way to test the system than in the real market. So start low, get to know it, and that's probably the best way to do it. So nothing holding you back there.
Oh, great. Will, I want to thank you for sharing your experience there at the CME and all the things that you've learned in the statistics in the markets with us here at Chat with Traders. Thanks for coming on the show.
Thank you, Ian.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
And I basically turned like a very big win into an outsized loss. After that, I said to myself, I know how to make a good trade, but when I'm making these swing trades, like I need to have better rules for getting out, right? Because there's many fish in the sea. So rather than get emotional about it and attach my bias to the trade, I'd much rather have rules for when A, B, and C happens, I cut half. And when D happens, I cut the full thing no matter what. I don't care. On to the next one. That thought just kind of spurred me into this very systematic way of thinking. And once I came up with rules for everything, then I started to ask myself, well, maybe I can automate this.
Markets, speculation, and risk. This is the Chat with Traders podcast.
We're happy to bring to you another awesome episode on Chat with Traders. This is episode 277, and I'm Tessa, co-host of the show. When I think of algo trading, what immediately comes to mind is complex programming, testing, a lot of number crunching, steep learning curve, lots of time and all that. Some or a lot of that could be true and sounds overwhelming, but I have to remind myself that it can feel this way with many things when we don't yet know or understand something. Ian chats with an awesome guest today. What I love about this episode is that you get to hear more about the bridge between discretionary trading and algo trading, and it's not all black and white, right? You'll see what I mean. Well, let's introduce our guest. His name is Garrett Drinan. The lure of the markets seduced a successful musician into full-time trading at a well-known prop firm. Collaborating with other traders, Garrett learned the market signals and other ingredients which go into great setups. Wanting to expand his reach, he uses his programming skills to create new algos which help him and his colleagues find the unicorns and ponies and manage a larger portfolio than he could normally handle. Let's dive in, shall we? Ladies and gentlemen, we're so pleased to present Garrett Drinan from New York.
Hey, Garrett. Welcome to Chat with Traders.
Great. Thank you. Thanks so much for having me. I've been listening to this show for longer than I can remember. I'm a big fan. You've had some serious legends on this show, so it's really an honor, and it's humbling to kind of be a part of that.
Great to have you join us. So where are you at right now?
So I'm in Brooklyn. So I'm in my apartment. I usually trade at the office, which is in Midtown Manhattan. Today I stayed home to do this. Yeah, I'm in New York City.
Oh, great. Where did you grow up?
So I grew up in New Hampshire. I grew up on a farm, very different than New York City. We actually had pigs and sheep at the farm. Uh-huh. So, when I was a little kid, I would be, jumping in the pig shit and stuff like that. I remember that one of my earliest memories is my parents delivering twin lambs in the barn while reading. They had an open book called, I think it was called Raising Sheep the Modern Way. And they're literally like reading from this book, delivering these baby lambs and kind of just learning how to do all that kind of stuff on the fly. So it's pretty interesting.
Oh, wow. Did you want to get into being a farmer or raising sheep when you were young?
No, I am no expert on raising sheep. That's something to ask my parents about, because I think by the time I was probably in junior high, they kind of got rid of all the farm animals, and then it was just a farmhouse.
So what did you end up studying in school, or what was your main area of interest and focus?
So I studied English and music at the University of Pennsylvania. During school, was heavily into music. Played the guitar, studied it, played with other musicians. We had a group there. We were playing every week. I actually did the crazy thing of right after school going and being a musician in New York City, being part of recording sessions, going on tour, all that crazy stuff, which is, of course, exactly what my parents wanted me to do. But it was a fantastic experience, and I learned a lot. It was a great time. And, I was lucky enough during all that to also have a job in the music industry, in marketing and sales, for a pretty cool company. And what was kind of nice was they understood, because a lot of musicians worked there, they understood when you had to go on tour and do some things like that. So I did that for a little bit before trading, so it was quite a transition.
Yeah. So what triggered the transition? How did you get introduced to the financial markets?
I was always interested. From the time I was really young, I would look at stock charts just because I thought it was fun. It was like a game. But it was just a hobby, right? I'm not pursuing it. I just thought it was kind of cool. So I'd always sort of follow it. But when music started to cool off a little bit, I just had all kinds of more time, right? Because like after work every day, I was rehearsing, and of course I was leaving and going on tour and recording and doing all these things. So when that cooled off, what kind of naturally started to fill the void was my love for the markets. So I started reading everything I could get my hands on. I started trading a paper trading account, just to experiment. I was trading my own account, more of like an investment style, but really focusing on it. It just kind of happened. And I started studying for the CMT certification and went through a couple rounds there before I got hired at SMB. I didn't finish it. And so that just kind of snowballed. And I was just, all my extra time was being used to study the markets. And even a little bit like during the work day, I'd be, looking at the market and stuff like that. And so it kind of came to a point where I was like, this is what I want to do. Like I loved my job, the music industry. I mean, I worked for a guy who basically invented effects processors and basically analog and digital devices that change the sound of your instruments. If you're playing a guitar, it can provide a distortion or reverb and stuff like that. He basically invented these things in the 60s in the Village and was handing them out to guys like Jimi Hendrix and Carlos Santana. And he still ran the company, and I got to work really closely with him. So I loved that job, but there was only so far I could go with it. And I felt like I had kind of like reached my max there. And so I was like, God, how can I get into trading? I mean, this seems like such an enigma, right? Like, I mean, I was like, am I going to have to just try to find a job kind of in the financial industry just so I'm near it? And then maybe like I meet some traders and kind of get into it that way. And so
what year was this that you first got into the financial markets? And how old were you when you opened your first brokerage account?
So, I mean, I don't remember how old I was. I was in my 20s when I opened up my first brokerage account. I started at SMB in 2017. It's been, 6 years, something like that. I mean, to be honest, like I didn't know anything about intraday trading when I started there. What I knew really, if anything, was the macro landscape, like how things kind of worked with interest rates and sectors and bonds, and how the Fed affected things, and the fact that gold was affected by real rates, and sort of this intermarket big picture analysis. But I had no idea about the intraday volume cycle, volatility at the open, and then things calm down, and then volatility back into the close, and these intraday setups were all new to me. So it was sort of trying to marry, my overall sort of big picture knowledge with, okay, like how do I trade this stuff now?
Before joining a prop firm, what did you trade, and what were kind of your early mistakes?
So I would trade oil stocks, and I would look at crude oil. And this was a time when I think that made more sense, like around 2015, 16, the whole market was moving with crude oil. And a lot of those oil stocks were in play. And so it's very different now. It's not something I do anymore. But back then I would be looking at the oil futures, and I would find these, oil pure plays. And if I saw a big breakout in crude oil, I would look to the oil names and see like what's about to break out. So that's one thing I would do. Another thing I would do is just trade relative strength, which is something I still do every day, right? So I would just find the leaders. I would try to identify the strongest stocks in the market and the strongest sectors in the market, and then either look for pullbacks to buy them or look for breakouts. Pretty simple.
I see. So when you were trading these oil stocks, did you and you saw that there were some early movers as the price of oil was going up. Did you ever feel tempted to buy some of the laggards, knowing that historically they tended to catch up in a major bull market, that, a rising tide lifts all boats? Or did you just, were you pretty disciplined and just stuck with the big names that moved first?
It's so funny you asked that, because this was one of my biggest mistakes early on. I was always the sucker who would be going after the sympathy play that hasn't moved yet, right? Because it's like easier to buy. And of course, it would never move. And so I learned really quickly to find the strongest stocks, go after the leaders. And also, I learned how to pay up. A lot of times, we're working on different time frames. So one of the things I like to do is think about paying up on the higher time frame, but fighting for price on the lower time frame. And that's one of the ways I think about getting really good risk reward and probabilities, because you might have something that's really strong intraday that's breaking levels on the daily chart. So it's already up more than everything else, but I still want to buy that stock, right? Not everything else. And so then I'm drilling down and looking at the lower time frames to see where I can get a price where I can actually get in with good risk reward and have a reasonable stop and control my risk that way.
Did you look at at many of the stocks within the oil sector and see that, okay, there's certain oil stocks that are tightly correlated with each other, and that historically they tend to move as a group, and say even some big names? And how often did you encounter and were tempted, even though it's a laggard, but you look back and say historically these stocks move in unison?
What I would do is I would just find the pure plays, right? Because you've got the Exxon Mobils of the world that have a lot going on, right? They're refineries and they're drilling and they're doing all kinds of things. So I would try to find the pure plays, and back then it was like the Permian Basin, and I would just go after those, because those were the ones that would tend to get momentum when crude really moved. And at least back then. And so that's what I would go after. And I would have my handful of stocks that I liked. They were usually the strongest, you could call them momentum oil names. And, there's probably 5 or 6 of them that I would look at. And I would just look for setups on the daily chart and then kind of look for my trigger, with crude oil. And look, at this point, I barely knew what I was doing. So it wasn't like I had mastered this, but this is kind of the first thing I kind of fell into, because I think oil was in play. And so I gravitated to that at that time, because the whole market was following crude oil around, which, doesn't happen anymore.
Were you doing this full time? And how did you do in your early years?
Oh, I was all over the place. I didn't do it full time. This is when I was working at my job in the music industry. So I'd be just checking the quotes during the day. I'd be making trades when I could. And, I couldn't focus enough on it to really, and, I wasn't learning fast enough. I didn't have anyone teaching me. I was reading books and stuff like that, but this was really just to get my feet wet. It was out of interest. I wasn't trying to make a living doing it. I was just trying to solve the puzzle. And that's the only thing I was really interested in at that point.
Early on, when you first started trading by yourself, did you have specific goals or expectations? Like, well, I've heard people can make, 100% per year or 200%, and I'm going to quickly be self-employed. Or what was your viewpoint on taking risks and your expectations?
I had no expectations, and in no way was I trying to do this full time or be employed by it, or quadruple my account. My account was very small. It wasn't like I was sitting on some giant account where I had all kinds of capital in order to leverage. It was tiny. So all I wanted to do was make good trades and kind of feel what that was like. And that's also why I did the paper trading account, because that I could actually trade a multi-million-dollar account and see what that was like. So no, I was just trying to learn. Like I said, it was a passion project. I just wanted to kind of see how good I could get. I didn't care about the money. I wasn't expecting to even make money.
So what does a typical day look like when you go into the office? Kind of what are your setups? What are you looking for?
So do you mean a typical day in terms of my routine or
Yeah, say you start off with the routine and then your process of selecting stocks.
Yeah, so I wake up at 5 a.m. and that's either me going to the gym or straight to the office. When I get into the office, I usually have a number of things that I'm working on outside of, direct trading. And so that could be coding an algorithm that I'm working on, which just takes way more time than I care to admit, or even, I wish it didn't, but it does. And so I'm always working on that. And so sometimes I'll come in the morning and try to knock off a few hours of coding before I start preparing for the day. And otherwise, if it's a really busy market, and we've been in a great market and a very busy one, I'll just start preparing for the day. So what does that mean? It means looking at charts. It means reviewing the stuff from yesterday, seeing what's setting up. During earnings season, I'm looking at all the reports. I'm figuring out what kind of trades we might be inputting into some of our models that are, you could say, half discretionary and half algorithmic, where there's a component that requires us to actually put the algo on a certain name that day. So I'm scanning for these things, and then I'll meet with my trading partner who I develop these algorithms with, and we go over what we're seeing, and we decide, and it's very process oriented. There are rules for everything, and we decide what we're going to put on our algos, right? So which names are we going to apply our algos to? Which algos are we going to turn on? Which ones are we going to turn off? So we go over all of that, and then we meet with our bigger team. And so this is about 7 traders, led by a guy named K-Fitz, who's a fantastic trader. And we all share our ideas. And I've been on this team, since I started. And we all will go through what we're looking at for the day. And that really helps because, of course, now you've got 7 eyes on things. And then I sit for about half an hour and kind of just visualize and get ready for the open. And then we get on a call. Our bigger team gets on a call at the open. We go over anything we're seeing, we call out. And this will last maybe until 11, 12. And then as things calm down in the afternoon, I usually get back to coding. I might get back in with my partner and we might work on some of the models we're working on together. Or, of course, if it's a really busy day, we just stay watching the market all the way into the close. And then when the market closes, I usually get right to reviewing, and I always playbook all the best trades of the day. I've been doing this for a while and I still do it. It's just part of my process. And I just catalog them on a Notion. And that really helps me stay in tune with what's happening and, what are the themes out there, what setups are working. And, to me, those are things that are really important to me. And then if I have any time until I usually leave around 6, I'll do a little bit more coding or some research or something like that, and then I'll get out of there.
So early on, were you just a discretionary trader kind of without the algos? And what drove you to get into algos? Were you not satisfied with your performance as a discretionary trader, or?
No, it was an add-on because I still trade discretionarily, especially during markets like this when the market is very active. I'm still very active in the market. I started fully as a discretionary trader, right? And that's what they teach when you get there. Right. And that's how we're learning to trade. And, as I started to develop, certain things would happen. And, I could tell you a story about a trade I took, and this was sort of ended in a disaster. And this was sort of the turning point for me going systematic and algorithmic. I'd been waiting for an IWM breakout for months, right? It had just a beautiful pattern on the weekly chart, the daily chart, gigantic base, the trade triggered, and on volume, everything looked perfect. I got in calls, I got in stock. I was probably the biggest I'd ever been. I entered perfectly. The thing ran all day and then ran another day. And I'm thinking, this is such a big breakout. My plan, my visualization is that this is going to go for a couple of weeks. Like this can be a really big trade. And that wasn't my mistake to think that. But what happened was the market started to shift. And I mean, this was probably the last breakout before the bear market, right? So of course everything started to fail, but the breadth started deteriorating. All the signs were there. I mean, the IWM started holding below the 5-day moving average as the breadth started to deteriorate, and certain names started to fail, and certain names, started to break out and fail. And it just didn't feel right. Yet I'm thinking, well, gosh, if this thing pulls back to the breakout level, I'm just going to want to buy more. So yeah, I can't get out of here. And of course, this is just a terrible mistake, right? Because you got to have some sort of a process for managing these trades. And I was going purely on feel. And I think it was Thanksgiving, and I went to my now fiance's family's house for Thanksgiving. I wake up the morning after Thanksgiving, and the whole market's gapping down, like, many handles. And I think it was a coronavirus variant news piece, which, I mean, at that point, it's kind of laughable because the coronavirus thing had kind of blown over. But for whatever reason, the market just got destroyed. And I basically turned like a very big win into an outsized loss for no reason, after absolutely seeing all the signs of these things deteriorate. And so after that, I said to myself, I know how to make a good trade, but when I'm making these swing trades, like, I need to have better rules for getting out, right? Because there's many fish in the sea. We're going to make many more of these trades. The best ones keep going. So why am I sitting in this one that's not working? So rather than get emotional about it and attach my bias to the trade, I'd much rather have rules for when A, B, and C happens, I cut half. And when D happens, I cut the full thing, no matter what. I don't care. On to the next one. And that thought just kind of spurred me into this very systematic way of thinking, coming up with rules for everything. And once I came up with rules for everything, then I started to ask myself, well, maybe I can automate this. Like, this seems like something that I could actually have an algo do, since there are so many rules involved. And then that would make it even easier to manage. And it would also allow me to trade multiple names at the same time, especially on the entry when these things trigger. Especially a lot of times these things trigger like right at the open. And so if I'm able to trade many names at the open that meet my criteria, that's more bandwidth than I would be able to have as a human. And so we started to code up these things, and then everything just sort of went from there, just kind of snowballed.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Could you break it down to us? What are the aspects that you look at to help you determine when to go long, when to go short? What do you look at in the markets in general? And what are the trigger points to trigger longs and shorts?
So it totally depends on the setup. And I trade multiple setups. So I can give you an example. I can just go into one. I'll kind of go over the first algo that we developed. And this really came out of the story I just told. And also, before I kind of go into this, I think it makes sense to kind of break down the two different types of trade categories that I think about, especially when we're developing these algorithms. You've got your unicorns and your ponies. That's kind of how I think about it. And your unicorns, like if you put all the trades on like a distribution curve, the tails are the unicorns, right? They're the super rare occurrences that have tons of opportunity, usually in the discretionary space. And this is sort of what we're doing on the desk a lot of the times, is finding these unicorns, because that either means a lot of people are caught off guard because this is a very rare situation, or it means that there's something going on in the market that can't really be tested. It's very hard to back test something that barely ever happens. And it's very hard to create a model for something that barely ever happens because you just don't have a big enough sample size. But because we kind of came from this place of finding unicorns, we started to try to automate some of these unicorns, right? And the other thing is the ponies, which is the middle of the distribution curve. And that's going to be many trades that probably have a smaller edge overall, and you're just trying to grind out edge trade after trade after trade. And of course, that lends itself to creating models and algorithms because you have a very large sample size and you can actually study the data. But when we started, we were used to looking for unicorns. Like that's kind of in our DNA, at least me and the partner that I work with, and a lot of people on the desk. And SMCI has been a great example of a unicorn, of course, right? And it's very, very hard to backtest some special theme that's happening in the market, right? Or some sort of earnings report that has a component in it that's not just a beat and raise and guide, right? It might be an X factor in the earnings report that, given the market environment, means a lot versus like something that might not have meant a lot a couple of years ago. And so our way of sort of getting around that was creating these hybrid strategies where we would have an execution algorithm, execute on our idea, but then there was a discretionary component where the environment and the themes were very important. And so an example of this is an earnings play algorithm that we have. And we run this every day during earnings season. And the discretionary component is looking at the reports and looking at the overall environment and assessing what is working in this environment, right? Is it big double beat and raises and big guides in mega cap stocks that mention AI, right? Or is it all-time high breakouts that beat expectations? Or are things breaking out from the bottoms of ranges? Maybe things that are breaking out to new highs are actually failing, right? So every earnings season is different. And so what we like to do is first try to get a feel for what is the theme right now and what is working in this earnings season. And then we'll scan the reports and see what fits into that bucket. And then we put our algorithms on those. And so typically in the classic setup here, and it's very simple, and I'm not reinventing the wheel in any way, shape, or form, but you have your classic double beat and raise, full year guide up, breakout to 52-week highs in a growth stock, right? And that's sort of the default. Most earnings seasons, those are the trades. And so we'll look for those. And of course, right now, we're gearing it more towards mega caps, towards semiconductors, things like ASML, NVIDIA, SMCI, and, big growth, big liquid growth names that have huge guidance and are obviously involved in AI. Like that's what's happening right now. So that's what we're doing. And so we find it very hard to backtest for that. So we don't make it fully automated. We just make it kind of half automated. Yet it really helps us trade them because we can kind of trade them all at the same time. And they don't make mistakes the way I do.
So you have your system scanning the overall environment, kind of to gauge the temperature of what's going on in the markets, so that when, say, an SMCI announces a beat on earnings, like it did last summer, for example, would it then trigger, because it had certain qualities and the nature of the move, that it would trigger like, bing, now it's in the unicorn category, and here's, take an outsized position? Would that be an example would fit your A type setup?
Yeah, 100%. In fact, we took that trade. What we did was, like, the other component to this was studying, hundreds of these things and how they act on day one, and how do the good ones act, and when they follow through after day one, how do they do that, and how far do they usually run, or how far can they run? What do they look like when they start to fail? And where are the best places to buy and when? And so that sort of informed us as to, okay, when we have a really good one that's acting well, this is how we want to execute. And that's sort of how we built the algorithm. A lot happens in that first 15, 30 minutes on day one, and there's a lot in an A+ setup, and our algo just won't trade it. It just doesn't meet the criteria as soon as the market opens and we're not in.
Why is that? I mean, do you ever second guess your algos and say, well, to us, it's an A+ setup and our algo doesn't like it, but who cares? I'm going to go long anyway.
I mean, we find that most of the time our bias is probably worse than reality. And at the same time, when we say it's an A+ setup before the market opens, that's only half of the information. It's only half of an A+ setup, because the other half of that A+ setup is that it's acting right. And so if it's not acting right, we don't want to get in. And I can't tell you how many times, like, discretionarily, I've got like a big idea and I'm all keyed up for the play, but it doesn't act right, and I'm trying to buy something that's not acting right, and of course I'm losing money doing it. And so the algo assures that it's acting right based on the criteria that we've laid out. And so the algo will either enter the trade, and it'll enter the trade big size, or it'll enter small size, or it'll not enter at all.
I see. What's an example of acting right? What can we see on our charts to show us, like, oh, that stock is acting right?
Well, we want it to be going higher if we're buying it. Okay, we're not interested in buying weakness if it's selling off on day one. That's a different play. Like, there's nothing against doing that. Like, that is an actual thing you can do. But for us, for what we've studied, we don't want to be doing that, because we've found that most of the time, the best ones don't wait. The best ones just go. So it's got to be doing a lot of volume, at least 5 times its average daily volume. And it's got to be trading higher. And then we just have a time component to it. So we have like certain areas that we want to be executing, preferably earlier in the day. And so it's pretty simple, but when you kind of put all this stuff together, it is a lot of information at once to sort of process. And so, again, it's kind of nice because the algo can sort of figure all this out instantaneously and then size accordingly, with the correct stop. And so it's very consistent in that respect.
So getting to quality setups, where say it's an A setup or a B setup, how you would rank a setup, has it varied over the years? Does it vary depending on the type of market you're in or the type of securities you're trading? How does that work? Or is it just standard across all time frames, all markets?
I mean, there's different criteria, obviously, for each setup. What I would say is, if we just continue with this example, is that, of course, our A+ setups change based on the environment. And this is not something that we always did. We had to make mistakes first in order to figure this out, because when we started trading this strategy, it did great. And I think for three or four quarters in a row, it was extremely consistent. And it felt like we could just put the algos on any name we thought was a good idea, and it would just print money. And then we, of course, bumped the risk way up, gradually, and then kind of a big jump. And then, of course, as soon as we did that, the market environment changed. And we learned very quickly that when the market environment changed, that's not true at all. And so rather than being, super systematic, where you're sort of rigid in your systematic approach, where you kind of have one way of doing things and you're just grading things based on that criteria and closing your eyes, we realized we needed to be flexible with our systematic approach and sort of build that into the system. And so what I mean by that is, if our classic setup is a double beat and raise in a growth stock that breaks to 52-week highs, if the quarter is telling us something else is actually an A+ setup, we need to adjust the criteria to that. And so then that becomes, the new A+ setup. We also have environment checks in the model where the environment will get upgraded or downgraded based on, are these things failing or are these things following through? And then that will actually reduce the risk significantly in unfavorable environments.
Do you program dynamic changes into the code so the algo can modify, say, strategies on the fly? Or
so the way we think about it is, like, we would rather have, like, for every sort of iteration of a strategy or for every strategy, we would rather have a separate model for it, a separate algo, rather than trying to put too much into one, because things can get very complicated very quickly, and it also becomes more difficult to assess the progress of a model when you're kind of putting many different iterations into one. So we would rather split them out. What we call it like having babies. Like, we'll come up with a model and then we'll have like different iterations of it, and then the model will kind of have babies, and then we'll put those out, and then we'll sort of monitor, how each iteration is actually doing. And it's a lot easier to sort of keep track and figure out like what we need to be increasing the risk on and decreasing the risk on.
You mentioned the word "we" several times. Are you and many other traders kind of working together on this algo system, and that you trade the same names, you go long kind of at the same time and short at the same time? Or
I have a team that works on these. We work on them together and we trade them on a joint account. I couldn't do all this alone, for two reasons. I think maybe my biggest strength is probably making friends with people who are much smarter than me. I've been really lucky at the firm to kind of, be really good friends with like the head of the coding department, and he taught me everything that I know about Python. I mean, I did take some trade school classes on coding and stuff before, and I was always interested in it, but couldn't really do what I needed to do until I got to S&P. And so I've learned a lot from him, and then I work with another guy, and we kind of work together. And I mean, with the quant stuff, it's very, very time consuming. And honestly, I don't know how I could take on the load just by myself. I mean, I know people do it. Some people do that really great, and maybe I'll get to that point. But right now, I mean, I love working with other people. I've always been sort of a collaborator at heart, just playing team sports and stuff like that. And, it's sort of an assembly line approach, because when you're building these things, it's not just about coding of it. And it's not even really just about the research to kind of figure out the idea. It's also the, analyzing the data, the cleaning of the data, making sure that your data frames are right when you're looking at the data in order to improve the model. And so there are all these steps that take a lot of time. And that's probably the biggest drag with this approach, because the results are very great, but it takes a long time, at least at this point, to go through all those steps. And so I think our biggest improvement probably over the last year has been, getting much faster, exponentially faster at this stuff.
So you mentioned it takes a lot of time for, say, for example, a trader who's really experienced and has their system, their process down and everything's down really well. Would they save quite a bit of time in the sense that they know what to program in? They don't maybe they don't need to do extensive back testing. They just program these algos to save them time. Or is it the nature of the beast that no matter how much experience you have, it's, as I've heard some algo traders say, programming algos can be a bottomless pit of time. Have you found that to be the case?
It can be if you're barking up the wrong tree, for sure. And so I think part of the trick is knowing when to stop and when to move on to something else. And I was talking to a quant the other day who's outside the firm, and he was talking about how he finds it difficult to find a computer programmer that truly understands the market really well, or a really great trader that can computer program, because both of those skills are they both take a long time to develop, right? And so to have both is a lot. And so I think that the people on our team had the trading part first, and then we kind of attacked the quant side just from a coding standpoint in the beginning. And like our approach was to just be really simple about it, right? Because we're not Jim Simons, like from Renaissance, as much as we wish we were, right? And we're not data scientists either. And so we're not going to be data mining and kind of leading with the data and like starting with that and trying to come up with strategies based on the data. We're going to actually draw from our experience. And when we see something that works in the market, we're going to look to try to automate that. And we're going to kind of work that way. And then once we have the strategy, we're able to pull all the data and try to see which features actually might improve the model, which features might have nothing to do with the performance, and fine tune it that way. But we always start with an idea, at least at this point.
Have you looked at any of the off-the-shelf commercial algo systems? Is it really necessary for everyone who wants to get into algo trading to have to program their own?
Yeah, I don't know. I actually haven't looked at those. I don't know how good they are. I do know that it is very hard to come by great data. That's one of the key things with this. And, a lot of times, I mean, depending on how often you're trading, like execution matters, right? So if you have a backtesting system that's not giving you the correct fills that you would realistically get in the market, like that can make a huge difference in the performance. So you might come up with something backtested, think it's really good, and then trade it live and realize, I'm not even getting filled. So that stuff does matter. I only have experience with what we have at the firm, which is extremely customizable. It's very raw, so you kind of have to build everything from scratch up on Python. There's no plugins or anything like that, but it's very customizable, so you can do pretty much anything that you want to do.
So once you have your algos running, how much time do you have to put into managing them, and how often do you turn them off, if ever?
So we tend to manage them quite often because, like I said, the environment really matters for these things. We are currently working on some things that we hope we don't have to manage that much, because I know that's kind of the dream, right? To just set it and forget it and not have to manage it. I think that when we're making algorithms that are finding these unicorns, there's a lot more managing because you're dealing with the tails, right? So most trades are not these. So you can't just kind of go fishing everywhere and just come up with tons of junk trying to find like one of these really great trades. And so environment really matters. I think if you have something that's trading ponies and just kind of pulling edge out of the market, like grinding it out, and there's just sort of like an inefficiency or some mathematical edge, I think it's a lot easier to let that ride and just kind of deal with the strings of losses, because you just have such a bigger sample size and a lot more trades, and you can kind of just let it play out. And it's basically a numbers game.
I hear that some quants say that not all strategies are automatable. Have you found, like, for example, support and resistance lines? Have you found any hindrance to automating any particular strategy, or in your view, are they all automatable?
Oh yeah, absolutely. I mean, I found so much hindrance. Like, I mean, and of course, it just might be me not doing it right. Like, that could be part of it. Like, I don't know, maybe someone else figured out how to automate it. So it doesn't mean that it's impossible, but yeah, that's absolutely our experience, because we come from this discretionary side that's looking at these very unique situations in the market. And like I said, that's in our DNA. Like, those are the trades we see with our eyes. Those are the things that we're still trading discretionarily. And a lot of this stuff is just impossible to backtest. And so, I've never tried support and resistance strategies or anything like that, but we've tried tons of things that we know is a good setup. Like, we know we have edge in trading it, yet we try to automate it and we just can't seem to filter out the junk.
What junk? Like, can you dive deeper into that?
Yeah. So you might have a volume breakout strategy in a small cap, and there's a very specific pattern that triggers this trade, and it's very rare, and it's a very powerful trade. And discretionarily that this is a trade with a lot of edge, but because there are so few of them, you don't want to miss it when it's there, because you'd have to be sort of manually scanning for these things all the time. And if you miss one, there might not be another one for another month or two. And so you want to automate it, and you put in all the criteria that you think has a correlation to the performance in the trade. And then you find that it's taking 900 trades in stocks that have nothing to do with this setup, and it's performing terribly. And you try to define the setup, and it's almost like no matter what you do, you can't get rid of a lot of bad trades. Mm-hmm. We've gone through this a number of times, and I think that it has to do with trying to automate that unicorn, because these are such rare, special occurrences. And it's very hard to study a model that over a 3-year backtest has 5 trades, because it's not enough data to understand if the performance is random or not.
So does the algo completely miss the unicorn when it's happening, or does it catch it but underweight the position size in it?
It catches the unicorn, but it also catches a million other terrible trades. So that do not, that overshadow the greatness of that one trade that you're trying to catch.
I see. So when it catches a lot of junk trades, at the moment that it puts on the trade and you look at the chart, do you disagree with the algo, or do you agree with it and say, yeah, actually it looks pretty good, or no, clearly this is a junk trade? And if so, if it is a junk trade, are you tempted to simply override the algo and say, no, I'm going to get out of that position?
So, I mean, what we would do is probably just not put this strategy live. So we wouldn't even be getting to the point of overriding the algo, because we wouldn't feel comfortable having this live. But when we look at the back test, yeah, we're seeing a lot of trades where we're like, that's not the trade. That doesn't look right. That doesn't feel right. How can we filter out this even more? Right. And you just kind of go down this path where you're studying, you're taking a data frame of all the features you're putting into it, right? That might be volume components, it might be technical analysis components, it might be sentiment stuff, it could be anything. And you're looking at this data frame of all your values for every single trade, and then you're just spitting out, scatter plots and charts of these things to see what feature might correlate to the performance. And if it doesn't correlate really clearly, right, like you can see it with your eyes, then it probably doesn't matter at all. And so if you're trying to make really small changes that kind of make it better, usually we've found that's that's probably overfitting, and you're probably just fitting into noise. But when you find something that you can see with your eyes on the scatter plot, like, okay, the higher this value gets, the better the performance of this trade. Like then we know we have something.
Well, speaking of curve fitting, what are the best ways to avoid curve fitting? Is simpler better?
Yeah, I think so. It's at least safer. It's more comfortable. I don't want to say that with all the confidence in the world, because I do know that, we're certainly not doing like everything that someone could be doing. And I'm sure there are quants out there doing very complex things that are fantastic. And so I don't know if simpler is better, but I do know that, like, if you don't have a very good data analysis background, right? If you don't have like a PhD in math and statistics, it's very easy to go down the wrong path if you kind of just start with the data with no clue as to what you're trying to do. And given the fact that we are traders, I think our best way so far has been to always start with an idea that makes a lot of sense to us. Is this a trade I would be taking? Right. And if it is, then, okay, now we can dig deeper. Now we can look at all the things that actually make this play tick, right? Like, is it the volume? Does volume matter? Maybe it doesn't. But if it does, we probably want to input that into the model. So we just take ideas that make sense to us, and then we just get much deeper into it, almost the way we would anyway if we were just creating a playbook for a discretionary trade. But now we're obviously automating it.
Have you used ChatGPT or other AI in helping you with this process?
Yeah, we use it every day. I mean, it's fantastic. Whether it's coding, a little bit of coding help here and there. You run into an issue, there's a bug, and you want to kind of run it by ChatGPT to see where we could fix the bug, or and it might be a variable that we're looking at, right? And we're trying to measure, say, liquidity, and we have a couple ideas on how we might want to measure liquidity. Sometimes I'll just input that idea into ChatGPT and just see, okay, is there a better way we can do this? Like, what if I combine these two things? Does this formula make sense? So sometimes I'll sit on my couch at night and just talk to ChatGPT about, math stuff for like an hour. It's like the dorkiest thing ever, but I love it.
Well, some say that algos lose their effectiveness over time. Have you found this to be true?
So we haven't found that yet. Maybe we will. And from my understanding, I do think that it is strategy specific. I think that there are some strategies that do lose their effect over time, and they're very market specific. And then I do believe that there are some strategies that are, as old as the market is. And it just depends, and I think from what I've read, even from Jim Simons, like, he says the same thing, right? Like, I forget if it was like 30 or 20% of their strategies sustained over time, and maybe 70 or 80%. I might be getting these numbers wrong, but something like that, 70 or 80% degraded over time, and they would have to either rebuild it or just can it.
Huh.
So
why is that? Is it more people are discovering these strategies, and then so more people use them, the less effective they become? Or what do you think the cause is?
Yeah, I don't know why it is. That makes a lot of sense to me if that's the reason. Of course, nobody really knows, but that would make sense. I think sometimes when you're developing a strategy, you're developing it for the market you're in. And you might even know that this is not going to last. You're just saying, okay, you know what? Like, this is working right now. We need to do this until it stops working. And so you're not even really caught off guard. If it stops working, you just know this is for this market. And this is something that is happening, and maybe it won't be in a year. And then there are other strategies like our earnings play that, you can read about people doing this in the 1920s. And it's the same setup. There's like not really any different. Maybe the way the market acts now is different. because of options and because of all this, different mechanics in the market. So in terms of studying those day ones and studying like how the algo might execute, like maybe that stuff changes over time. But, the classic big inflection, fundamental inflection, like double beat and raise, earnings surprise is not a new thing. That's been going on forever. So.
Do you use options in any of your trades?
Yeah, I trade options a lot on the discretionary side. Most of my trading is options, actually.
From a long or a short side mainly, or kind of are you depending on the situation?
Yeah, it depends on the situation. Could be buying calls, could be buying puts. It could be spreads. It could be a butterfly or an iron condor, but most of what I'm doing is buying calls in this market, at least.
In this market, because of the nature of the market that we're in, a steady, nice upward trend.
When there's a lot of momentum, that's when, because to really make money buying calls, like things have to really be moving and they have to be, exceeding their implied moves and stuff like that. So when you have a momentum market where breakouts are working and things are running, then it can be a good environment for options like that. But in a quiet market where things are kind of sloshing around or even moving slowly, that's not going to work as well. And so I would rather be buying stock in that case, or doing some other things.
What indicators do you look at to help you determine kind of what kind of market are we in for that day or for that week? Are there statistics, any off-the-shelf indicators that we can look at?
Yeah, I mean, for me, this is just pure feel, but it is very specific, and I can explain it, and it's super simple. It's kind of like, okay, what's leading the market? Are the leaders leading, right? So right now that's NVIDIA, SMCI, the semis. And our breakouts working. So if the leaders are leading and breakouts are working, like to me, that's a momentum market. If breakouts start to fail, like if stocks start to get above big levels and then don't run and then fail, to me, like that's a change in character. Or if the leaders stop leading, that's a change in character. And so like right now we're seeing a big inflection in all this AI stuff, and we've been seeing it for a bit now. And of course, in every bull market, there's pullbacks, and that's just a feature of the market, and there are corrections along the way. But, we're seeing a lot of momentum in these semi names. And so as long as that continues, I consider us in a momentum market. And, we see that kind of carry over into Bitcoin names and things like this. And so as long as I'm seeing that, then I'm seeing it. And then I just have to be really quick and honest with myself if we start to see things fail. And, one of the things our team leader was saying today, like, he's always been talking about out of a bear market like we had, there's going to be new leadership, and like keep an eye out for new leadership. And this is holding to be true, as we speak, as we watch this market, because we're seeing things like ASML, SMCI, and the stuff I've been talking about breaking out and kind of taking the reins from, if you look at like the Google and the Apple and the Tesla charts, they're not leading anymore, which is really interesting to me, because it's very easy to kind of get stuck on Apple and Tesla after a bunch of years of them just being like the strongest stocks in the market. And so I pay attention to leadership and breadth and things like that.
I noticed a retweet on your Twitter that this quote that says, "All pain in life is an indicator. It is a catalyst for change." So I'm curious, how do we position size our trades such that when losses occur, we experience enough pain is created to induce the change, but not devastate our portfolio?
Yeah, such a great question. And I actually read something, I think it was last night, from Linda Ratchke, who I know has been on the show, and she's one of my favorite traders of all time. I just love everything she has to say. And I think she said something like, don't trade too big that, you're going to trade it wrong. I'm going to mess this quote up, so don't quote me on this, but this is the idea. Don't trade too big that you're going to trade it wrong, but don't trade too small that you're going to be careless, right? Because I've been in both situations and it's not fun, right? You're too small, so you're like, oh, I can just let this thing ride, right? And then you're just ruining your edge. Like, no matter what size you have in the trade, it's like not the right thing to do. Or, you're so big that you're hitting out like before your stop, and then, you're getting back in and all that kind of stuff. And so that's one of the biggest challenges as traders, in my opinion. And, for me personally, like, we're all trying to grow. Like, no matter what level we're at, we're all trying to get bigger, more consistent, and get to that next level that we kind of see ahead of us. And in order to do that, we have to trade bigger. And so one of the things that I've learned from, Mike Bellafiore and Dr. Steenbarger and, all these great mentors that I have in my, K-Fits as well, is that, when it's time to push it and grow, you really want to do that on your A+ setups. So you really want to wait for those moments where you can control your risk. The risk reward is there. The probabilities are there. Like, this is worth it. Now's the time to get to that next level. It's not every single day, let me just triple my size on every little thought I have, right? Because that's not going to turn out great. So that's one of the things that that I try to focus on every single day, because it's not easy. Because you get, at least I do, some traders are great at this. Sometimes you get set in a routine and you're just used to a certain size. And so it's not even that you don't want to be bigger. It's just reflex, right? You're kind of like, one of the things that I learned from playing music is that, we're learning systems, right? Scales and music theory and all this stuff, but we have to learn it so well as to make it sort of part of who we are. We have to like ingrain it into us so that we're not thinking when we're actually executing. Because like when you're playing music, like you can't let the thinking get in the way of like hearing the band. You have to be listening to the other musicians. You can't really be thinking about what you're doing because it's happening too fast. And trading is very similar, where everything is happening very fast and you have to be listening to the market. And so if you're thinking too much about what you're going to do and all the different steps, it can really take you out of reading the tape or understanding what the market is telling you, at least for me. And so to me, that's the biggest challenge. And so when we're trying to size up, sometimes that can take you out of that sort of flow state. So this is why your question is so good, is because it really gets to one of the biggest challenges of trading, in my opinion.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
Well, then, if one were to go fully automated, where all their trades were done by the algo, wouldn't that raise the risk of that person becoming more disconnected to the market and losing their feeling and connection with the market? Couldn't that be a detriment because they're not in the now? They now have this automated system doing everything for them.
Yeah, I think there are advantages and disadvantages to both. And when you're discretionary trading, you're getting, like you said, you're getting a great feel for how the tape is acting and what's going on in the market. And you can really keep track of that every day. When you're algorithmic trading, you can trade 100 things at the same time. And you can execute with precision on all of those and execute really fast. And you can size them perfectly to the risk that you want to take against the correct stop. And the consistency will be there. So I think that both of them have their pros and cons. What we've chosen to do is both, because we did start as discretionary traders, and I would feel kind of odd not following the market and just letting our algos trade. As much as like I think, probably the best quants in the world would tell you, don't mess with your models. It doesn't matter. It's just math. And they're probably right. But I might just be too much of a discretionary trader to fully prescribe to that.
Well, so to wrap things up, what do you struggle with most as a trader?
Oh, I mean, it's definitely what you brought up earlier, which is just growing. It's taking what you do and what you do well and the edge that you have in the market and having the patience to apply that at the next level when the moment arises to do so, right? Like it's so easy to have a big trade, right? You might have a record trade and then you're like, all right, I'm at the next level. I'm just going to trade everything bigger, right? And then you go and you're a little careless, you give a bunch back because you're taking, C setups with bigger size and you're just like too amped up, right? That's one thing. Or, you're like, okay, I've been really consistent. I've got edge in this setup. I need to trade bigger. And that setup comes around and you're so ingrained in how you do things, which is not always a bad thing, right? We want to be automatic, but you're so ingrained in how you do it that you don't get bigger and that you just trade it the same size, right? And so to be consistent is one thing, but to be consistently growing is another thing. And I just know that, I'm not the only one. That's, for all the traders that I know, it's something that the traders around me are constantly focused on, right? Because that's the goal. Everyone's trying to grow. And so that's always the challenge, right? In the beginning, it's not that because you're just trying to find edge. But once you find edge, it just becomes about that, really. And as Lance, who's, I think he's been on your show too. Lance always says, hey, you could have done the same thing there. Like that was a great trade. You can do that 10x. Like he's like, it's not that you should, because you have to grow slowly, but just as a mental exercise, like, hey, you could have done the same exact thing with, 10 more, 10 times the size you had, and you could have made 10 times more. So just think about that for a second.
Mm-hmm.
So, yeah.
Well, great. Thanks, Garrett. Thanks for coming on Chat with Traders.
Thank you for having me. Appreciate it.
Great. How can our listeners reach you?
So I'm on Twitter at Garrett Drinan. Feel free to message me. I'm always tweeting my indicators, different things like that on the market and some of the codes that I'm writing. And then, that's actually the best way to do that. That's probably the best way to do it.
Fantastic.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Hey, welcome to Chat with Traders, episode 278. And we are so glad that you joined us today. I'm Tessa Dow, and I co-host this show with Ian Cox. Ian's the one with all the great questions and extracts those awesome insights from our guests, and I make sure that you get to hear it. So how are you? I hope you're doing well. I hope you're better than surviving and more like thriving, or at least on your way to thriving in every aspect of your life. Well, speaking of thriving, do you get stuck in brain fog, slow thinking, or having low energy when you're trading? Okay, I admit I have found myself in that situation often, and I'm always searching for ideas that could help with that, especially now that I am trying to up my game in my own trading journey. You know, when we talk about health, we often focus on the physical side of things, but what about mental performance? To put it simply, if our mental sharpness and power suck, it will chip away at our ability to trade well. If you think about it, trading successfully is not just about having a high probability setup or a well-defined strategy or system as an edge. Mental health and performance are equally important, if not more. It could be the edge that some of us have been trying to look for. So, are there ideas and ways that we can boost our brain power? Well, let's find out, because we have a very special guest today. His name is Ben Greenfield, a renowned health and fitness expert, biohacker, health optimizer, author, and 13-time Ironman triathlete, and more. You have probably seen or heard Ben on Joe Rogan, Impact Theory, Jay Shetty, Mind Valley, just to name a few. And we are so excited to have him on Chat with Traders today. Please note, the topics today, including thoughts and ideas shared in this episode of the podcast, are for informational and educational purposes only and do not replace professional medical advice. Ask your doctor's advice for specific health concerns and questions. Okay, without further ado, ladies and gentlemen, please welcome Ben Greenfield from Spokane, Washington.
Hello, Ben.
How's it going?
Good. Great to have you get a chance to get you on the show. I've been a longtime listener of your podcast for many years and really enjoyed the benefits of all your information and wisdom and what have you. So
that's awesome. I'm glad we could make this work, and thanks for the flexibility on time.
How did you get into the health and fitness field, Ben?
You know, I wish that I had a sexy wounded healer story for you, Ian, but gosh, I mean, I would say that I've been immersed in all things related to the human blueprint for my entire life. But really, I would say since about the age of 14, I have been a voracious student of the human body and brain. I just fell so in love with anatomy and physiology and biochemistry and microbiology and physics and movement and fitness and nutrition that I wound up getting a master's degree in exercise physiology and nutrition. I actually studied for the MCATs and took the pre-meds. I got accepted to 6 different medical schools and wound up deciding to take a year off to go work in hip and knee surgical sales. And that process absolutely just kind of disillusioned me with the idea of going into modern medicine. All the doctors told me I'd be nuts to be a doctor, and they all had boats and cars and big homes and seemed to have no time to enjoy any of those things. And I spent a lot of time with a laser pointer showing surgeons how to put $30,000 hip implants into obese individuals who probably would have been better served with preventive medicine and weight loss. And the whole scenario just basically left such a distaste for me for at least modern allopathic medicine and the way I was experiencing it, that I decided I could do a lot more doing what I loved, which was fitness and physiology and nutrition. So I remember one day I actually walked across the street to the gym and I slapped my resume down the front desk. And at that point, I was a strength conditioning coach and a personal trainer and a nutritionist. I'd worked training people all through college. So I had a pretty good resume, and they actually brought me on as manager of this gym called the Liberty Lake Athletic Club in Liberty Lake, Washington. From there, I managed their program and developed triathlon training programs and group personal training programs and cooking demos and nutrition and meal planning. Kind of made the training program there pretty successful. And then I connected with a physician who was the husband of a client of mine, and he convinced me to partner up with him. He was the head physician for Ironman Triathlon and Rock and Roll Marathon. His name was Dr. PZ Pierce. And PZ and I launched this giant kind of like warehouse that was a one-stop shop for sports medicine, exercise physiology and biomechanics and performance coaching and chiropractic docs and massage therapists, physical therapists, sports medicine docs. And I was the director of human performance there. And so that meant that I used interesting technologies that would probably be considered kind of biohacking before biohacking became, a more popular word. So blood injections with platelet-rich plasma and high-speed video camera analyses and what's called indirect calorimetry, which is like a breath-based analysis of how much carbohydrate, fat, and calories that you're burning, like your metabolic rate. And basically ran that facility and opened up kind of a sister facility over on the Idaho side in Coeur d'Alene, Idaho. And in 2008, I was nominated as America's top personal trainer. And that kind of thrust me into the limelight of speaking and traveling and doing a lot more online consulting and coaching. That's kind of how I got to where I am now, walking on my office treadmill and talking to you, Ian.
Great. Thanks for sharing that. So today, let's dive into ways to improve mental performance. Trading in the financial markets require a sharp mind. So our listeners are looking for ways to get an edge in mental performance. Starting off with probably one of the more common ways that people are familiar with is coffee and caffeine. Can you tell us a little bit about coffee and caffeine on as a mental pick-me-up?
Well, I'll give you a fun fact. You know the French philosopher Voltaire? You ever heard of him?
Yes.
He purportedly drank up to 60 cups of coffee a day, and seemed to function pretty well mentally. Like coffee was discovered when, as the story goes, this guy's goats, some farmers' goats, were chewing on coffee berry plants, and he noticed they had very robust amounts of energy as they would bound up and down the hills. And later, of course, they isolated caffeine and discovered all these other molecules in coffee, like feel-good paraxanthine and caffeic acids and all these things that actually make coffee almost like a mix between like a highly stimulating agent combined with a little bit of a psychotropic effect. Fact is, anybody who's drinking coffee and quits for about 2 weeks, your cell receptors actually become desaturated with the caffeine and they become reaccustomed to operating without caffeine. Then once you start drinking coffee again, you actually realize, holy cow, I'd forgotten how much of a mental boost this stuff actually bestows. So, coffee's also been studied for its effects on staving off Alzheimer's and dementia, cardiovascular disease. It's good for the liver and glutathione production. It has a host of metabolic benefits that, if we're just talking about coffee, right, not orange mocha frappuccinos and half a cup of coffee with another half a cup of half and half, and a few teaspoons of sugar in it. Coffee on its own is stellar as a mental enhancing agent. There are subtle nuances, right? I think a lot of people are probably aware now of some of the issues with many beans having mold or mycotoxin or from non-organic sources or unsustainable farms. And so I'm a little bit picky about making sure that I'm choosing organic, supporting the farmer, and preparing my coffee in such a way that I'm not, pulling up to the drive-through window and just getting a cup full of chemicals. But ultimately, I would definitely say that coffee ranks up there as a good it's called a nootropic agent. Yeah, that means mind director. And coffee's kind of like one of the first nootropic agents. That being said, there's a lot of others out there if we're talking about enhancing the brain from a chemical standpoint. But I give thumbs up on coffee, but I personally try to cut out coffee for about a week out of every month, where I'll switch to tea or decaf coffee or something like that, because you have these receptors in your nervous system that coffee binds to, or the caffeine, more specifically in coffee, binds to. And there's another molecule in your body that also binds to those same receptors. And that molecule is adenosine. And adenosine is what increases what's called sleep drive, meaning your ability to feel sleepy as the day progresses. So the problem is that if the caffeine is constantly throughout your whole life bound to those receptors, your body has to make more and more receptors, and it also has to make more and more adenosine to actually feel sleepy. And so you wind up desensitizing yourself to caffeine while at the same time really limiting your ability to build a healthy sleep drive. But what studies have shown is that in most people, within 6 to 10 days of a washout of caffeine, of not drinking coffee, you get a restoration of the normal number of receptors, and you become resensitized to adenosine. So it's really interesting how coffee is something that you could cycle. It's very simple. Like, let's say, you've got a lot of people's work days are occurring in press pulse cycles, right? There's those 4 to 6 weeks where you're working really hard, and then you're going to have a week of easy work, or you don't have a product you're launching or whatever. And I like to choose those less busy weeks to try to not be on caffeine and coffee, just so I reset those receptors, and your sleep will thank you if you do that.
Great. That's good advice. What about, is there an optimum amount of coffee that people can take to get that enhanced performance without having significant side effects, or is it highly individual?
We established that already at 60 cups. If you want to be a famous French philosopher, 60 cups. I don't know how big the cups were, by the way. You hear that a glass of wine is good for you, and then you see, the average American having a fishbowl-sized glass of wine with dinner, and I think in the studies it's actually something like a paltry 4 ounces, which for most people is just a taste. With coffee, a lot of the studies show that you derive quite a bit of the benefits in the range of anywhere from 1 to 4 cups. However, as you noted, it can be very genetically determined. What I mean by that is that some people oxidize caffeine really quickly, and some people don't oxidize caffeine as quickly. If you are a slow caffeine oxidizer, 1 cup of coffee could actually leave you kind of jittery and feeling as though you're excessively stimulated, give you the runs, like there's all sorts of stuff it could do. And then if you're a fast caffeine oxidizer, you're that person who can have a shot of espresso after dinner and be sleeping like a baby a couple of hours later. So you can test that. In the realm of DNA testing, there's a lot of companies that do it. A few of the better ones would be like the DNA company. They have a pretty good genetic test. 23andMe, I think, even though they had some FDA restriction in terms of the health data they could release, I think they still do that coffee oxidizing one. Another really good company is Self-Decode. And when I use terms like Self-Decode or the DNA company, what that means is that you typically take a very small amount of saliva and you send it off to these companies, and they analyze your genes for all sorts of stuff, really useful stuff. Like, are you histamine insensitive? And therefore you need to take a histamine blocker when you have, say, canned fish or wine? Or do you do a poor job detoxifying and you need to take some glutathione before you go to bed at night so your body does a better job removing toxins while you sleep? Or do you have poor nitric oxide pathways, and so you need to eat a lot of foods that will help you generate more nitric oxide, like arugula or pumpkin seeds or extra virgin olive oil or something like that? So I actually think that DNA testing can give you a lot of insight as to how to eat, how to supplement, how you're wired up, and of course, the most important thing, how many freaking cups of coffee you can drink before your head explodes.
Yeah, great. So let's move on to pharmaceuticals. I was enamored with the movie Limitless because it showed the main character taking this experimental drug, and one of the many things he became an expert at was trading in the financial markets. Do you know of any over-the-counter or prescription meds that can yield some of the mental improvement benefits that we might have seen in that film?
We could get Bradley Cooper on the phone and find out. There are definitely some limitless pills out there, or some things that come pretty close to the limitless pill. Now, honestly, man, I'm feeling a little bit guilty bringing this up right now, because it's kind of like when a guy asks me, hey, should I get on testosterone? Well, I usually tell him, hey, no, like, first, make sure you're getting enough fat soluble vitamins, like vitamin D, for example, and make sure you're getting enough magnesium, and make sure that you're eating enough protein, and that you're lifting heavy weights with your legs, where a lot of the what are called the androgen receptors for testosterone are, and make sure you're getting good sleep and low stress. And there's all sorts of things that you should do before you pull out the big guns, right, of some kind of testosterone replacement therapy. And I would say that we could probably say the same for mental function, right? For example, we all have a blood-brain barrier. I don't know if you've heard, Ian, before of the gut barrier. Like, a lot of people say they have leaky gut, which is very common, especially in people who eat in a stressed out state, or eat foods they might be sensitive or allergic to, or have a lot of like raw vegetables and raw seeds and nuts that can kind of create some inflammation in the digestive tract. And those people often benefit from eating fewer of the foods that aggravate the gut, and then healing up the gut lining with really nourishing foods like bone broth. Colostrum is another example. Glutamine is another example. In functional medicine, there are certain foods that are used to restore the lining of the gut. Well, you also have a blood-brain barrier. And if you have a permeable, or to use the highly scientific term, leaky blood-brain barrier, what that means is that toxins and chemicals that should otherwise not be in neural tissue wind up in your brain and contribute to things like brain fog, poor memory, word recall, lack of cognitive function, etc. So typically the type of things that would cause a leaky blood-brain barrier would be poor sleep, high amounts of stress, high amounts of alcohol, low intake of electrolytes and minerals. And I don't just mean table salt, which is just, table salt's crap. It's just sodium chloride, but like really good minerals and electrolytes, like, sea salt and many of these electrolyte blends that you put into water that are out there now. And so you want to take care of your brain. And that can even come down to choices such as the way that you set up your environment, right? We know from a recent study last year that indoor air pollution limits cognitive performance, meaning you could really be well served by getting a portable HEPA air filtration unit for your office or for your bedroom or for multiple areas of the house. We know that bright overhead LED fluorescent light can cause a low-level flicker on the retina that causes brain fog as the day progresses. And so you can switch out the lights in your light cans for halogen, or even though it's increasingly hard to find, incandescent, or what's called biological LED rather than regular LED. We know that Wi-Fi signals and just high exposure overall to what's called dirty electricity or a high EMF environment can cause sluggish neural function in a lot of people. So you could, hardwire via Ethernet cable to the router, or you could not have your phone's Wi-Fi on if it doesn't need to be on, or you could even have, and this is something I've done, what's called a building biologist visit your home or visit your office and go through it with some different meters where they measure magnetic radiation and electrical surges and dirty electricity. And then you get all these little things that you can put in your office or switch around to fix that, like a dirty electricity filter, or, moving your office chair to a different area where you're getting exposed to less electricity. And so there are variables like that, like sleep, stress, air, light, electricity, and even the health of the blood-brain barrier that you want to take into consideration before you just pull out the big Band-Aid of the limitless pill. So I just want to get that out of the way. You want to do the natural things to care for your brain before you turn to some of these other, arguably more sexy items,
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Right. Boy, that's quite a list that you shared with us. So transitioning to diet. What
we didn't even get a chance to talk about what the limitless pill is. I'm sure people are wondering, right?
Well, yeah, that's where you can go watch the movie and find out. It's a great movie.
Well, I can tell you that back to that word I used, nootropics. Mm-hmm. That's kind of like the key term when we're talking about things that would function beyond a cup of coffee, like the limitless pill. I'll give you a few examples of kind of like done for you formulas that would not be considered pharmaceuticals that you would need a prescription for, like say Adderall, but that you can buy over the counter. There's one company called Nootopia. You go to their website, you fill out a questionnaire that reveals what your unique neurotransmitter type is. And then you get this big black box that arrives to your house with different pills in it, like a pill for memory, or a pill for wakefulness, or a pill for higher levels of dopamine, which means you have a higher level of reward when you accomplish tasks, or a pill for sleep deprivation, or cleaning up the brain after a long day. And so that's one good company. There's another company called Neurohacker, and they have kind of a shotgun formula. It's like food for your brain. It's got 30 plus different ingredients in it that act in synergy to support the brain, kind of like the limitless pill. That one's called Qualia with a Q, Qualia, and their product is called Mind. Another example would be there's a relatively new player on the market that will give you about 14 to 16 hours of what I would consider to be pretty pure, clean focus that's similar to what you'd expect from a limitless pill without keeping you up for days on end. That company is called Wukio, Wukio. They also make a pretty good product. And the reason I'm giving you specific brands is because part of my job is, I'm constantly answering questions, digging into formulations, digging into products, seeing what works, what doesn't, what gives you explosive diarrhea, what doesn't. And so these are a few of the ones that actually work. One that Joe Rogan has made popular, Onnit's Alpha Brain. That's actually a pretty good formula as well. It's not quite as powerful or as heavy a hitter as some of these others I've brought up, but it actually is a very well formulated product for people who want to see what a nootropic feels like. And I would say the only other thing to think about that I didn't bring up with a few of those examples would be, just to fill in the gaps here, I did mention that people who are slow caffeine oxidizers knocks off the edge. It doesn't get it out of your system. It just causes it to kind of feel as though it's being more slowly released. And that can help out quite a bit if you find yourself jittery after using these type of things. And then the last thing I should mention, because a lot of people talk about it now, is nicotine. And that's kind of the classic smoke a cigarette, drink a cup of coffee, write a book in Paris type of scenario. And it actually is true. Nicotine, despite the bad rap that cigarettes, rightly so, get, nicotine itself is actually a pretty potent mental aid. And you can now get nicotine gum, lozenges, pouches. It tends to be a little bit more addictive, but nicotine combined with caffeine can also be a decent mental hack. One example of a way to do that and do it clean would be nicotine toothpicks. You can get, for example, stevia flavored nicotine toothpicks. Another example would be a patch, like anywhere from a 1 to a 10 milligram nicotine patch that you can wear, so you aren't messing with having to smoke a cigarette or maybe chew a piece of gum that has a bunch of artificial sweeteners in it or something like that. But nicotine isn't bad either. And then finally, though everything I just mentioned, those would be considered nootropics. There are also drugs. There are also pharmaceutical agents. I'm often asked about one called modafinil. It also goes by the name Provigil. And I actually think that was the inspiration for the movie Limitless. Now, modafinil floods your receptors with tons of dopamine. It makes checklisting, getting things done, staying up for long periods of time feel really good. It's actually an off-label anti-narcoleptic agent, meaning people who fall asleep in the middle of the day because they have narcolepsy, they'll get on modafinil and just be fine, not have to struggle with that. But in a regular person, or at least a person who doesn't have narcolepsy, modafinil is kind of close to the limitless pill. The problem with it is it can keep you up for days on end. It kind of turns you into almost like a robot without a personality who just wanders around getting things done at an extremely rapid pace. And when you stop using it, it takes a little while to like come down, start to sleep normally, etc. I have some modafinil in my pantry, and it might be something I'd use if I were to have to say, like, take an overnight over to Japan, and I got to get on stage and speak after the flight, and I've gotten 2 hours of sleep, and I know I'm going to be at the conference all day, in meetings, shaking hands, in talks, and then at the after party. And I'm just like, okay, I got to be up for 18 hours. Let's do this. But there's a definite biological cost to modafinil, but that's one that for those really hefty workloads is probably the biggest guns that you can get your hands on.
So when taking nootropics, is there a recommended reset time, like with coffee, like to go without taking nootropics for a certain number of days, weeks, to reset the body?
Because there's such a wide range of compounds and chemicals in these blends, it's highly variable. Like I mentioned, we know with caffeine that it's 6 to 10 days. Arguably, knowing that that's about the amount of time that would take neurotransmitters to reset, or at least the receptors to reset, you could probably say the same for a lot of these agents. But one of the better tips I can give you is that I know I listed off a lot of stuff. Usually people who do really well with nootropics and their use, they have like 3 or 4 different things around their house and they'll cycle. Or like one day they might do one of the Newtopia supplements. One day they'll have a cup of coffee and some nicotine. The next day they might do a handful of Quality of Mind. The body, kind of similar to how you build muscle when you switch up workouts and exercises frequently to throw curveballs at the body. It's kind of similar to throwing curveballs at the mind. So I'm a fan of having a few different nootropic agents around and cycling through them. And you'll find that different things work well for different tasks. You know, I'll give you an example of that by naming two things I didn't name yet. And these would be from the realm of plant medicine. You've no doubt heard, you know, of the recent surge and popularity of microdosing. Microdosing with, say, you know, psilocybin or LSD or wachuma or ayahuasca or any number of things that in a high dose would cause a what's called an entheogenic or psychedelic or hallucinogenic effect, but in very small subperceptual doses seem to allow for a lot of focus or creativity or productivity or wakefulness. So, for example, if you were going to engage in a bout of creativity, maybe a business rebranding project or a book that you're working on or anything else that would require a lot of creativity and thinking in new patterns, a microdose of psilocybin is actually very good for that, like 0.25 to maybe 0.5 milligrams of psilocybin. And to put that in context, you'd have to take 2+ grams to start to get to the point where you were getting a little bit psychedelic. You know, in most cases, when people journey with magic mushrooms, you're talking 6 to 8+ grams. So it's a lot, you know, it's at least 1/10 of that. And then let's say you instead just got to focus. You got to buckle down. You're in project mode. You don't necessarily have to be creative, but you're going to have to focus and work hard the entire day. Well, that would be where something like a microdose of LSD could be used. And when I say microdose, again, like a trip dose would be, you know, 100 micrograms. So we're talking about 10, maximum 20 micrograms of LSD to allow for focus, whereas psilocybin would be more for creativity. And so as you're playing with a lot of these different nootropics or smart drugs, you'll find that certain things lend themselves better to creativity, socializing, you know, partying, etc., whereas others are better for just a day of buckling down with focus and productivity.
So these microdosing of these different LSD or mushrooms, what have you, other psychedelics, that does not impair one's ability to drive, to do normal functions. It's like you said, it's subperceptual. So would you even know that you're under the influence if somebody, say, slipped one into your drink, for example?
You know, both plant medicines and nootropics and smart drugs are all kind of interesting in that you need to drive them properly. It's like getting in a Ferrari and driving it properly. If you just take, let's say, half gram of psilocybin or whatever and just kind of sit around on the couch and maybe go for a walk and play some golf or something, you're really not going to get much out of it. Usually you pair a nootropic or a smart drug or a plant medicine microdose with a very cognitively demanding activity. And that's when you really start to reap the benefits of what is called neurogenesis or neuroplasticity, meaning the growth and sparking of new brain neurons, the merging of the left and right hemispheres of the brain, and that focus that you're actually looking for, that creativity that you're actually looking for. With the plant medicines and whether or not you can actually feel them, it's subperceptual. You know, it's similar to having like a cup of coffee, like let's say a decent 10-ounce black coffee versus a 24-ounce cold brew, right? And most people who've had the 24-ounce cold brew know, like, you're definitely on something. I would say that the properly administered microdose of a plant medicine, the only thing you're going to notice is that when you do get to work, you're getting more of the focus or the creativity that you're looking for, but it would in no way impair driving. You wouldn't be seeing purple fairies or, you know, psychedelic imagery or sacred geometry inside your head while you're, you know, trying to go through financials or anything like that.
For nootropics, they all have different ingredients in them. I mean, are they, how, in what ways are they similar to a pharmaceutical, or are they completely different?
Generally, nootropics are considered to be substances harnessed from the natural plant kingdom, right? Like Bacopa monnieri or caffeine from coffee berry, or royal jelly from bees, or choline from fish oil or something like that. Whereas modafinil, Adderall, and some of these smart drugs are chemically synthesized, often more powerful, but the nootropics just tend to be a little bit more natural. And so as far as the different types of them, there's just so many different variants that it's dizzying. The last paper I read on nootropics and smart drugs, and I won't get into the details here unless this is one of those bedtime podcasts that people listen to fall asleep. It lists about 12 different categories of nootropics and smart drugs, from things that amplify choline release by limiting the rate at which choline breaks down, choline being a key neurotransmitter for focus and for creativity. Others will clear inflammation from the brain. Others will help with the blood-brain barrier. Others will help with the production of ATP, or the protection of mitochondria in the brain. So it's really tricky. It's like, it's kind of like saying, well, what food do you eat for energy? It's like, well, gosh, I don't know. Some days I'll have sweet potatoes, and some days I'll have carrot fries, and other days I'll have a ribeye steak. So it's very widely varied as far as the number of different nootropics out there. And that's why I do kind of like to be lazy and just go for some of these done for you formulas that cover a wide range of functions with the appropriate doses. But some people, gosh, man, you could take a deep dive down the rabbit hole. There are websites like, say, one popular one would be Nootropics Depot, right, where you've just got all these things that look like chemicals, and you don't quite know how to combine them, but there's little Reddit threads that give people's user reports, and you kind of piece stuff together and experiment. And if that's what you like to do, great. But if you just want something that's formulated approximately close to what human dosages are and is combined in the right way, I would say some of those done for you formulas like Newtopia or Ana Alpha Brain or Qualia Mind or Rukio would be good places to start if you don't want to kind of be the pioneer cowboy.
Okay, fantastic. So how about diet? How can we make dietary changes to help improve our mental performance?
Yeah, I would think about this in two different ways. The first comes back to that blood-brain barrier that I talked about. And this is the acts of omission typically tend to be less sexy and popular for folks, but ruthlessly eliminating seed oils and vegetable oils from the diet, being really careful with excessive alcohol, artificial sweeteners, colors, preservatives. Basically, the more that you're consuming a standard Western diet, the more damage you do to the blood-brain barrier. So a big part of it just comes down to eating clean, real, whole food. And even though based on the genetic variation that you and I were talking about earlier, the type of diet someone eats is going to be very different amongst populations. Meaning some people will do well on a paleo diet, others on a plant-based diet, others on a carnivore diet, etc. But generally, most of those diets seem to work pretty well because there is a general elimination of processed and packaged foods, artificial sweeteners, eating out of crinkly bags all the time, and a return to a more whole foods approach. Now, if you were to get your genetics tested and maybe do some blood testing and maybe some food allergy testing and some hormone testing, you could step back with that data. And this is a lot like I spend half my week just on phone calls with people, walking them through their labs and telling them how they're supposed to eat and supplement and exercise based on their values. But you would find with testing that, oh, I'm a good candidate for a paleo diet, or I wouldn't do really well on a keto diet because I don't digest fat well, and I have, ApoE4 gene that dictates higher risk for Alzheimer's when I eat a lot of saturated fat, and I've got poor gallbladder function, right? And so that ketogenic diet that really helps, the person sitting across from me isn't really going to help me. So ultimately, though, eating whole foods and eating in a relatively unprocessed manner is how you approach the blood-brain barrier piece. And then as far as the things that you would want to go out of your way to include for a healthy brain, first of all would be what's called DHA and oleic acid. The reason I just said those two things is because the myelin sheaths that line your nerves that allow a signal to propagate down the nerve and allow your brain to function properly, those are made up primarily of two different fats, DHA, which is docosahexaenoic acid, and oleic acid. You get DHA from things like fish, seeds, nuts, avocados, etc., with fish probably being at the top of the totem pole, whether it be fish oil supplementation or a good, clean seafood-based diet. You get oleic acid, as the name implies, from extra virgin olive oil. That's a great source of oleic acid. Avocado oil has some in there, macadamia nut oil, any of these kind of like stable oils that aren't canola oil or safflower or sunflower oil, those tend to really do well for the oleic acid piece. So really good, clean, healthy fats in the form of fish, seeds, nuts, and when I say seeds and nuts, by the way, not the trail mix from the gas station that's coated with canola oil and cane sugar, just like raw seeds and nuts. And I actually go so far as to like soak them, and I'll even sprout them because that's how you unlock a lot of the nutrients in them. And then fish, olive oil, avocado oil, etc. All of those are fantastic. A few other things to consider with the diet would be adequate mineral intake. And so I'm a total salt nerd. I've got Florida Cell salt and Kona black salt and Colima Mexican salt and Celtic salt, which you can find at just about any grocery store. And I salt my food at every meal because, and there's a great book about this called The Salt Fix by Dr. James DiNicolantonio. Research shows that salt is not bad for you unless it's like the isolated sodium chloride I was talking about from table salt. But full spectrum minerals spread throughout the day in the form of really good electrolytes are fantastic for brain function, in addition to those fatty acids that I was talking about. And then the final thing I would think about that will both allow for better neural function and also for a better blood-brain barrier would be polyphenols and flavonols. So you hear people saying, oh, eat the rainbow, eat a wide variety of fruits and vegetables and herbs and spices. And there's definitely something to that, right? Blueberries and black raspberries and purple potatoes and these like, green juices and red powders. And a lot of these are fantastic for the brain. A little bit of a pushback you'll often find, at least in the health sector these days, is people will say, well, I heard plants are bad for you. I heard we're supposed to only eat animals. It is true that plants can be bad for you. Like, I live close to the Palouse. You guys are over in Seattle, right?
Yes.
Yeah, okay. So you're familiar with like the rolling wheat fields of the Palouse over by Pullman, Washington. If you're just to wander out to one of those fields and just start chewing on a stalk of wheat, you'd get tummy upset because of all the gluten, the lectins, a lot of the digestive distressors that are in that plant. Because unlike animals, plants don't have teeth and claws and hooves and an ability to be able to defend themselves. So plants produce chemicals that irritate the gastrointestinal lining of the mammal that eats them, and that's how they survive. A lot of times that causes the mammal to poop out their seeds whole, so those seeds can then propagate. It's just a survival and a defense mechanism built into a plant. That doesn't mean that you don't eat plants, right? We could take that same stalk of wheat and we could grind it and mill it and wash it and rinse it and soak it and even do a process of, say, like for sourdough bread, fermentation on it, and we could render it very digestible. We could take that bag of quinoa from Costco and rinse it and then soak it overnight and then rinse it again before preparing quinoa the next day to get all the soap-like irritants off of the outside of the quinoa that would irritate the gut lining. You can take that giant, raw kale smoothie and instead, boil and mash and puree the kale to reduce a lot of the oxalates and to make it more digestible. So it's mostly about being smarter than the plant and knowing how to do things like soaking and sprouting and fermentation to unlock a lot of the nutrients in the plant and to deactivate a lot of the plant defense mechanisms. And when you do that, a diet rich in, plants, vegetables, fruits, herbs, and spices tends to be a really great way to get the polyphenols and the flavonols that you need to optimize brain function.
How about supplements? And also, what can we do to increase the absorption rate of vitamins that we do take, or even the foods that we ingest, so that more of it actually gets into our system?
Oh, that is an interesting question. The nootropics that I talked about earlier, those are all supplements. Like, those would count as supplements.
Mm-hmm.
If you were to throw in some things that wouldn't be considered so-called mind directors, but that would be good for the brain, one I already named, and that's fish oil, right? Anywhere from 1 to 4 grams of fish oil daily, preferably taken with a meal to allow for better absorption. Another example would be creatine. Creatine for a long time was thought to be just like the supplement that strength and power athletes use to bench press more weight or something like that. But a lot of recent research has shown that creatine is fantastic for mental function and is particularly good for you if you're sleep deprived. And so about 5 grams or so of creatine on a daily basis is also really good for the brain. And if I could tell you one more in addition to fish oil and creatine and some of the nootropics I talked about, you've probably heard of NAD. A lot of people talking about like NAD, also known as NR or NMN. It's a little bit difficult to roll off the tongue, but NAD is nicotinamide adenine dinucleotide. NR is nicotinamide riboside. NMN is nicotinamide mononucleotide. I forget what the N is. I fail. But basically, you hear a lot of like NIA this, NIA that. Well, they're all basically derivatives of what's called niacinamide. And niacinamide, when consumed, gets converted into NAD in your body. And that's a very good cellular and DNA protectant, including for the brain. As a matter of fact, it's so good at that if you are sleep deprived and you take NAD, preferably combined with creatine, and that's my sleep deprivation hack stack, by the way, you find that you can perform very similarly to how you'd perform if you weren't sleep deprived. That's not making a case for sleep deprivation, because there's all sorts of other things that happen when you don't sleep well, like your collagen degrades and your brain starts to fill with toxins, and you start to lose endocrine function, and you make too much cortisol, you snack too much because you have poor appetite control, etc. But if we're just talking about like 1 or 2 days and you got to get through it, NAD combined with creatine is fantastic. I would say that with NAD, very similar to what I said about nootropics, there are a few brands I could vouch for out there that do a good job with NAD. There's one company called BioStack Labs. They have a good one. Qualia, that same company that makes the Qualia Mind nootropic that I talked about, they have an NAD. And then there's one that's also pretty popular. I think this is the one that I think possibly David Sinclair was involved with the research for this one. It's called True Niagen. That's another popular one. But basically, you're just looking for the active ingredient niacinamide. And so NAD can also be really fantastic. So I would say top 3 supplements would be fish oil, creatine, and NAD.
We all know that sleep's important to get enough of, but is there such a thing as getting too much sleep? And if so, would you recommend setting an alarm so that we don't sleep in too late?
Well, that depends. I mean, like you probably heard of like Tom Brady and Michael Phelps, for example, super athletes who will sleep 10 hours a night. And I did 13 Ironman triathlons, and I was a professional Spartan racer. And I've certainly had times of my life competing as a professional athlete. I was also a collegiate tennis player where I knew that I needed a lot of sleep, and it would take 9-10 hours sometimes for me to wake up with that refreshed feeling. So if you're beating up your body on a regular basis, and I know, your primary audience isn't a bunch of pro athletes, but even like somebody who's CrossFitting a couple of times a day or something like that, you are going to need closer to kind of like that 8 to 9 hour sleep time. Most people do pretty well on 7 to 9 hours. You are right that there's some data showing that exceeding 9 hours can actually lead to increased all-cause risk of mortality. Something about just laying in bed, huddled up under the sheets, seems to be bad for people. It's back to that sage verse from the Bible. It goes something like a little sleep, a little slumber, a little folding of the eyes, and poverty comes upon you like a lion, or something along this. It's from the book of Proverbs in the Bible. I think about that sometimes when I'm laying in bed underneath the covers, snuggled up with my wife, knowing I got enough sleep, but I kind of feel like staying in bed. I think about that verse, and that usually rips me out of bed in the morning to avoid the little sleep, the little slumber, and the poverty that comes along with it. But anyways, that's why I really like a lot of these sleep trackers. I wear this, the Oura Ring. I know we're not a video podcast, but I'm holding up this ring right now that's on my finger. There's another one called the Whoop. Garmin makes one. There's a lot of different sleep tracking wearables out there. And these will really allow you to know within a few weeks of use what sleep time is allowing you to have adequate readiness, adequate nervous system repair and recovery, and an ability to be able to feel good and operate during the day. Now, so it varies. I can tell you right now that I break a lot of the rules personally when it comes to sleep. So I only sleep about 6 to a maximum of 7 hours a night because I like to get up very early before the texts are coming in, but before the rest of the world is awake and before people are emailing me, because I know that's the time when the house is quiet that I can get deep work done, spiritual time in, like prayer and devotions, a sauna session, a cold soak, a workout. So, I can easily, by the time I got to be on my Ben Greenfield Life team huddle at 9:45, I've often gotten a good 5 hours of productivity in. Now, my hack for that is that I'm a big fan of a nap or a siesta in the afternoon. So I actually clear my post-lunch period from about 1:30 to 2:30 p.m. to not have meetings or consults or anything like that. And I typically will duck away into the basement where I've got some relaxing materials to lay on. And I've usually got some kind of sounds that will lull me off to sleep, or an essential oil diffuser, or, different meditation devices. And I always have that time carved out, because if you can take a good quality nap or siesta, that can give you the equivalent of a full 90-minute sleep cycle in as little as 20 to 30 minutes. So you do the math. Like if I sleep 6 hours a night and I get in, let's say, like a good solid 30, 35-minute meditation session after lunch, I'm giving myself 60 to 90 minutes every day of extra time. So that I realize not everybody can just like crawl under their desk and go to sleep after lunch. But if you have the option for an afternoon nap, combined with a slightly shorter sleep period, that works really well if you're one of those people who just likes to crush the morning.
Is that because typically when we go into a nap mode, we go into more deep sleep than we would do at nighttime in a regular?
Well, if you look
sleeping?
at sleep spindles on a good nap, you just go through all of the different sleep cycles, but more quickly. So rather than taking 90 minutes to get through them all, you can get through them all in 30 minutes. There are certain things that can accelerate that. I'll give you an example. I have an app called NewCalm, and NewCalm has 30, 40, 50, 60-minute sessions that will make you feel like you've slept several hours. It's spelled NU Calm. I have a little wearable that vibrates and it lulls you off into sleep. It's called an Apollo. I wear that around my ankle, and it really helps me get into a relaxed state when I go from like emails and lunch to siesta. All right, I got to knock myself out fast. Another example, kind of like the opposite of smart drugs or nootropics, would be a lot of times with lunch, I'll take a little bit of CBD and a little bit of reishi mushroom extract. And I've experimented with a lot of things that would allow you to have a nap after lunch, but not wake up groggy. And if I do a little bit of CBD and reishi with lunch, I can get a really effective nap in after lunch and then be able to get up and get back to the workday effectively.
Great. I noticed that you're wearing some yellow sunglasses. Appears. What? Tell us about those.
Yeah, the blue light blocking glasses. I used to call them birth control for your head because they, for a long time, were not very fashionable things to wear. But there are some companies now that make pretty good-looking, fashionable glasses that will block the bright overhead fluorescent light that I was talking about earlier that can lead to retinal irritation, brain fog, even poor eyesight and early onset of myopia. So I have 2 pairs of these glasses. I have the one I'm wearing right now, which is a more yellowish pair that I'll wear in the daytime to block the glare, the backlight from coming off of screens. And then usually during or after dinner, I put on a pair that's red light that will block a lot of the bright lights that would tend to suppress your melatonin production and result in poor sleep or poor onset of sleep. So, I mean, that's a very, very inexpensive hack, faster than fixing all the bulb cans in your entire house. And so there's lots of companies out there. These are made by Raw, R-A, Raw Optics. And there's several brands out there for blue light blockers, but I think it's a pretty good investment, especially if you are working on screens or under fluorescent lights a lot.
Yeah, I have a pair of yellow blue light blocking glasses, and I definitely notice when I'm looking at the screen, it's much easier for me to doze off when I'm wearing them. So.
Yeah, that's the problem. Actually, is like I'll sometimes be like, well, I want to if I take my sons to a movie. I'm like, I want to go to sleep after the movie, so I'm going to wear my red light glasses to the movie, but then you get sleepy during the movie. They're that effective. So it's surprising. Like once you get them and you put them on at night, you're like, oh, this is how it's supposed to feel when the sun sets and I'm not exposed to a bunch of light. And of course, you can use that as a hack too, right? Like if you, I'll give you an example. Let's say that you are waking up way earlier than you want to wake up. Like you're one of those people who wakes up at 3:45 with racing thoughts. You don't have the luxury of an afternoon nap, and you know you're going to be toast by like 2 p.m. if you get up. Like you're just going to be living on cold brew. Well, what you can do is you can shift your circadian rhythm forward within just about 2 or 3 days. And the way that you do that is in the morning, you don't necessarily have to lay there in bed waiting until, I don't know, 5:30 or whenever you actually do want to get up. You can get up if you want to, but don't turn on any lights in your house. I actually have a red light headlamp that I'll use for this, especially when I travel and I'm in a different time zone, just a cheapo red light headlamp on Amazon. So the trick here, the idea is you're restricting how much light you're getting exposed to. You're wearing the blue light blocking glasses most people wear at night instead in the morning. And when the actual time comes around, when you actually want to start waking up, you take off your blue light blocking glasses, you flip on all the lights, you take your computer and your phone out of night mode, and you blast yourself with light. And that actually will shift your circadian rhythm forward to allow you to start waking up later on. It's kind of something that comes in handy, especially if, you know, like I travel a lot and sometimes I'll come home from being on the East Coast and I just don't want to wake up that early. So I'll use light as a circadian cue to reshift my circadian rhythm.
Wow, that's an interesting hack. Speaking of which, the subject of biohacking, do you know, are there any ways to objectively measure one's mental sharpness like we do in other areas with wearable technology, blood tests or brain scans?
Yeah, there's kind of two ways to think about this. One would be kind of the cheap at-home version. There's an app that you can get. There's a few different versions of it. It's called the CNS tap test. That will measure reaction time, central nervous system tap test. It's a series of quick taps that you do with your thumb on your phone. There's another one for memory and recall called NBAC. You can get a free NBAC app and a free tap test app. And both of those will allow you to kind of like do a quick check-in at home. If you want a slightly fancier version, you could make an argument that if you regularly use an app like Lumosity or Brainscape, for example, that you could engage in those brain games and see if your performance improves or decreases if you're playing them consistently. But then to actually do what would be considered more medical imaging of the brain, there are a few things you can do. There's one test that will tell you your blood flow to the brain. Dr. Daniel Amen is a doctor who has made this test pretty well known. It's called the SPECT scan. And it's interesting because that blood-brain barrier I was talking about is related to the actual blood flow that's able to go into the brain. And there are areas of the brain that can have poor blood flow. THC would be an example of something that's horrific for blood flow to the brain, for example. And so a SPECT scan will show you your blood flow. That's a good test. Another really good one is a QEEG, which is an electrical mapping of the brain where you wear some electrodes on your head. There's some companies trying to do a home version of that. I haven't been impressed with many of those that I've received yet, even though they're getting closer and closer to it being just a pull-on cap where you can do an electrical test of your brainwave production, like your alpha, your beta, your delta, and your theta brainwaves, and those brainwave ratios, because that also will be a good indicator of cognitive function. So SPECT scan and QEEG scan, both of those are pretty good for a more professional quantification of mental function.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
Types of exercise. If one does, say, headstands or gets on the inversion table and has the blood flow all the way to the brain, does that help or have any effect, or are there any types of exercise that would help mental performance?
Well, I love this question. It's not all about popping the pills, right? And by the way, this might be the last question that I have time to go into, just so you know. But certainly. Absolutely, there's actually a book. It's an older book. It's called Spark by author John Rady, that talks about all the different ways in which exercise can be beneficial to the brain. Now, it turns out that low intensity aerobic cardiovascular function is fantastic for mental focus and for general brain health. However, if you look at something like strength training or high intensity interval training, that seems to be very beneficial for producing a lot of what is called brain-derived neurotrophic factor and vascular endothelial growth factor. Both of these act like miracle growth for the brain. And so strength training and high-intensity interval training, in addition to cardio, should be part of your brain training program. There's even hacks that you can do. Probably the most popular is what's called blood flow restriction training. And this is where you wrap bands around the arms and the legs and work out, and you actually concentrate a bunch of lactic acid in your muscle tissue when you do this. Obviously, it's a little bit more of an advanced exercise technique, but not only does it fool your muscles into thinking that they're lifting heavy weights without you having to lift heavy weights. And so this is like the ultimate hotel room workout tip, because you can work out with just push-ups and squats and things like that. But when you take the bands off, you get a rush of lactate into the rest of your body and a huge surge in that brain-derived neurotrophic factor. So I'm a fan of, and I should mention one other thing. Temperature dysregulation appears to be really good for blood flow to the brain as well. And also when it comes to cold, the health of the vagus nerve, which is a very important part of your nervous system that can assist with cognitive function and stress control. And so I would say that heat and cold, like a sauna practice and a cryotherapy or a cold water practice, would also be really good for the brain. So what this would look like is, for example, your morning could be those things that are a little less hard, because the body's more primed for hard stuff later on in the day. It's actually about between 4 and 6 p.m. when testosterone peaks and grip strength peaks and reaction time peaks. So it's better to do the harder stuff between about 4 and 6 p.m. in the afternoon, if you can. And then in the morning, do like an aerobic walk or a bike ride to the coffee shop or to work, or a sauna session with a quick cold plunge afterwards. And then do your work day. And then afterward, do a little bit of strength training or high intensity interval training. If you don't have the time to do something like that, then you could just alternate. Like one day, your recovery day, you could do a walk with the sauna session and some cold. The next day, do some strength training and some interval training. But there's different ways that each of these different forms of training seem to stimulate the brain. So I'm a fan of really all 5: low intensity cardio, strength training, high intensity cardio intervals, sauna, and cold. And those would be like the 5 forms of movement to engage in, unless you're going to take into account sporting activities. And I'll give you a little quiz here, Ian. What do you think are the sports that you can play that lend themselves most to optimized brain function with age?
I would think something eye-hand coordination. I don't know, maybe tennis or I'm just guessing something that requires you to focus in on something.
Okay. Well, you nailed it. I'm glad you didn't say football. I would have failed you. Whether European or American, football is not that great for the head. Turns out that anything that merges left and right brain hemispheric activity, like racket sports, are way high up there, as is swimming. So if you want to choose the two sports that would be best for your brain long term, it would be tennis, pickleball, racquetball, any racket sport, and swimming.
Oh, wow. Great. So in summary, if you could only pick 3 actions to take to improve mental performance, which 3 would you choose?
I would say go after the low-hanging fruit, and it would be aerobic exercise, cold, and ruthlessly eliminating vegetable oils from your diet. Those would be the top 3 that I think just about anybody can do. So what do I mean by that? Get one of these activity trackers and shoot for 10,000 steps a day. A lot of people think they're very active and they look at their activity tracker and they're like, crap, I took 3,000 steps. But it's possible. Take your phone calls while you're walking, get an office treadmill like I have here, go for walks. It's just so good for the brain. And it also takes you away from technology quite a bit. Cold shower, for example, every morning, just quick cold shower. Easy way to do it. You don't have to buy like a $4,000 cold tub, but get yourself exposed to the cold on a regular basis because that's fantastic for flushing the brain. And then just look at food labels and even ask at restaurants and try and avoid rancid processed seed oils because they're so bad for the cell membranes and the blood-brain barrier. So canola oil would be the biggest, safflower oil, sunflower oil, French fries, fried foods, fried chicken. Be super careful with that in your diet and your brain will definitely thank you.
Great. Fantastic. Well, Ben, thank you very much for coming on Chat with Traders.
Well, thanks for having me. These are great questions. You got my brain smoking, man.
So how can our listeners get in touch with you?
I'm pretty easy to find. bengreenfieldlife.com is my website. If you search for my name on Amazon, you can find any of the books I've written about a lot of these topics. And then I'm on all the socials as well. But you can find all that if you go to bengreenfieldlife.com. Great.
Fantastic. Yeah, I've certainly very much enjoyed the podcast that you've done since I started listening to you 7 years ago.
Oh, wow. You're loyal. You're right up there with my mom. Wow. Congratulations, man. You get the loyalty award.
Great. Right. Thanks, man.
All right. Thanks.
Yeah.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. tastytrade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tastytrade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
It showed them that if they ganged up on the market, even on big indexes, that they can do things. Who are these guys? These guys are, most of them, a lot of them, many of them, people who work in tech, mostly in California. Actually, my nickname for them is Cali Boys, California Boys. They have huge compensation over there, and they have more money than they know what to do with. And they are big gamblers. That's something that perhaps even they didn't know about themselves. And they love doing this stuff. I'm really always trying to understand and study and try to find a way to, as I said, not even follow them. I just want to avoid them. I just don't want to be in the way. I don't want to be a victim. If you remember during the GameStop saga, a lot of hedge funds were victims of this guy.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Hey traders, how's it going? I hope you're doing well. Tessa here, co-host at Chat with Traders, and this is episode 279. Do you ever think deeply about who you've been playing with or against in the markets, and do you know who those market participants are, how they tend to behave, and make their decisions and why? If trading is a game that we want to stay in, should we be thinking about this in the same way as elite athletes do, where understanding their opponent's strengths and weaknesses can help them to strategize and sharpen their own edges and come to the game prepared? Or is it different with trading? Today, Ian speaks with Saad Filali, who for a time worked for Goldman Sachs, specializing in mergers and acquisitions. Then he left and became a trader. Understanding the thinking and trading styles of the many different market players is key to his trading, including those of institutions, sell-side brokers, CTAs, retail and meme stock traders. Yes, meme stock traders. Studying how they trade the volatility in news releases helps Saad to predict market movements and calculate suitable entry and exit points in his trades. Saad now manages his own macro fund and relies heavily on news flow and research. He looks for discrepancies between market pricing and fundamental valuations and consider the impact of different market participants. I bet that there are great takeaways that can be gained from a very interesting perspective. Listen and enjoy. Ladies and gentlemen, please welcome Saad Filali, currently in France.
Saad, welcome to Chat with Traders.
Thank you. Thank you for having me today.
Yeah. Where are you at now? And where did you grow up?
I grew up in North Africa, in Morocco. I was born in Casablanca. And when I was 18, I had an opportunity to come study mathematics in France. That's what I did. I have a master's in that. Then I've worked a little bit in finance and in mergers and acquisitions, in M&A, in London, in Holland too, and in France. That's basically how I got into finance.
Tell us a little bit about what you did in M&A, mergers and acquisitions, right?
Well, mergers and acquisitions, you have to see that as a sort of broker's type of job, except you're not actually selling apartments, you're actually trying to sell businesses. There's a tiny little bit more work involved, but outside of that, it's not really an intellectual job. It's a job in which a salesman will be better. So I realized I was no salesman, unfortunately for me. But I was good with numbers, with thinking, with logic, with reading. And somebody just suggested that I look into trading as a possible alternative. I did. And then I gave up on the M&A route and I joined Goldman Sachs to work as an equity sales trader for a bit of time in Paris for like a year. I did that for a year, and the idea was that they would give me a book for trading, It didn't happen because there are some regulations in Europe, namely MiFID II, which makes allowing people to trade within the banks today like really, really complicated. So when I realized that it was probably never going to happen, or I would have to wait a long time, I decided that if I was any good at this, I should be able to succeed alone. So I went out of the bank and I got some money from a couple of friends and started trading to build a little bit of track record. This was back in 2020. A couple of years later now, I do have a track record and I'm managing 13 million US dollars. It's not a lot for a fund, but given the structure that I chose, it works for me.
And what did you learn at Goldman Sachs? You were there for just a year, did you say?
I was there for a year. Let me be frank. There is very little you can actually learn in there that's going to be useful for actual trading. The only good thing is the access that I had to the research department. So you can talk with these guys in the research department, but that's something that you can have access to today. Like you can get access to the sell-side papers if you just buy a subscription from this provider or that provider. You can get these papers and you can read them alone, and that works very well. There's no problem with that. But like in terms of actually learning anything, like basically your question should be, I think, are the market makers or are the traders or what's left of them within a place like Goldman Sachs any good today? Well, no, they're not. And there's a very simple reason for that. That's not what they are asked to. Most people who call themselves traders within these banks are not actually traders, they're just brokers. They are just here to facilitate the trading of the actual clients, or the hedge funds and the very big retail clients and so on. They don't do that much trading. They don't really take directional positions. They don't really bet on the market doing anything. What they have to do is simply manage their own the portfolio that they get, which is just a direct result of what trading is happening or is being done by the clients. So a client calls, this client wants this. That means that you are short that, and you have to manage that exposure. You have to unload the delta if you are on the option side, or even on the linear side, meaning if you deal in futures, even though that doesn't really happen today in big banks like that. And because they added a regulation that says that at the end of the day, they have to be delta neutral at the end of every day, you can imagine that the margin of maneuver for these traders is very, very, very limited. So it's a very different job. Like when people think about traders in like Goldman Sachs, you're actually thinking about the people who were in Commodities Corporation before it was bought by Goldman Sachs. So you're talking about stuff that was happening in the 80s and late 90s, or even up to the 2007s, if you were lucky. But after 2008, and especially today, and especially in Europe, I can assure you there's not much directional trading happening at these places.
Is that because they got burned many times in the past, or is this just they're become very risk adverse for some reason?
It's because of some regulations that appeared in the US after 2008. And then the second, most importantly perhaps, the shareholder base of these banks are telling them today that the reason that they invest in a bank isn't really to get any much equity upside or anything like that. What they want is for the investment banking business to be as stable as possible. So they are strongly told not to do anything that could create volatility. So it's just a shared desire by the shareholder base of these banks. It's also the direction that the regulator is going to, as far as the SEC in the US and in Europe, they just copy them. In fact, in a lot of times go above them. It's just the way the world has turned after 2008. They want the less risk at these places, and that's what's happening.
I see. So while you're at Goldman, were you doing any trading on your own account, or did you have Goldman manage any assets for you?
No, I didn't do that. What I was doing specifically was doing it for clients. And then I was also suggesting a lot of trades to clients. So I was a sort of macro strategist at the same time. That's sort of how I got my reputation in there. I was writing these articles. And my boss at the time, he did promise that he would try and find a way for me to try and do the ideas myself, but it just never happened. that was really the main motivation for why I left.
Can you give us a couple of examples of maybe, say, a typical recommendation that you might make to clients to go long or short? What kind of products?
Well, it was European equities mostly, but I also dealt in US equities, in futures. My ideas were very simple. They were something like, I think you should buy Netflix today, or I think you should sell bonds today because of this, and that. They were predictive in nature, meaning that I was taking a bet on a certain number of things happening in the future over a reasonable time. And then the second thing that's embedded in these kind of bets, that the price action would correspond to what I'm predicting at the same time. Because you can predict the event, but sometimes the price action doesn't correlate. That's something that's just happened to me, for example, in gold recently. I've taken quite a hit because I imagined that the Fed would have to become more hawkish. And that's what happened recently. We've even had Powell say something along the lines of, inflation exceeded our expectation during the first quarter, and we won't necessarily cut this year, but gold didn't fall. So sometimes you can get the prediction right, but it doesn't mean that you will get the price action right. This is like the nature of everything that I do. It's a bet always ahead of an event, or ahead of something happening, or ahead of a data release, or ahead of an earning release. Then it's also a bet on the price action responding.
Your bet on what is going to happen and the price action and so forth. What kind of time frame were you looking at in these recommendations? Like, okay, in the next month, week, or very short term?
No, it goes from seconds, really seconds, to a couple of days, or no more than 2 weeks. I operate on relatively short time frames.
I see. So when you were making these recommendations to the clients, I gather they had to be very quick to get your recommendation and also to be able to exit the position, because we're talking about very, very short time frames, correct?
For example, there's a non-farm payroll number. That's basically the jobs number in the United States. That's coming. I think this particular number will be important. And I also predict that this particular number will either miss or exceed expectations based on what the consensus is. And I also predict that this asset class will respond in this way. So I will contact the clients ahead, maybe 1 day ahead or 2 days before, and explain all of this to them. And if they agree, they will tell the trader or tell me to put a position for them.
I see. And then do they allow you to, at your own discretion, to exit the position when you feel it's the right time, or do they have to?
No, that never happened. But usually what would happen is they would usually like talk with me about the exit beforehand, also sometimes after the event has happened, to discuss whether it's something that they should keep for a longer time frame, or if they should just be happy with what they've got and exit.
So you felt, my understanding is you started your fund and started trading for yourself in May of 2020. Is that accurate?
May 2020 is when I started the fund, yeah.
And so did you feel that your 1 year at Goldman prepared you enough to be ready to take on this new adventure?
What really prepared me was reading a lot of sell-side research from Goldman and from others. It's really the research aspect, the research papers that really helped me. And something else that really helped me is that by that time, I had been a listener of Bloomberg Radio for more than 3 or 4 years. And I think that's also something that really helped me, because like you get to hear everything that's happening live, the commentaries, the analysts, the people who are invited from the sell-side banks to answer questions. They usually ask really good questions. So I think these are like my two schools for this. Now, of course, I do happen to have a theoretical background in finance and all that, but I don't really think that's necessary or even that helpful. In fact, I would say that you could easily be too smart for trading the markets, because let's not forget, the price is the reflection, a sort of average of everyone who's involved in the market. We're not talking about just mathematical Olympians who are trading. It's really everyone. So sometimes you have to give up very rigorous logic and just, if not ride with the trend, just accept the trend. An example for this in my case would be Bitcoin. I understand what Bitcoin is. I could even replicate it. I can even recreate it if I wanted. In fact, I even did just for fun. But I don't see why the price should appreciate. To me, the reason why Bitcoin appreciates is the same reason why sneakers prices appreciate. It's because there are a couple of people who really love it, religiously so. So for me, buying that and keeping it for a long time, hoping for price appreciation, is just contrary to what I do. Usually the kind of thing that I do requires a direct mechanical cause. If I'm selling bonds, it's because I believe the Fed will come behind me or after me and raise rate. So there's a direct mechanism for why that will happen. So I don't believe in Bitcoin, but that doesn't mean I will short it. Mm-hmm. So this is when you have to like give up and stand back a little and say, okay, I don't want to play this game with them. So at least I will have the insight to sit out and just not participate instead of getting hurt if I started shorting it. I think that also happened to a lot of people in Tesla, for example. Today, Tesla is falling very hard. A lot of people feel vindicated. I've seen these analysts on TV. They come, oh, I've always told you Tesla is such a shitty stock. It was overpriced and overvalued. Yes, okay, but for 10 years, the thing has multiplied by 10. So you've lost money on it. Even if Tesla goes to zero, you will make all of your money on it. So you will not even break even. So how is that exactly a win for you? I wouldn't say that. The win will have been to just acknowledge that indeed, more than a stock, this is a sort of religion. There are some cultish elements behind it. Yes, someday, sometimes the truth may come, but I have the insight to sit out, not participate, and instead focus on stuff that I actually have some mastery in, where there are direct effects and causes. Like usually in all of the stuff that I trade, which are basically all the big macro instruments, I might not always be able to predict the right price action, but I can more or less 99% of the time explain why something happened.
My understanding is that the fund that you're running and have been running since May of 2020, you describe that as a macro fund. Is that correct?
It is a macro fund. Yeah, it's a very old school.
So describe for us, for our listeners, exactly what is a macro fund? What type of fundamentals do you look at?
Typically in the 80s, when people said I have a macro fund, what they really meant is that they were trading futures, or that they were CTAs and they had managed accounts. But today, the definition is somewhat different. When people say they have a macro fund, it means that they are engaging in predictions about the future of things that are relevant to the instruments that they trade. This for me is like the basis of it, is that I am predicting. I'm not reading technicals. For example, in my case, I don't use technicals at all. In fact, I could even not use charts at all. I do have a couple of them, but I don't really need them. I just need the prices. I have zero technical input. And however, my biggest input, like you can really see my screens here, but like the 70% of the real estate that I have in screens is dedicated to the news flow. So the news from Reuters, the news from Bloomberg, the news from the Skok that you heard talking in the beginning of the interview. Then I have several other subscribers and analysts that I like to read because I feel that they are useful. And then there's my channel on this one where I talk with the people who work for me or are clients with me, like to exchange ideas. That's my main input. It's really the news, and that is the driver of trades for me. That's what generates trades. It's when we have a data release or something just happened, and I see that I identify that one or many of my instruments might be impacted by it, and then I will try and do the trade.
And so are you doing this discretionarily, or do you have an algo? I mean, do you use algos to execute your trades?
It's entirely discretionary.
Entirely discretionary, I see. And so how do you know when you're looking at a particular market? Now, you're looking at the news flow here. How do you know if a market has already factored in the prices, the expectations, or is underpriced? And what determining factors do you use to go long or short?
See, there are various situations, but let's start with the easiest one. If the news in question is something that has never happened before, that wasn't really on the table or on anyone's radar before, for example, Iran or Israel rather attacking an embassy in Damascus, well, that's something new. That really wasn't on anyone's radar, and that potentially will impact oil and gold positively, both of them. So that's something that's very easy, because the only thing that needs to happen is you need to be in front of the screen and awake when it happens, and then you need to click as fast as possible. Even if you do the trade, and let's say you do it and it doesn't work for some reason, maybe you misjudged, maybe other people don't care about it, maybe people don't think it's that important, then in that case, what happens? Okay, you paid the spread, maybe the price even goes against you a little bit, but it's still but it's still an opportunity that has a very high risk return. Because if they do care, if it does work, it will go up sensibly, materially, let's say maybe 1% for each of them, in the case of oil even more so. And if it does go against you, yeah, you'll have paid the spread and it will go against you. But provided there's nothing else happening at the same time, you won't lose that much. So it's still an opportunity that you have to try.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
On your website, you have a quote here. It says, identify situations where market pricing diverges from the fundamental valuation for a period of time, which can range from seconds to weeks. So what would be, give us an example of a fundamental valuation. You mentioned the gold market or the oil market. What are you looking at for fundamental valuations?
This sentence applies more to Forex and equities than gold. Gold is a bit more complicated because people who buy gold, okay, let's start with Forex and then go back to gold. What is Forex? The biggest players in Forex do it for 2 reasons. Either for corporate purposes, because they need to invest or to buy things in a specific currency. And as far as investing goes, it's the carry trade. The carry trade can be used to give you a valuation, a value for a Forex. If you know the 2 interest rates for both of the pairs, and you have an idea of where they should go, then you have an idea, then you can deduce an idea of how much they should move, provided you are right about the move regarding the interest rates. In equities, it's the discounted cash flow method. If you have a very, especially if you have the benefit of a very precise understanding of what valuation is and what drives it. And by the way, I've written an article about this that goes into great detail that you can find on Seeking Alpha if you type my name. I think it's still in there, where I describe mathematically how you get to these drivers and how important each one of them is. In the case of equities, it's re-rates and then the projected growth. Once you've identified the driver, if something happens in the news flow that you think will affect one of these drivers, then first, at least you have an idea of the direction, so you can do the trade. And once you do the trade, you can start thinking about, okay, I'm in the trade, how much is this supposed to impact my instrument exactly? You can never really tell, but you do have an idea. For example, I've done my statistics, so I know that each time the projected growth of the EPS of the S&P 500 goes up by 1%, as measured by the consensus from the sell side, which you can find on Reuters, the S&P itself goes up by 3-4%. So once you do this, you have all of the sums that you can apply to all of the instruments.
Are you figuring that the market is efficient and that it's has priced in everything up until that point? So, because you say you don't look at charts, so are you assuming the market is correct and is not overbought or oversold?
If you are going to trade something, especially over very short terms, you have to assume that the market is efficient up to that point. However, if you are wrong about that, then what will simply happen is the situation that I've described on the oil trade. You will get in, and it will not move the way you want it to move. Maybe it will move against you a little bit. And that's when you have to understand, to decide whether to give up or to pursue it a little bit. Usually giving up is the right answer, because that just means that either enough people have already paid attention to this, or it means that the other participants of the market do not share your judgment with regards to the event that just happened. They might end up being wrong later, which happened, for example, with the Fed right now for me. But at least for the short term, it's best for you to give up and come back later. For example, when another guy from the Fed will come and do a speech that goes along the same direction, you can try again until it sticks.
What indicators are you looking at to see if it sticks? I mean, do you say you use mathematics, right? So, I mean, do you calculate, like on paper, calculator on what the price should be based on all your inputs, and price that you're going to use to maybe get out of your position?
No, for the target price, as I mentioned before, I've done the statistics, so I have all of these rules of thumbs for all the drivers, for all the instruments that I trade. For example, I know that if the Fed funds rate goes down by 25 basis, the dollar yen needs to go down by 1%. This one is always the case. This one is extremely reliable, so I gave you the most reliable example. So like, what is 25 bips? 25 bips is exactly one rate cut. So I know that if tomorrow something was said that would allow us to price another rate cut, I would know the dollar yen needs to go down by 1%.
You have another quote here on your website. You say, "We observe that the market efficiently prices new information relating to macro fundamentals over time, but not instantly." So are there markets that are more efficient or less efficient at pricing these in? And what kind of time frame are we looking at to price this in?
There are definitely differences in efficiencies between markets. I would say the least efficient market is probably the equities index. Equities first, and then the indexes second. Yes. And I would say the most efficient market is the Forex one, by far. The Forex one, especially on well-telegraphed events, for example, planned events like central bank meetings, when the change happens, even if it's a surprise, it will get priced within seconds. That's frankly not something that you can profit from, or it will be extremely difficult, because the problem with this sort of events is that even if you're fast, you still have to deal with the slippage that comes with the brokers and all. So these are opportunities that don't really exist. However, in equities, there's a lot of times where the market is extremely slow at pricing even stuff that should be done, and there are reasons for that. It's because the market structure in equities is very complex and very diverse. In equities, you have a lot of volume that is options today. You have the futures, you have the equities themselves, then you have the ETFs. So for all of these things to move the right way and to go to where they have to go, there's usually a lag, and that's why you can actually profit from it.
So can you give us an example of a fundamental event occurring in equities, say like an interest rate cut or an interest rate increase? And how do you make your plans to go long or go short equities?
In my case, I will actually predict it. So I will come before it happens, and I will decide beforehand if they are going to surprise and be more dovish than expected or not. So if I do think that that's the case, and if I, after looking at how the market has moved and what the sell side is saying, that's also one way of appreciating whether a market has priced something or not. It's simply to look at what the sell side is saying. If all of the banks on the sell side are saying that the market is already expecting a rate cut, then there's probably not much for you to do, because it's already been either front ran or it's already done. Absolutely have to come before this stuff happens, not only before it happens, but before it becomes consensus. Because sometimes, especially with the Fed that we have today, unlike the Fed that they had in like the 90s, this Fed likes to telegraph everything. So if they intend to cut, they will come several months before, and they will start sending these guys to do speeches where they will guide you slowly towards the outcome that they want. They will tell you, we see that inflation has, we are happy about the path of inflation so far, so we can consider a cut. Then another guy will come and say, so you can't just wait for them. You have to come beforehand. You have to understand what they care about in terms of inflation plan, and then you have to understand the path of inflation, and you have to decide whether you want to do the trade or not.
So with stocks, since the Fed telegraphs pretty early on where they're going to go, does that run into conflict with your holding periods being so short? Because if you want to take a position, presumably you have to do it quite some time before everybody gets on board with a consensus, right?
Exactly, but sometimes for people to get on board with a certain consensus, it takes like a week or more. Mm-hmm. Let's take the most recent Fed speeches as example. This quarter, we had 3 successive inflation prints that were hot than expected. However, the Fed had misjudged, but had telegraphed already in December that they would cut, okay, before seeing the prints that we had. So we got the first print in January, and it was hot. We got the second one in February, and it was also hot. And we got a third one, and it was also hot. But the problem is that by the time we got the third one in April, the Fed had still not changed its communication at all. And that's why the market didn't start falling until very recently. So they should have started doing this, but they didn't. And the sell side also didn't, because one thing that people have to understand about the sell side is these guys are not incentivized to take risks, in their opinion. Now, of course, you have a couple, what I like to call lunatics, that are always on the bearish side or the bullish side. I don't know if you remember the Morgan Stanley guy, Mike Wilson. I think he was let go recently. But this guy's gimmick was to be always bearish for his whole career, essentially, I think. So these are exceptions, but most of the regular guys, they will always try to stick to the consensus. They will never take risks. So because the Fed itself was saying in December that we will cut, even though the data was clear to everybody else involved that they should change that stance and move to something, if not more hawkish, at least more neutral, nobody had the guts to do that. And this was an opportunity for a patient trader, especially after the third print. If you just came and shorted, I did that, and that worked very fine for me. The Nasdaq finally started falling for once. What didn't work for me was gold. I'm still trying to understand why not. But yeah, these are how these opportunities form. You really have to be on ball, always following what's happening, and always aware of what others are thinking. And I really think, just to answer a question that you asked me before, just to repeat it, one of the best ways of understanding where others are is simply to look at the sell side. Don't try to, look at the price or look at volume or try to conjecture something. Just look at what the side is saying. Because what you have to understand is that the sell side, every morning when they release a paper, they are calling all of their clients who are big money managers to tell them, hey, these are our ideas. Would you like to follow them? And every hedge fund manager has his favorite sell side guy who he copies more or less, or who he takes a lot of input from. So they are indeed quite representative. And I would even add a little trick of mine. For every market, there are like 2-3 sell side banks that you have to follow. You don't have to follow all of them. For example, if it's in equities, I would say you are fine if you just follow Goldman Sachs and Morgan Stanley. These are the only ones that you have to follow. If you are trading gold, you have to follow UBS. If you are trading oil, you have to follow Citi. So, because they are the most widely followed analysts in their respective asset class, and they have the biggest clients in that specific asset class. That's why you have to listen to them, because usually their clients will be in line. The thinking of their clients will be in line with what these guys are saying.
It sounds like then you look for discrepancies between what the data is showing you that what should happen, and then what the sell side is saying what their view is. And when you see a great discrepancy, when something doesn't line up, like you did recently with the interest rate increases, then you're more emboldened to be a little bit of a contrarian.
Definitely. Oh yeah, definitely. That's the case, especially if you. I mean, being a contrarian is especially hard these days post-COVID, because the CTAs are so big today. They have a huge market impact, and these guys they don't really read the news. I'm not even sure they know how to read. I mean, it's just robots doing statistics-based trading, momentum-based trading, which is just some form of statistics. I know they like to put a lot of words behind it, like machine learning and all that, but it's just linear regressions, more or less. The problem with these guys is they don't read the news. They don't care about the price. They don't care about valuation. But the only thing that they care about is their own P&L and sometimes volatility. So these guys make being a contrarian very, very hard. You still have to time it really well. For example, we were talking about the recent interest rate increases. In bonds, these interest rate increases materialized as soon as January, February, interest rates were already rising. However, the Nasdaq was still going up every day, and so was gold. And why? How come? Well, it's because of the CTAs. The CTAs, they found a momentum trade in the Nasdaq, so they pile up on it every day. And the only way you're gonna get them off that is if you hit their P&L a little bit. But for you to hit their P&L, you have to be really patient and wait for an event. In this case, it was the speech by Powell himself and no one else. That was the only thing that was powerful enough to move the market or to motivate and incentivize the people in the market who do care about fundamentals. So that would be the other macro funds, to come and start selling the Nasdaq a little bit, enough to do enough damage on the Nasdaq so that the CTAs themselves need to start selling. That's what happened recently, and that's why we have this 5% drawdown in SPX, which to some old-timers might not seem like a lot as far as drawdowns go, but it actually, given the market structure today, it's actually quite something.
One of the you mentioned that you read Market Wizards' book, and one of the people in the Market Wizards that you followed was Colm O'Shea, a macro trader. And he has a quote. He says, trades only matter when people care. So in this case, are we talking about the CTAs who are driving the price up, irrespective of interest rates? They suddenly care because their portfolio dropped somewhat, even though they're not paying attention to the news, and that could be a catalyst then to get the ball rolling to the downside.
I would modify his quote a little bit just to make it work for today. It's not when people care, when the right people care. When the right people care. In this case, the right people, the only one about the fundamentals are the huge portfolio managers. For example, the people at BlackRock, or the people who handle the funds for the teachers, CalPERS in California, and then the other macro hedge funds. What I had to understand and accept about these guys is that they are not over traders. They hate trading. In fact, the less operations they have to do, the better it is for them, because they always see through the prism of fees before performance. Since they move such a huge portfolio, fees matter to them a lot. So in order to motivate these guys to do something, you really have to give them something big, a big scoop. So once these guys moved, the Nasdaq fell enough so that even the CTAs who don't care about what's happening in the world saw that their trade wasn't working anymore, that they were losing money every day. And then they said, okay, maybe I should take some off. And that's how you get the ball rolling. Part of what I do really is to be more and more, and I'm always trying to get better at it. It's to be really aware that there are different market participants that have different market impact. And this market impact, unfortunately, is not correlated to their size. For example, the retail people, the Wall Street bets guys, these guys don't have a lot of money. But because of the way they trade, since they always hit market trades in options where you're not actually really supposed to do that, their market impact is huge, given the embedded leverage in the options and just given the way they do it. However, if you think about something like someone like CalPERS or BlackRock, they are huge, but the way they trade, they don't open their IBKR and say, okay, buy, market rate. No, they will ask a bank to buy for them 1 billion of SPOOs, and this 1 billion will be bought over 2 or 3 days, and it will be done slowly along the VWAP, and the banker will make sure that the average price that they will get will be below the VWAP if they are buying, just to justify, hey, okay, you told me to buy 1 billion, I did it in the best possible market conditions. And as you can see, I am below the VWAP, so I got you on average a better price than what other people who have been buying during the same period have had. And so as a result of that, your fees will be low. Okay, will be lower, and your market execution fees will be lower. This is like the sophisticated way of trading, which is based around minimizing market impact. They want to buy with moving the market. The Wall Street bets guy, the retailers, they don't care. They just buy at market rate. And actually, it works for them because when they buy in this savage manner, that's basically how you can qualify it. What they are doing is they pump the price, and it becomes a signal for other like-minded people to come and take more options and do it even more. So that's sometimes you have to also think about this. Like, what signal do you want to give?
I see. And what are you seeing right now in the market? We just had a drop here a number of days ago on Monday, April 15th. Due to war jitters in the Middle East. Do these speculators that you're referring to, does it work to the downside too? I mean, are you seeing them take off their positions and now go net short?
No, as per what I've seen from the sell-side papers from Goldman and the GPM, it's clear that the latest bout of downside that you saw was the CTAs taking some profits and calling it a day for once. They've been long the Nasdaq for a very long while, more than 6 months. For the what a happy bunch! But now they've taken a couple of hits, so as a result, they had to degross. That means reduce their exposure. That's also why if you look at what's actually underperforming in the market, you will see that the Nasdaq is falling more than the SPX and even more than the Russell, even though the Russell is usually more volatile than the Nasdaq. Well, why is that? It's because the CTAs, they weren't long. The Russell was flat year to date. I think now it's even negative year to date. What was winning, what was working, where the momentum was in the Nasdaq. So that's why you see the Nasdaq falling more than the other things. And I think it was entirely due to CTAs. Now the question is, are they done? Can we get in? Probably. I think if you take a look at what's coming later, the events that are coming later. Next Friday, we have the core PCE, which is the inflation measure that the Fed cares about. Personally, if I was someone involved in government, I wouldn't care about this measure at all. But that's the one they care about. It's also, you have to be honest, the one that gives them the best look in terms of what they are doing for the public. So that's the one they care about. That's what they've decided, and we have to follow that. Well, I predict that this measure will probably show something close to 0.2% month-on-month increase. And if that's the case, anyone who I think buys the NASDAQ or SPOOs at these levels, by Friday will probably be happy. I'm going to be trying that myself. So
I see. So from what you're seeing in the data, you're seeing that a potential oversold condition based on potential data coming out, and it looks slightly more bullish to the upside for you.
It looks bullish to the upside, be it for equities or for interest rates, which have been for bonds, which have been sold quite a bit. The justification for why they've been sold is actually valid. It's just that it should have happened before. But now I think things are turning, and it seems that inflation will indeed go down, or at least go back to a path that is acceptable for this Fed. And that's why I think that anyone who is still short bonds by Friday will be regretting it if he doesn't take his profits. And that's why personally I'm a buyer of SPOOs bonds, and I would even be a seller of the dollar against certain pairs. Dollar yen comes to mind, but I think out of these three trades, SPOOs and bonds would Nasdaq and bonds would probably be the best ones to try if you had to try any of them. Again, for disclosure, I will be doing that.
Another quote by Colm O'Shea in the Market Wizards book. He says, bull markets are more psychological than fundamental. So have you found...
a lot of things that Colm O'Shea was talking about, I don't think they apply today. This one is probably one of them, because the CTAs, they are not really psychological. It's just what they do. They find something that goes up and they buy it, hoping they will keep going up. They don't get out of it until it starts going down a little bit against them. Or they have a preset stop loss if the trade never works. I think it's a very silly strategy, but from 2021, 2022, and 23, it has worked really well. They've been lucky. Like it was a strategy that had severely underperformed up until COVID, but suddenly it's been working for like 1, 2, 3 years. And what happens when you have a strategy that works for 1, 2, 3 years? Well, every other fund wants to do this strategy. They say, that's what we have to do. It's where the recency bias is very strong in the industry, unfortunately, even though every advertisement in the industry has the disclaimer below that says that past performances are not indicative of future performances. Apparently, they don't really believe that. So, because the CTAs have worked so well, there's so many of them, I, for one, would welcome the day when they die again. I don't know what it's going to take to do that, because I really think they hurt price discovery a lot. And I think they even hurt some aspects of the real physical economy for people. Let me give you an example. Cocoa prices, 11,000. Up many percent. Does that have anything to do with the supply situation in Cote d'Ivoire? No, it doesn't. No, yes, we have a drought. Yes, we've been having droughts everywhere in Africa. That's never given us this kind of price for cocoa. We've had way more droughts that were way more severe. That never did anything like this. What's happening? What's happening is that all of these CTAs are saying this thing that they don't even care what it's called. Could be called cocoa. It could be called X. They don't care. They just see it goes up. Okay, if it goes up, I'm gonna get in. And because cocoa is such a liquid market, that's not really supposed to be the host of this kind of big volume trading from the CTAs. It moves up, and that's how you end up with something like this. Same happens in Nasdaq. Same happens in gold recently. That's why gold is up 17% this year, even though on the geopolitical front, it's stalled. Like it's whatever was supposed to happen is dead, because Israel has more or less given assurances to the United States of America that they are not going to retaliate in a way that will cause anything severe as far as reactions from Iran go. As proof of that, you can check oil. Oil has already gone down. So the geopolitical risk premium is clearly out of the way, or at least is in the process of being taken out of the way. Yet gold is at the highs of the year. At the same time, interest rates are at the highs of the year. So why is gold here? Gold is here because of the CTAs. Yeah.
Let's get into your fund's performance. I noticed on your website that in the first month of trading in May 2020, you came right out of the gate with a fantastic 41% return. And by August of 2020, you already had a 152% total return. What factors went into these incredible returns?
Well, that's very simple. My specialty happens to be US politics. And I had just understood before everyone that Biden was going to, and I just put on the implications of that, and which was basically to buy the Russell instead of anything else. That's worked tremendously well for me. So sometimes when there is something that important and there is a big prediction like this that's going to give you a lot of change, you can make a lot if you guess it correctly.
So when you see an unusual event unfolding that is not, it's not typical, do you change your weighting of your position sizing?
If it's something that's really strong, they would definitely incentivize me to put more size on, for sure. Now, one of the reasons why my returns have scaled a little bit lower over the time, it's also because as a request from clients, I've been told to lower volatility. It's just something that I've been requested to do. So I've been using less size than before. And what happens is that among my clients, those who still want the bigger returns, they can just decide to copy my fund, but to leverage multiple applied to it. So I have some people who have 3 times the return of my fund or 2 times the return of my fund, provided they can manage the volatility and accept it. So that's basically how we work it. But yeah, if it's something new and you understand that it should be important, that it should have an impact, yeah, you have to put on size. You have to be brave. I'm not the bravest trader there is, far from it actually. But on such, I've had the insight and intelligence to raise to the occasions for the couple occasions that I've had.
How much of your trading is, if any, is done on personal kind of feeling, gut instincts versus just pure quantitative data analysis?
Very little is on gut instinct. It's really all of it is news flow. I mean, people wouldn't be able to. For people who follow me on Twitter, they can easily see that each one of my trades corresponds to a news item that I usually post about, and sometimes with a little analysis following it. So it's really news flow driven. Now, once I have the news flow, I have to be quick. So sometimes it's not perfect and I get it wrong. But if I do get it wrong, I just take the loss and wait for the next opportunity. The main thing for me, especially today that I already have a bit of AUM, is really to stay alive, increase AUM, and try to keep returns that make all of my clients happy, which is something along the lines of an average of 3 to 5% per month on average. As long as I can keep doing that, I think everybody should be happy, and I can stay alive and maybe even increase AUM at some point. That's basically what I got to. My trading has gotten a lot less riskier than it was at the beginning, for sure. Yeah,
I see. If it sounds like you're somewhat constrained by investors' requests to lower risk, so does that hamper your strategy in any way for the big games?
I definitely am. Yeah. Today I wouldn't engage in anything like that at all. I know as soon as I do that, I'm gonna have 26 messages from people who are either angry or scared or both. Especially if it's not working. I have demonstrated that I can get myself out of very heavy drawdowns. I've had drawdowns of 15%, 20%, and I've always gone out of them and gone back to new all-time highs. So I'm personally not that worried about it, but clients don't like it. And these days, I don't think I've had more than a 6.5% drawdown in a very long time. In a very, very long time, I think that, and I intend to keep it that way.
Have you ever thought about automating your system, or is it possible realistically to automate what you do?
It's not. It's really not. It's really not, because the kind of inputs that go in are not entirely quantitative. And even if you were to use something like generative AI, like if you link it to ChatGPT, it probably still gives some very funky results. So no, I think discretionary trading, unlike other forms of trading, will stay in the realm of humans, and is not something that you can replicate automatically at all.
I saw your performance graph from November 2023 till today, showing that you average about 17 trades per day. However, on this last Monday, April 15th, with a sharp market decline in response to war jitters in the Middle East, you had 57 trades. What were the catalysts to trigger all these trades?
No, what's happening here is simply that I sometimes send trades over multiple trades. For example, if I'm going to buy the NASDAQ, I'm going to do it in 4 times instead of 1 time. That's just something that I've had to to do as client size grew, because some clients have really big accounts upward of 1 million, and the broker won't let me buy the required amount in one strike, so I just do it in 4 strikes. So what you identify as like 57 trades is probably you have to divide that by 4 to get the real number of what it is.
Oh, okay, great. Do you have any goals in the next couple of years for your fund or for this learning process?
I'm always hoping. There are a lot of questions that I still can't answer. For example, I would really love to have a better mastery of certain market participants. To me today, the 2 market participants that really make huge issues for me are number 1, CTAs, and number 2, retail. If they could ban them from trading, I would be very happy with that. But we can't do that. Especially since the CBOE is very, very happy with the 0 DTE trading that they've introduced. It's given them so much volume and so much revenue that they didn't have otherwise. So I assume they are here to stay. So I am definitely trying always to understand or have some sort of framework, or trying to build some kind of framework which would help me understand that. And as far as doing that, I am definitely closer to achieving that with the CTAs, who at least have rules that you can more or less guess or replicate or approximate, than the retail crowd. The retail crowd is really trading out of gut trading. It's entirely psychology. It's groupthink. I fail at these things. I'm not even hoping to follow them. I'm just hoping to avoid them. That's basically I just don't want to be involved in a situation where they will be against me, because I stand no chance, given how savage they hit something when they want to hit it. They don't care about price. They don't even care about the price of the volatility or the calls that they are buying. As long as it works, they buy, and that's all. Yeah, that's what makes them so potent.
Did you follow the meme stock craze?
I did. That's exactly what I'm talking about. And it might have started with GME, but what it showed them with GME is it showed them what they were capable of. It showed them that if they ganged up on the market, even on big indexes, that they can do things. I remember a day during the GME saga where they decided that silver had to go up, and they managed to send silver up 7% in a matter of 1 hour. Why? Because silver is in the liquid market, and we're just buying enough. And these guys actually have money. That's something that people don't really understand. Who are these guys? These guys are, most of them, a lot of them, many of them, they are people who work in tech, mostly in California. Actually, my nickname for them is California boys. Because these are guys who work in tech. They have huge compensation over there, and they have more money than they know what to do with. And they are big gamblers. That's something that perhaps even they didn't know about themselves, but they happen to be huge gamblers. And they love doing this stuff. So they have money. Like, it's easy for them to put 10, 20, 30, 50 grand on a call. But what you have to understand is that 50 grand on a call is something a hedge fund could do too. It's not that far away. You could have a hedge fund, call Goldman or a smaller bank, and ask them to put 50 grand on a call for something. That can happen. So this is like real money, and it's done in a way that impacts the market as much as possible. It creates a reflexive effect. I'm really always trying to understand and study and like try to find a way to, as I said, like not even follow them. I just want to avoid them. I just don't want to be in the way. I don't want to be a victim. If you remember during the GameStop saga, a lot of hedge funds were victims of these guys. I think there was one very big prominent fund of someone with huge credentials from Citadel and so on. And he got trapped and he had to close his fund because he was like more and more interested in. And, one of the biggest mysteries for me in this whole zero DTE retail saga is how exactly are they being hedged in the market? Like, who is on the other side of their trades? Normally, it would be Virtue or Citadel. It's plus Jane Street. These are the 3 high-frequency firms that can actually do that. But how are they doing it? What are they doing with that stuff? Because we know that Citadel has a hedge fund and is a market maker at the same time. They will tell you that they have a Chinese wall between them and whatever, but that's what they say. What are they doing with this data? how much money is Citadel making these days? Well, turns out Citadel is the best hedge fund these days. I think last year they made 16 billions in profits, which is huge for them. So it's a real mystery, and I'm still trying to understand how to get around it. And same goes for the CTAs. Now, the CTAs, I know it's a cyclical thing. It's just because they've had a good run, and it's probably not going to last, especially if we have Trump as president. But it's still important for me. So like these are the two aspects that I'm trying to enhance with me. It's not really the macro analysis or predicting or that. I think I've mastered that as much as possible. Today for me it's really about understanding other market participants who don't care about the stuff that I care.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
Mm-hmm. So these market participants sounds like they're distorting the natural fundamental news that would give clearer signals without their participation.
Oh, definitely.
Mm-hmm.
They are a problem. They are a problem, but at the same time, given how the legislation works in the US, given how much someone like Ken Griffith from Citadel has, with so much sway over the US legislators, he's basically a huge campaign donator on both sides. I don't think it's ever going to get fixed, which is funny because in the US they didn't even allow sports gambling for such a long time, and now that it's something important, they don't care about it. Why? Because the people in charge will not go against the hands that feed them. So they are here to stay. They are here to stay. Actually, if they weren't here to stay, they would never exist. Because in Europe, I might be wrong, but I don't think so. 95%, I'm right. There is no zero DTE in all of Europe. There's no such thing as a zero DTE option for Europe. Or if you had to do it, it will be OTC. And it wouldn't be like exchange listed like in the US. So it will be something that your banker would make for you as a favor or as a product that they sell. And that tells you something. It's because here the regulators are a bit more free, and they see that something like that is going to be, as you said, a problem to the primary or societal function of the market, which is to give us real signals about the price. Zero DTE and CDAs are how you end up with the situation in cocoa and on a few other iterations, such as the Nasdaq going up every day and GameStop and a lot of names, silver at some point. And if I was personally a legislator, I would get rid of it. But that's not how the world works. The world doesn't resolve around me. I have to adapt to it, and that's what I'm trying to do.
So what do you think about going into business as a cocoa grower? We can capitalize on this big run up in prices.
You can definitely do that. It just so happens that cocoa doesn't really. Actually, some. I just read that some Swiss chocolate makers will do just that. They are getting in growing their own cocoa because assuming the prices stay here, which I don't think they will, because it makes no sense. They can do it, but actually there's a very limited area in the world where you can grow cocoa. And I think what will really happen to the prices is in at most a year or 6 months, because right now I don't know if you've noticed, but the price for chocolate hasn't really moved that much. If you go and try and buy a chocolate bar, the price haven't moved. It's because they still have inventory. At least that's what some senior management at Nestle said, and I believe him. But what will happen when they have to sell you a chocolate bar with these new prices? I think what will happen is very simple. People will just not buy it. No chocolate for you, my son. How about some fruit? That's basically what will happen. That's how prices will go down.
Well, I think the price will have to go up a lot for me to stop eating chocolate. I'm pretty addicted. So,
okay.
Yeah. So, wrapping up, what do you struggle with most as a trader?
Man, I struggle with a lot of stuff. It's a daily struggle from every day. Really, it's just trying to remain consistent and to perform as well every week in, week out. That's what I'm trying to achieve. I'm not there yet. I mean, yes, I have a fund that has returned more than 1,000% since 2020, but I don't believe I'm there yet. I'm still trying to improve that. And one way I'm doing that is I'm working on my environment. I'm working on commodities, on amenities, on making on having a healthy lifestyle. That's also something I'm working on. Might seem simple, but try to have a healthy lifestyle with the hours that I'm putting in. Sometimes you have to sort of put boundaries between work and the clients. In my case, because I have clients, I'm not just managing my own money. That's basically a struggle. I'm still trying to figure out everything, and I promise when I do become something close to what I consider perfect, I will come back and tell you how I did it.
Well, great, Saad. Thank you for coming on Chat with Traders.
Thank you. I hope people will enjoy what I said. Will learn from it.
Fantastic. Great. Saad, how can our listeners get in touch with you?
Oh, they can get in touch via my website, via email, via Twitter. That's basically it.
You can find Saad's contact details in the show notes.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
I am a gold bull, by the way. If we're getting into confessionals here, it's something that I've traded and I've followed, for in many, many years. But what's going on is pretty interesting because the gold breakout, normally, by the way, the dollar is extremely strong. The dollar is in a huge bull market. And usually when that happens, gold is not in a bull market. If you get dollar strength, you'll get gold weakness, usually. But that's not the case now. So that makes this breakout kind of unusual.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Hello and welcome to Chat with Traders, episode 280. This is Tessa Dow, Ian Cox's co-host. who you will be hearing from very shortly, interviewing our special guest today. Our guest is Professor Steve Hanke. Many of you know Professor Hanke as an economist and professor of applied economics at the Johns Hopkins University in Baltimore, Maryland. Professor Hanke is known for his work as a currency reformer in emerging market countries and served on President Reagan's Council of Economic Advisors. Very recently, Washingtonian magazine recognized Professor Hanke in their annual list of Washington, D.C.'s 500 most influential figures in shaping public policy. And did you know that Professor Hanke also trades? He had his first exposure to the markets and started trading commodities when he was just 14 years old and started learning the importance of closely following macroeconomic factors which impact the prices of currencies, commodities, and consumer goods. Professor Hanke's evidence-based approach uncovers the deeper forces driving inflation and market fluctuations and challenges prevailing narratives as it relates to economics. By exploring macro topics often overlooked by the mainstream, Professor Hanke broadens our collective understanding and invites us to think more deeply and critically about the economic forces shaping our world. Now, without further ado, ladies and gentlemen, we are so honored to present Professor Steve Hanke, currently in Baltimore, Maryland.
Hello, everyone. I would like to welcome Professor Steve Hanke of Johns Hopkins University. He is a professor of applied economics, and he served on former President Reagan's Council of Economic Advisors. Professor Hanke, welcome to Chat with Traders.
Ian, great to be with you.
How are you doing? And where are you right now?
I'm doing very well. I'm today in Baltimore, Maryland, and it's 88 degrees Fahrenheit, probably the warmest day we've had so far this year.
Wow. Sounds, broiling over there. So let's dive into your background. Kind of where did you grow up and how did you get exposed to the financial markets?
I grew up in rural Iowa, southwest Iowa, and was exposed to commodity markets almost from birth because that's what happens in Iowa. You grow corn, you grow soybeans, you grow alfalfa and bale hay, hogs, cattle, you name it. But my real introduction came actually over more or less 70 years ago. And that is my grandfather had a big egg operation, and they would collect the eggs from the farms, bring them in, candle them, sort them, grade them, clean them, and put them in cold storage until they had accumulated a semi full of eggs to ship back to New York or Boston. And that there was a time interval between the time that you put the eggs in storage and the time that you actually ship them back east. As you know, with any commodity, as time goes by, there's price risk, prices going up and down and so forth. In those days, the Chicago Mercantile Exchange had an egg contract, futures contract. And so if he didn't want to take the price risk and the price looked pretty good, he'd sell the eggs forward. And so I learned how to do that with my grandfather. I was about 10 years old. And then by the time I was 14, I did open my own trading account and was trading what? Commodities, mainly soybeans. So it's just part of life there. I mean, it's all based on agriculture and agricultural commodities of one sort or another.
Mm-hmm. So at age 14, they allowed kids to open up their a trading account?
Well, they did. This was probably be illegal today, but anyway, I opened an account, had no problem with it. I knew the local who was the broker for the brokerage outfit at that time.
Maybe you could share with us what has been the most memorable trade that you've ever done.
Probably several, but in 1985, I became chief economist at Friedberg Mercantile Group in Toronto, which is the biggest commission merchant, or was at the time anyway. I think it still is in Canada. Al Friedberg established that and still is the head man there. and a great trader, one of the Canadian billionaires. At any rate, I had modeled the oil cartel, OPEC, and had concluded that OPEC was going to collapse and oil was going to go below $10 a barrel. And that was in late 1985. And of course, in 86, it did exactly what I anticipated it would do. So it was a huge trade, and we had massive short positions on crude. After the fact, we found out that we had about 70% of the short interest in the London market.
Wow.
So we had very big positions. That was a pretty spectacular. And then there were others. The collapse of the Russian ruble in 1998. I actually had given a speech, I think it was in February of 1998 in Vienna, and I observed that the net foreign asset position of the Russian central bank was going down very fast. And to compensate for that decline, the net domestic assets were going up on the balance sheet very fast. And that, when you see that kind of thing happen, you know there's trouble in the winds. And I indicated that, and a Reuters reporter happened to be reporting on the thing. The minute the thing hit the wire, the ruble went down 3%. And I knew I was onto something, and so obviously put some short positions on, and the ruble did collapse spectacularly in August of 1998. You probably remember that. I mean, it was a pretty big deal. So both of those were big international things. OPEC collapsing, oil prices going below $10 a barrel in 1986. That was a big deal. And then the ruble in 1998. But there have been other trades. In 1995, I was a president of Toronto Trust Argentina in Buenos Aires, and that was the best performing fund in the world in 1995. So that was not one trade, but the portfolio was a big winner. It was the best one in the world.
Great. Thanks for sharing. So I'd like to dive into the Fed's decision on interest rates yesterday. I'd like to get your thoughts on this interest rate decision, and where do you think we go from here?
Well, the Fed basically said that inflation is pretty sticky. It's not going away because we've had basically three months of kind of sideways movement in the consumer price index in the United States. It hasn't continued to fall as it had been falling. So Chairman Powell said it's going to be higher rates for longer, kind of steady as you go, no change. And if you look at the futures market for Fed funds, it looks like the Fed funds futures market doesn't anticipate anything until probably getting into the fall sometime. So they keep pushing back the timeline for when they expect the Fed to lower the Fed funds rate. Now Powell did indicate that they were going to back off the quantitative tightening, that is reducing the size of the balance sheet and the government bond runoff that they've had. That is a loosening. So he's talking about staying the course with the Fed funds, but in fact loosening a little bit on the quantitative tightening. So that's what he said. And we don't know when he will change because the Fed is data dependent. They just look at the daily data and see what's happening in the various markets. And then they decide, it's basically a finger in the wind operation. Are we going to tighten or not? So you don't know what they're going to do. They can pivot tomorrow one way, and then the next day they'll pivot another way, depending on what the data are saying. This is a wrong-headed approach. They should be looking at the quantity of money, which they're not looking at. They're not paying any attention. They look at what they call a financial conditions indices. They have a bunch of financial indicators on interest rate spreads, shape of the yield curve, all of this kind of stuff, which all these data points are looking at are moving around, but that movement is caused by something that happened prior to those changes, and that's determined by changes in the money supply. So you have to embrace the quantity theory of money, that money is the fuel of the economy. If you goose it, the asset prices are going to go up, commodity prices are going to go up with a lag, and then another longer lag. Economic activity is going to start changing. It'll go up, and with even a longer lag, inflation is going to start moving. So, so where are we? As I see it, we're in a situation where the money supply has actually contracted since early 2022. It's gone down. I mean, it's smaller now than it was back in 2022. This has only happened 4 times in the United States. You've got to go back into 1949 to pick up the first time you got a contraction, and of course that was followed by a recession. And then you go back to 1936, 37. There was another contraction that was followed by a recession. You go back to 1929, 1933, and of course, you had a huge contraction in the money supply and a Great Depression. And then the fourth one, you go back, I think it's 27, 28, I can't remember for sure. But you had a recession. So all these contractions do what the quantity theory of money tells you or anticipates the contraction should do, and that's caused a slowdown. And that's why I can say with confidence that a slowdown is baked in the cake in the United States because of what happened a year and a half, 2 years ago, 2.5 years ago with the money supply, contracting. So we anticipate, John Greenwood and I do this work together. John is a fellow at the Johns Hopkins University at my institute for applied economics, and was for many years a chief economist at Invesco until he retired a little over a year ago. So economic activity slowdown is baked in the cake. The other thing that's baked in the cake is that we will eventually start moving down again with prices. The consumer price index, it'll start going down, and we will get down to that 2% inflation target the Fed has. Maybe it won't come by the end of this year, which John and I originally thought. Maybe it'll be a little bit longer. But you have to remember that the tricky thing about this, Ian, is that there are long and variable lags between changes in the money supply and changes in all these indicators. So to put your finger on exactly when something's going to happen is kind of a fool's game. But you do know it's going to happen. That's why the baked at the cake thing comes.
So why is the Fed engaged in this quantitative tightening? And how much of the decrease in the money supply is attributed to the Fed's actions versus the banks not lending as much as they used to? From my understanding, banks are primarily responsible for the majority of new money creation. So how much blame can we put on the Fed versus the banks, and why are they doing this?
The Fed's policy framework it influences the banks. So the Fed's always behind the curtain, either directly or indirectly. If you look at the money supply, the Fed actually, the base money, what's measured by M sub 0, they're responsible for about 11% of the total money outstanding. And bank deposits, liquid bank deposits, account for about 76%. So banks are the elephant in the room. And then you've got a small retail savings accounts. That's another 5% of broad money, M2. And then money market funds are about 8%. So the commercial banks are a big deal, and they have contracted. They're part of the contraction.
I see.
And now the bank credit is basically year over year, more or less flat.
So do you think that can fiscal policy actually overwhelm monetary policy? Right now with $1 trillion being added to the debt every 100 days.
No, money dominates. Money always dominates fiscal policy. The best way to look at this, the best examples that clarify exactly what I'm saying here. If you look at Japan in the 1990s, for example, in 1990, the money supply was growing at 13% per year. And then it collapsed in 1990 to no growth from 13 to 0. So you had a huge slowdown in the money supply. It was very tight. And ever since then, by the way, the money supply has been growing at about 2 to 4% in Japan. It's been very tight. Now it's growing at 2.5% per year in Japan. Very tight. It's always been very, very tight for, we got 30 years, a little over 30 years. When I say tight, it's tight because Hankey's golden growth rate for the money supply, measured by M2 in Japan, that would be consistent with hitting an inflation target of 2%, is about 5%. So you can see all these numbers I've been giving you, the 2 to 4% range, that's low, tight. 2.5, the current number, is tight. And what about the fiscal side? The fiscal side is loose. The loosest fiscal situation in the world. The debt to GDP ratio in Japan's to about 260%. So you have very tight monetary policy and ultra loose fiscal policy. And what's happened to economic growth and inflation in the last 30 years in Japan? They can't get their inflation rate sustained and up to 2%. It's been generally below 2% all those 30 years, while they've been expanding the fiscal side, fantastic deficits and fiscal expansion. So that is one example where money dominates. The other clear example is the U.S. in the 1990s. The fiscal policy was very tight. President Clinton actually reduced government expenditures by more than any president, in relative terms, by the way, that we've had since World War II. Clinton was very, very tight fiscal. He reduced government expenditures by 3.9 percentage points in his 2 term as president. And the last 2 years of his presidency, he actually ran fiscal surpluses in the United States. So he was a very tight fiscal policy. At the same time, we had accommodative, I think appropriate monetary policy. Greenspan was the chairman of the Federal Reserve, and we had monetary policy running, monetary growth. M2 was running about 6%, more or less 6%, which is consistent with Hankey's golden growth rate, the golden growth rate consistent with hitting a 2% inflation target. Inflation in those years was actually just a little below 2%. So money dominates. The Japanese example in the 90s going forward, very tight monetary policy, very loose fiscal policy. And what do you end up? A slow economy and very low inflation. In the U.S., you had a very tight fiscal policy in the 1990s. I wouldn't say loose, but kind of optimal monetary policy. And you had very rapid economic growth and inflation that was low.
So why is it that from all the economists in the government and Chairman Powell and everything, I don't recall hearing much of anything about the money supply? Why don't they focus on that? I mean, they certainly have a large team of economists, think tanks. Why are they so obsessed with interest rates and not the money supply?
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Well, I think there's several reasons for this. In the Fed system, by the way, there are 785 economists. So they have a lot of expertise, shall we say. I put that in quotes, expertise. Why don't they look at the money supply? Why do they deep six the quantity theory of money? One is that the models that they use are post-Keynesian models for macroeconomics, and they don't include an aggregate for the money supply. So the money supply is not in the models. All these modern post-Keynesian models that most of these so-called experts have been trained in their PhD programs, they don't include money. So that's one reason, the models. And the other factor I think that is important is the fact that out of the 785 economists, the ratio of Democrats to Republicans is 48.5 to 1. So there are more or less 50 Democrats for every Republican. Now you say, well, what's that have to do with anything? Well, I think it has a lot to do with the situation, because Milton Friedman, a known Republican, a Nobel laureate in economics, is basically the dean of the quantity theory of money. He was all his macroeconomic model. The fundamental thing in there is money, and that's of course the model that I use too with the quantity theory of money. So Friedman's kind of, for any Democrat, Friedman is more or less enemy number one in the economics realm. So that's another factor. So it's the modeling, it's and the composition of the political alignment of the so-called experts at the Fed. That those are the main drivers in there, keeping the quantity theory out. It's just out of fashion. It's just not only the Fed, by the way, but all these models don't include money, and all the models are used internationally. Is this not in the United States?
Is that an ideological stance against the theory of money? I mean, is there something about Milton Friedman that they say, well, no, we got to cancel him and just throw out his?
Well, the political part of it, that does come into play, but the modeling part, it really comes at the university level, and as I say, they're post-Keynesian models for the last 30 years have been the order of the day. So that's what the academics produce. That's not what I use, but that's what the majority of the freshly minted PhDs will be exposed to, whether they're in Canada or the United States or the UK or the continent, where you name it.
Mm-hmm. I'd like to jump to the concept of the leverage. And are we in a time period now that could we call this time period the death of leverage? Will interest rates of 5% kill the leveraged economy and investment opportunities?
Well, I mean, obviously, with we had a long time where interest rates were, de minimis, and so we did have a lot of leverage. And as interest rates go up, there's a big incentive to clean up your balance sheet and get those debt ratios down. Because if you don't get the debt ratios down and you're a corporation, you're going to have problems. Because when you go to the bank and the bank's looking at your balance sheet and you look like you're over leveraged, you got a problem. The volatility, you get two things going on. One is that the level of interest rates have gone up, but there's now volatility in the thing. So the combination of the volatility and the higher level of rates is meaning that refinancing or new borrowing by corporations is going to cost you more. And in terms of you want to deleverage, and then also in terms of capital budgeting and just basic capital theory, if the cost of whatever you're borrowing is higher, there are many new projects that don't go over the green light zone. Mm-hmm. So yes, I mean, interest rates, play a role, and it's all wrapped up with capital theory. And as Sir John Hicks, Nobel laureate, once said, there's nothing more important than a balance sheet. So whether you're an economist or a bank or a financial person or a corporate a vice president, CFOs pay attention to this. These debt ratios, because by the way, all the covenants that the banks have with loans that you have all have various limits and ceilings put on these debt ratios, for example. So as interest rates go up and you have to refinance more at higher interest rates, you get yourself into trouble because you start hitting those covenants.
Mm-hmm. Mm-hmm. I'd like to jump to the most recent inflation report, which shows the economy has slowed to just 1.6% annual growth rate. Is stagflation back?
I don't think so. Stagflation, the last time we had stagflation, slow economic growth and high inflation, was in the 1970s, mainly during Jimmy Carter's presidency. And I'm not saying we won't, but it could happen if they. What did they do in the Carter years when we had stagflation? Well, they increased tax rates. Marginal taxes went up. It was kind of an anti-supply side regime, and we do have that in the United States. So that's possible if these huge budget deficits are deemed to be unsustainable, which they are. There are only two ways to fix it. One way is to increase taxes, and the second way is to reduce government spending. That's how you get rid of them. You either reduce the expenditures or increase the revenues you're getting from taxes. And if they go the increased tax route to get the deficit on a sustained basis in the United States, that will definitely put a damper on economic growth. So that would be a slowdown factor. And then the inflation factor is all dependent on the Fed monetary policy. Inflation is always and everywhere a monetary phenomenon. The only way it comes, by the way, from fiscal deficits is if the Fed, or whatever the central bank happens to be in the country you're located in, starts buying the bonds that are issued to finance the deficit. And if they do that, that's called monetizing the debt. It increases the money supply. And if you increase the money supply, you're going to get more inflation.
Mm-hmm. Speaking of inflation, I've heard many people in the past argue that the way the government calculates inflation actually underreports actual inflation, and that the way that inflation is calculated has changed quite a few times since 1980. And my question is, why has it been changed? And do the new changes underreport real inflation?
Well, number one, actually, the Consumer Price Index started in 1919, and there have been lots of changes in the index. And so let's step back, kind of look at the big picture of the thing. The consumer price index is an index, and there are lots of things in the index, or a lot of goods and services in the basket that over 300 items now.
Mm-hmm.
When you have an aggregate and you're trying to you have a lot of different dispersed things, and you're trying to make an aggregate, and we call that an index number. You have lots of judgments that go into what goes in the index. What are you going to put in there? So there's a lot of subjective judgment that goes into it. So that's one thing. Then the next thing is, after you decide what to put in the index, of course, things change over time. Are you going to keep those things in the index, or you're going to keep buggy whips in the index, or and horses and so forth, or are you going to eventually take them out and put cars in there? It's dynamic. It's changing all the time. Then whatever is in the basket, if all those prices of all the items go up and down exactly in proportion to each other, that doesn't pose a problem. But what if they're going up as they do? Some go up much faster than others. Some even go down. So they're moving around. Everything in the basket's moving around. What we call relative price changes are occurring all the time. And so then you have to make another judgment. Well, how much weight should we put on each one of those things in the basket? So you have to decide what's in the basket, and then what weight do you put on the basket, items in the basket. As you can see, it's kind of a tricky business, and it's highly subjective. Now, in 1983, there was actually a big change, because interest rates used to be in the basket. And looking at the consumer price index, or the so-called cost of living, interest used to be in there. So your mortgage interest was in there, credit card interest on loans for cars, for example, that used to be included in there. And financing costs of all kinds of things where interest was associated. Well, now it's out. As a result of that, if you calculated things the way they did in 1983, and you looked at June 2022, that's when the consumer price index peaked out in the United States, 9.1%. By the way, John Greenwood and I, using the quantity theory of money, we nailed that thing. We predicted that inflation might go up to 9%. It went up to 9.1%. But that's the consumer price index, the way they calculate it now. And that's calculated without interest. Interest is not included. Okay, now, what if we do it the way they did it in 1983 and we included interest? That number would have been 18%. It would have been almost double.
Wow.
The reported rate. So yes, there are different ways to calculate it. You get different answers. Now, I think, by the way, I've anticipated this problem in a sense, because I calculate Hankey's annual misery index each year for 157 countries. And I include interest, borrowing cost in that thing. My index is what? We have the inflation rate, we have the borrowing cost, and we add to that a third item, the unemployment rate. Those are all negatives. Those are all miserable things. If inflation goes up, it makes you more miserable. If your borrowing costs go up, it makes you unemployment goes up, it makes the workforce more miserable. And then you subtract from that GDP per capita. That's a positive thing. If your income is going up, that's good. So you subtract that from the three bads, and you get Hankey's misery index. So last year, the most miserable countries in the world: Argentina, then Venezuela, then Lebanon, then Syria, then Zimbabwe. Now, if we look at the least miserable countries, the least miserable was Thailand, then Japan, then Switzerland. Well, all those have very low interest rates and low inflation. So that's why they come in at least miserable. So in a nutshell, this isn't some conspiracy or anything like that. In my view, these are professional people at the Bureau of Labor Statistics coming up with these indices. But there's a lot of subjective judgment that goes into what should be in the index and not. And most recently, early this year, former Secretary of the Treasury, Lawrence Summers, who's a professor at Harvard, and three other co-authors that he had, produced a paper at the National Bureau of Economic Research, where they get into this business of the 1983 change. And they make the point, which I think is valid, given my misery index. They say, everyone's wondering why the economy is supposed to be doing pretty well in the United States. Inflation's coming down. The economy, labor market's tight. The economy is growing. Stock market's pretty hot. But why are people so fed up with Bidenomics and Biden? And they say it's because financing costs, the interest is much higher than it was when Biden came into office. And as a result of that, that's the borrowing cost thing and interest. And if you include interest in there, you, of course, get a much higher CPI. And that's why people are really so fed up. They're not so fed up with the consumer price index, maybe, as it's coming down. But they argue if you actually calculated things the old way, the inflation rate would be a lot higher. And that's what's bugging people. And it would be a lot higher because their financing costs are a lot higher. Mm-hmm. If your credit card debt is costing you more. If you go to the bank, it's costing you more. Your mortgages are costing you a lot more. Mortgages in the United States, they've essentially made housing unaffordable.
Right. So my understanding is that the GDP is actually after factoring in inflation. So we get kind of a net growth because inflation has already been calculated in. So if we were to use any of these other ways of calculating inflation, for example, there's a site called shadowstats.com, and they claim that if we were to go back to the way we calculated inflation in 1980 or 1990, that the inflation would be well above 10%, and then therefore GDP would be contracting that entire time. What is your take on that?
They're kind of mixing apples and oranges. Shadow Stats is good because you get a good number that's a broader measure of money. A proxy for what they call M3 is put out by Shadow Stats, which is a great service because the Fed doesn't put it out anymore. So you have to go to Shadow Stats to get it, or you can get it for this at the Center for Financial Stability in New York. The Center for Financial Stability in New York actually has M3 and M4. They even have broader. So if you really want to get into broad money measures, you have to go really to the Center for Financial Stability, and there you get I'm a special counselor there at the Center for Financial Stability, and the kind of guru on measuring money and changes in the money supply is Professor William A. Burnett, Bill Burnett, a great expert on this, probably the world's greatest expert on measuring the money supply. But let's talk about this thing where Shadow Stats is getting actually mixed up. GDP, to calculate the inflation-adjusted GDP, you've got to use a GDP deflator, not a consumer price index. Consumer price indices indicate changes in the cost of living. That's what they're supposed to do. But the GDP deflator is another index, by the way, another price index that's used to adjust nominal GDP and translate it into real GDP. So Shadow Stats, it's just an apples and oranges. They should be using a GDP deflator. And if they were, the GDP deflator is deflating it in an orthodox, appropriate way. Let's put it that way.
Mm-hmm. So many of us, when we go to the grocery store, we can't help but notice the concept dubbed shrinkflation. And just I've gone to some sites, they give examples of, cereal, ice cream, paper towels experiencing effective shrinkage of 11, 17, and even 29%, because some of these shrink so much over time. How much is shrinkflation impacting the real effect of inflation? And does the government accurately really take that into consideration? I mean, apparently, I saw the site that says the BLS claims shrinkflation only has had a total effect on food of just 2.5% spread out over a 4-year time frame from 2019 to 2023. What's your take on all that?
Well, number one, this is a question for specialists who are measuring things. Now, it turns out I actually know quite a bit about measurement and the Society for Measurement. I'm one of the original members of that society. So I don't know the answer because I haven't been out in the weeds measuring this kind of stuff. Let me point out, go back to our original conversation about the indices, price indices. This is another problem with price indices, is actually measuring things. So, and shrinkflation is part of the whole measurement problem. It's just another problem to put in there. And it's a problem associated with all kinds of economic aggregation and all kinds of indices. It's inherent in the animal. And by the way, you can't make any kind of reasonable observations or modeling or anything else without using economic aggregates. So you have lots of measurement problems. It just comes with the territory. So if you focus on one thing, like shrinkflation and the size of a box of cereal or something like that, this is a problem, and there's no way to get around it. It's just inherent.
See.
So I don't make a big deal out of it. I say, yes, of course, I agree. It's a problem. How do you measure this thing? And if you go back, for example, one of my professors, this goes back many moons. I've been around for a long time. I'm in my 54th year at the Johns Hopkins University as a professor. One of my professors was a famous professor, Kenneth Boulding. He was president of the American Economics Association, and Boulding has a great chapter in his in his 2-volume book on economic analysis. The macroeconomics book, I think the second chapter is on index numbers and aggregation. It goes through all of this stuff. Mm-hmm. They don't even teach this anymore, by the way. Most economists have no idea what we're even talking about. Now, at the official U.S. government people, believe me, they know a lot about index. Or if you take somebody like Bill Barnett, he's a professor at the University of Kansas, but he's also a fellow at the Center for Financial Stability. He's probably the world's expert on index numbers. I mean, it's a highly, highly technical field. And what are they trying to do? They're trying to measure not two things: the volume of something as well as the price of something. If you multiply P, the price, times the quantity, Q, you get something called the total value of whatever is in the box. So this is just a huge problem. By the way, one of the best books, I'm going to turn around, I'm at my home library, by Oscar Morgenstern, very famous economist, mentor of mine, on the accuracy of economic observations. I mean, I look at this thing every week, even though it was published originally in the 1960s. Let me see the publication date, 1965. It remains, I think, the best overall treatment of all these measurement problems.
Mm-hmm. I'd like to transition to the topic of gold, and with the long overdue breakout of gold to new highs, quite a few gold bulls are saying that this is a sign that investors and central banks are protecting themselves from reckless governmental financial policies, and that and an inevitable dollar weakening. What is driving gold?
I am a gold bull, by the way, if we're getting into confessionals here. So that to preface my remarks, it's something that I've traded and I've followed, for many, many years. But what's going on is pretty interesting because the gold breakout, normally, by the way, the dollar is extremely strong. The dollar is in a huge bull market. And usually when that happens, gold is not in a bull market. Mm-hmm. If you get dollar strength, you'll get gold weakness, usually. But that's not the case now. So,
why is that?
That makes this breakout kind of unusual because after all, the dollar is the international currency and very important. The dollar euro rate might be the most important price in the world, or maybe the dollar gold ratio, one of the two. But at any rate, what you find is that central banks are buying, and the central banks that are really buying big time are China and Russia, and their strategy is to de-dollarize. They want to have something on the balance sheet that's not issued by a sovereign. Gold is not a liability of any sovereign, so they get away from the politicization of things and the politicization potentially of fiat currencies. They get away from that. So that's one thing in the background. That's a positive. And then you look at non-central bank buying, shall we say, outside of China. I'll come to China in a minute. Shall we say in the West? And that's actually been quite weak. If you look at the ETF holdings, they've been going down. You look at bullion sales, they've been going down. You look at premiums on physical gold being sold in Singapore, the premiums are low, not high. So all of that indicates that there's not a strong demand in the West, that, shall we say, the retail or non-central bank retail and wholesale markets. So where's this juice coming from? It's all coming from the retail and wholesale markets in China. It's a China story. Mm-hmm. And in commodities, by the way, in general, it's all a China story. All commodities. Now you get some oddball things like cocoa right now. Cocoa's gone to the moon. It's backed off a little bit in the last few days, but that's because of weather conditions and the fact that they haven't been maintaining these plantations in the Ghana and the Ivory Coast properly. So the yields are very low, and just a huge shortage is built up in cocoa. So you get a few things that aren't China centric, but most commodities, most industrial commodities, and even some soft commodities, agricultural commodities are all driven primarily by what's going on in China.
I've heard for many years, gold bulls argue that for every physical ounce at the COMEX exchange, 50 or 100 paper ounces are traded, and that if just 1 or 2% of those currently long, the paper contracts, actually stood for delivery, that it would blow up the COMEX and would create the mother of all short squeezes due to a lack of physical inventory. Is this even likely, or is it just another hyped up, implausible narrative?
I think it's probably a hyped up plausible, but black swans can always creep into the pond, so you never know. Yeah, I'm not saying never, but my knee jerk reaction, I don't pay much attention to this kind of stuff. Mm-hmm. I'm a very plain vanilla gold bull. I'm not into all of this stuff going around. I literally don't spend 1 second even looking at it.
Great. Yeah, I'd like to jump into GDP and the multiplier effect. Now, I've searched ChatGPT. I've gone to many videos, and I cannot find an answer to this. So I'd love to get your take on. So from my understanding, Econ 101 taught us that when $1 is spent into the economy, more than $1 of GDP is generated due to the chain of businesses and people who will receive parts of that dollar and spend it themselves. So when I did a little bit of just simple digging, I was shocked that in 2023, the U.S. borrowed $3.1 trillion, but only $2.3 trillion of economic activity was generated as measured by GDP, meaning $800 billion was borrowed, presumably spent, but generated zero economic activity. How is this even possible, and where did all that money go?
Well, this is getting fairly complicated. Let's go back to Econ 101, the multiplier, a Keynesian multiplier. Let's keep it fairly simple. A Keynesian multiplier is roughly speaking something like this. If you increase the fiscal deficit in the country, there's a multiplier effect. And you can work this out with, the marginal propensity to consume. And there's a little formula, even you learn in principles of economics, that shows you the multiple. You'll increase the deficit, and you, on a multiple basis, will increase the level of GDP. Or alternatively, if you tighten up fiscal policy, you get a reversal of that with the multiplier, a negative factor. So that's what people learn, and that's why they say, well, fiscal policy. They always talk about monetary and fiscal policy. That's the macroeconomic tools, and fiscal policy is a big tool. And if you run a fiscal deficit, you goose the economy because of the multiplier effect. Well, it turns out that, and one of my former colleagues and collaborators, Sir Alan Walters, did a lot of work on this. And what he found was that if the fiscal deficit and debt to GDP ratios were kind of in a moderate zone, yes, you do tend to get a positive fiscal multiplier and a goose when you increase the fiscal deficit. But what if the fiscal deficit's pretty large and outside this kind of normal zone, and the debt to GDP ratio is large? Well, then if you increase and get it further away from the norm, the deficit, you actually get a negative multiplier because confidence is hit. You get a negative confidence shock because people are afraid that what's going to happen, that the central banks will monetize that extra deficit, and if they monetize it, they're going to get more inflation, not real economic growth, and so that's the line. That's how to interpret these negative fiscal multipliers. The Keynesian textbook theory is that the fiscal Keynesian multipliers are always positive. That's not correct. If you look at the actual data, and they turn negative when the fiscal deficit and debt ratios become too big. So that's one zone that we're getting into. Now you're talking about something that I think is a little bit different. I think it's not clear. This is a danger with Googling around. By the way, I'm very opposed to all of this Googling everybody is doing, including you, because you have to make any sense of Googling, you have to have a theory before you start Googling. And if you don't have a theory, you're just in a mass of confusion, confusing yourself. And if you listen to these financial reports on the television or radio or on YouTube podcast, it's just a mass of confusion out there because no one really, there are very few people who have their theory straight on the thing. So what I think, my interpretation of what you started with this borrowing and somehow the level of transactions that go on are a lot higher than the final GDP. And that is true because there's something called gross output. And if you look at the measure for gross output, that measures all the transactions in the supply chain. There are lots of intermediate things happening before GDP. GDP is the measure of the final value of goods and services produced in the economy. It's the final. It's kind of the bottom line. But before you get there, you've got the miner who's mining the raw material, and then you've got, and he sells it for some value to a processor, and the processor then processes it, maybe several stages of processing, and then fabrication comes after that. All these things are sales going on, and that's what gross output measures. And that will always be way greater than, typically greater than GDP, that number. And what's interesting about gross output right now, that is something I follow. As an Austrian economist, gross output is very important. And the big advocate of this and guy who's been promoting it and doing a good job of it's Mark Skousen. Professor Mark Skousen has been doing this work. I've written about it, supporting Skousen's work, because I think it's first rate. But gross output now, what's going on? Remember, I said a recession is baked in the cake because of monetary theory and the contraction of the money supply. But also, another complement to what I said and reason for why I think we're going to have a slowdown is that gross output has been growing at a slower rate than GDP for the last couple of quarters. And that means transactions going on in the background of GDP. They've been, the rate of those transactions has been going down.
So are you saying that GDP is not really a great indicator to get for the output of the economy? Because when I went back and I looked at 5-year periods going from 1971 to 1976 and then all the way to today, that back in that 40, 50 years ago, we had a positive multiplier. In fact, from 71 to 76, we had a 3.3 positive multiplier. Means for every dollar we borrowed and spent, we got $3.30 added to the GDP. But since 2006, for every 5-year period since 2006, has generated a multiplier of less than 1, which I thought was supposed to be impossible. I mean, how can GDP grow less than the amount of the debt that was borrowed and actually spent into the economy?
Well, looking at it from the perspective of the gross output measure and GDP, you'd expect GDP to be lower than gross output. Without looking exactly at it's this multiplier and the debt thing that you're looking at, I can't intelligently really comment about it. I can comment intelligently about gross output and its relationship to GDP. They're measuring different things. We've had a lot of this conversation, and has been about measurement of different things. GDP tells you something different than gross output. They're just two different things. Mm-hmm. And the question is, how do you as an analyst and as economist, how do you put these things together and understand them and the relationships that exist over the business cycle, for example? And that's one thing, over the business cycle. The other thing you've got to understand is more or less what you're getting into, and that's a secular thing, is something over the long run happening here. Is a structure of the economy changing in some way that's making these various measures and the relationships to one another change over time. So there's a lot going on here.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
The very often quoted debt to GDP figures for this country or that country are put out. And we see that for the vast majority of countries, debt to GDP is rising, meaning that the GDP is growing less than the amount of new debt taken on and spent. Is that anything to worry about? Is it just kind of like...
it is something to worry about, because that ratio is over 100% in the United States, and it hasn't been that high since right after World War II. So this is unsustainable. The nonpartisan Congressional Budget Office has come out with a series of reports recently indicating that this can't go on. It is not sustainable. And when something is not sustainable in economics, it will stop. Now, the question is, how are they going to stop it? How will it stop if it isn't sustainable? And I've already said, you got only one of two ways to do it. Either you increase taxes or you reduce government spending. Or, and when I say increase taxes, there are two ways to do this, Ian. One is that they send Hanke a larger tax bill. And the second way is kind of a phantom thing. They don't send Hanke an increased tax bill. They present more inflation in the economy, so everything Hanke is buying costs more, or he faces shrinkflation and all this other stuff we were talking about. So there are only two ways to tax: direct taxation or indirect taxation through inflation. One of those two things is going to happen if you want to increase taxes. Mm-hmm. And we know if you want to reduce government spending, like Bill Clinton did, you reduce government spending. Now, mm-hmm. Clinton, by the way, had a great advantage. And remember, he was president right after the Soviet Union collapsed and communism collapsed. And so there was what we call a huge peace dividend. The defense expenditures went down, down, down. And that was a peace dividend. So that's one. He had a lot of wind at his back to reduce that government expenditures.
Mm-hmm. So in brief summary, is there any way, are there any key indicators, easy to find indicators, where we can measure the effectiveness of government spending? Are they blowing it on a lot of malinvestments, or are they putting it into projects that actually generate a very positive return, thereby spending our tax dollars very efficiently and wisely? Is there any way we can measure this?
Not really, because here's the problem. In a profit and loss system, this kind of thing's measured all the time, because at the each quarter or at the end of the year, we get a financial on companies, or even if they're not public companies, publicly listed. For a private business, you have the same thing. At the end of the year, we've got their financials. So if you have profits, you'll stay in business. You might even grow. If you have losses, you're eventually going to go bankrupt and go out of business, or stop supplying whatever is causing the losses. So ex post facto, we have a measure in the profit and loss system. That's the beauty of it. At the end of every year, the books come out, and you can see whether you've made a profit or loss. You know what the rate of return on capital has been. But that doesn't happen in the public sector. They come up with all this pie in the sky spending, and no one ever looks at ex post facto at the government. So we can't look anyplace. We have nothing equivalent to a profit and loss statement for the government expenditures. So that's the answer to the thing, and that's why we know it must be very wasteful. And the reason for that is that decisions are being made by people who don't pay the cost of the mistakes that they make. And therefore, we have a lot of bad decisions. By the way, the only studies that have been done, and I have done some of these ex post benefit cost studies, because that's one field I not so much anymore, but I used to specialize in this, especially with these big infrastructure projects and water projects. And none of those had in fact generated benefits greater than cost. Of the ones that I looked at, big water resource projects, they were all losers. The governments tend to get into mega projects, these big projects. This is what's happening right now with Biden. By the way, he's very big into what we call industrial policy. And that's where the government is making all these decisions. And if you look at, for example, the Inflation Reduction Act, the Congressional Budget Office predicts, this is ex ante before, they predict it'll cost $391 billion in 2022 to 2031. Goldman Sachs estimates it'll cost $1.2 billion.
Well, big difference.
So a huge difference, and those are ex ante estimates, not ex post.
So, sorry, did you mean 1.2 trillion?
1.2 trillion. I'm sorry,
yes.
trillion.
Yeah.
1.2 trillion.
Wow,
I misspoke. Yeah, thanks for catching me on that. So here's what you have with government programs. You have what I call Hankey's iron law of industrial policy: over budget, over time, under benefit, over and over again.
So one malinvestment after another.
Absolutely.
And
why wouldn't you have that? If you were in the private sector, you can't get by with this, because eventually, if you have low rates of return on capital and you're a publicly listed company, the stockholders are going to send you a pink slip. And if you're in the government, what happens? Nothing. No one even looks at it.
I'd like to jump to, I've heard a lot of progressives argue that this new modern monetary theory, MMT, this new invention, is the key to helping us improve our economic situation. What are your thoughts on MMT?
Oh, it's absolute rubbish. The essence of it, the bottom line is that the government deficits don't matter. In short, it was a little like catching the flu. When the pandemic came, we had COVID, but the politicians caught MMT and started spending money like mad, huge fiscal deficit. 90% of the deficit was monetized by the Fed, so the money supply shot up. The money supply in March of in February or March of 2022, I can't remember the month now, but at any rate, early 2022, it peaked out at growing 27% year over year. That's the highest it's ever grown and since the founding of the Federal Reserve in 1913. And the golden growth rate, Hankey's golden growth rate, is about 6%. That's the rate consistent with a 2% inflation. So we had this huge increase in the money supply due to people believing in MMT. And what did we get? Well, we got a lot of inflation. This theory is utter rubbish.
So getting back to the contraction of the money supply. So from my understanding, our current contraction of the money supply is, I think the last time you said was in the 1940s was the last time that we've had a contraction of the money supply. But couldn't one argue it's like, well, it's not really a big deal because we're just taking some of the cream off the top because we had an explosion of money supply growth in 2020, and we're still just getting back to trend line. So who cares if we're contracting the money supply? We're just taking the excess off the top.
Well, yeah, the excess has been taken off the top. That's true. If you divide GDP into M2, that's a cash balance. It's the inverse of velocity of money. If you do that computation, you'll see that we had the trend is that ratio increases at about in the U.S. at about 1.7% per year. That's the trend rate. But of course, it exploded way over that, and you get a big hump of excess cash balances that were in the economy. And M2 divided by GDP went way up above the trend rate of growth of about 1.7%. And now it's back down to the trend rate, and the contraction's starting to bite.
So quick thought on the general stock market from you. I've learned from decades ago the old saying, don't fight the Fed. And yet interest rates are so high relative to where they were before. and you got a contracting money supply, but the markets seem to be inflated very highly. What's wrong with this picture?
Oh, they are inflated. If you look at the inflation-adjusted PE ratios, it's something. Robert Shiller at Yale, he's a Nobel laureate, so he has an adjusted price earnings ratio called CAPE, and right now it's reading 34, around 35 roughly, and that's higher than the monthly reading since 1881 for 95% of the months. And the highest we ever had, by the way, was the dot-com fiasco in 2000. Remember that? Mm-hmm. Then it got up to about 45. Now it's about 35. But the 35 number has not been realized since 1881 and only 5% of the time. So all it's saying is that the stock market is very pricey now. Mm-hmm. And by the way, the thing has been driven by the Magnificent Seven, some of this IT stuff. So the diffusion of the market, the dispersion is pretty thin. Again, it's an index. Mm-hmm. We got talking about CPI. The Dow Jones and S&P, all these things are indices with a bunch of stuff in them. And we've got a few things that are pushing these indices way up and a bunch of other stuff that really isn't doing that great. But the index itself is very pricey.
So it sounds like you're saying that some of the components of the index are artificially elevating it to levels and masking some of the underlying weakness?
I would agree with that comment.
Mm-hmm. Well, great. So to wrap things up, do you see anything that brings you some optimism?
One thing that brings me a little optimism. It looks like China has kind of hit bottom and is coming back a little bit. That's a tentative statement. Uh-huh. We have only a few data points and so forth, but that looks like the case. So a lot of these critical materials like lithium, for example, which has crashed, as you know, I think it's coming back. So yes, as a lithium bull, that makes me very optimistic.
Great. Well, Professor Hanke, it's an honor and it's a pleasure speaking with you today. Thank you for coming on Chat with Traders.
Great to be with you. I look forward to joining you again. Nothing better to chat about than trading commodities.
Yeah. How can our listeners get in touch with you?
The best way on Twitter, it's at Steve_Hanke. So that's pretty regular. That's a lot of regular stuff. The other way, they can just send me an email, hanke@jhu.edu, and I'll put them on my distribution list. If people request, I'll do that. That way they get longer articles and things like that.
Great. Thanks again.
You're welcome.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are making it
in 2026. Stocks, risk analysis tools, and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
And I experienced how addictive it could be to, just like keep wanting to put on a trade and see what happens. It's just like a slot machine, really. You get a dopamine hit from the wins, and then it makes you want to just put on another one right away.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Yes, that's right. This is Chat with Traders, episode 281. Hey traders, this is Tessa. What's going on? How are things with the markets lately for you? We'd love to hear your thoughts. Share it with us. Feel free to email us at hello@chatwithtraders.com. It would be so awesome to hear from you, or even better, get on the Chat with Traders website and leave a voice message. After all, we are audio-based and always love to hear your actual voices, so don't be shy. Before we introduce our guest today, please allow me to take a few minutes to do a quick shout out to our Chat with Traders community members. For those who don't already know, recently we made the difficult decision to close the online Chat with Traders community. When we launched this space back in November 2022, we wanted to create something truly special and different, a home where listeners of the Chat with Traders podcast could come together, connect, share ideas, and lift each other up. And we pictured a vibrant community of traders and aspiring traders supporting and lifting each other up. Patrick Peterson, Steve B., a big thank you to you. You have been a strong and positive driving force in the community. You're not only amazing and talented traders, but you have also inspired many of us in the trading room and outside of the trading room to stay motivated and continually to learn and improve. And building this community together has been an incredible journey, and the lessons we've learned will stay with us. So to everyone who's been part of the Chat with Traders community family, we hope with all our hearts that being here has added value to your trading journey, no matter how small. Moise, Barlow, Tim, Marilyn, Tiffany, Daniel, Stu, Peter, Michaela, Quinn, Chet, Murad, Jens, Nuno, Thomas, Brandon, Damiano, Mr. Dip, and many more of you. Please forgive me if I am not calling out all the names, but you know who you are. Your presence has meant the world to us, and we're so grateful for every contribution, every interaction. This community has allowed us to connect with so many of you on a deeper level than we ever could have imagined, sharing the highs and the lows, the struggles and triumphs that make the journey of trading so unique. So keep in touch with us. Let us know how you're doing. Thank you again for being a part of this very special experience. And for those who haven't had the chance to be part of the Chat with Traders community, although we are closed now, who knows? We may reopen again in the future. So make sure you are on our email distribution so we can keep you posted. Just get on the Chat with Traders website. Thank you again for allowing me some time to talk about the community. Now, I am excited to introduce a special guest. Today, Ian speaks with Marston Parker. Starting in classical violin and computer programming, Marston's path took a transformative turn when he ventured into trading. Despite a rocky start, his disciplined, algorithmic-driven approach led to consistent returns, earning him recognition in Jack Schwager's Unknown Market Wizards. We get to learn about his transition from discretionary trading to systematic trading and emphasizing the importance of statistical analysis over emotional decision making. Marston used his programming skills to create fully automated trading systems to take advantage of breakouts, mean reversion, and IPO opportunities and other strategies. Also, please note, this recording was made before the sad news of Jim Simon's passing. Ladies and gentlemen, we are so pleased to present Marston Parker from Massachusetts.
Well, Marston, welcome to Chat with Traders.
Thank you.
Where are you calling from?
I'm in Reading, Massachusetts, which is about 12 miles north of Boston. Yeah, it's great to be here. I actually had been in touch with Aaron Fifield about 10 years ago during the first days of the show and almost came on then, but I didn't have any kind of online presence. So I thought, no, I don't think I'll do that. So better late than never.
Yeah, well, you happen to be fortunate enough to be the only purely systematic trader whose performance over the decades was sufficiently superior to make it into the book Unknown Market Wizards by Jack Schwager. How did you get known to him?
Yeah, I mean, I have a feeling there are probably a lot of systematic traders with better performance, but who just weren't known to him or weren't interested in being in a book. But I was lucky enough to be recommended. I didn't know he was making a new Market Wizards book at all or seek to be in the book. I had been, I'm still a member of a community online called StockBee, which I joined in 2013, I think. And the fellow who runs that community, Pradeep Bond, somehow was in touch with Jack and was let known that Jack was looking for people for his new book and recommended couple different people, including me. The others who he recommended declined to be in the book, but I agreed. So that's how that happened. And then, of course, as usual in Market Wizards, I had to send Jack all kinds of documentation about my track record. Luckily, I had all my old brokerage statements going back 20 years, so that was fine. And as he wrote, my stats were really just barely qualified me, but somehow he decided to put me in. So here I am.
Oh, great. Thanks. Yeah. Let's dive into your background. Kind of where did you grow up and what were your early interests in life?
Yeah, well, I grew up here in the Boston area. As a teenager, I had two main interests, classical music and specifically violin and computer programming. And they sort of competed for my attention throughout high school. And I ended up deciding to try to pursue a career in music. And I went to a conservatory in New York City and studied classical violin. But this was the early 80s when the personal computers were just being introduced. And I got one. And so I ended up spending more and more of my time while in school coding and less time practicing violin. So I graduated, but it was clear that I wanted to go in the computer direction by the time I finished. So I moved back to Boston, took a job at a computer store, and then eventually found employment at a software startup in 1984, and worked for that company and two other companies. The third one was called Segway Software, SEGUE, and they ended up going public in 1996 on NASDAQ, symbol SEGU, and I was one of the earliest employees, so I owned about 4% of the company. So I had some stock, and that's what got me interested in trading.
What kind of job did you have at the software company that I
was a software developer, software engineer that was my profession from 1984 through 1997.
Oh wow, 13 years.
Yeah.
And what kind of software did you write?
I started out working on VAX mini computers and then transitioned to personal computers software. And it basically was tools for other developers. The first thing I built was an editor for a particular programming language that the company offered. For a lot of the latter part of the career, I was involved in building tools to support testing of software. So our customers would be QA engineers at other software companies. Yeah, Segway's main product was something called Silk Test, which I think was the leading thing in that category for a while.
And did you get a lot of satisfaction from being a programmer?
I did, yeah. Yeah, I've always enjoyed building software and having people use the software that I build, and so that was satisfying.
Yeah. So the famous Jim Simmons. He was involved in the buyout of the company you worked at.
Yeah, I think he pronounces it Simons. He was that third company, Segway Software. He was the chairman of the board and the largest investor in that company. He at that time in the early 90s, he hadn't had, he had some success in his hedge fund business, but not nearly as much as he did later. And he was, or maybe just on the side, he had a venture capital fund so he was investing in, I don't know how many in total, probably 5 or 10 software companies typically. And we happened to be one of them.
When the buyout occurred, were you itching to retire at that point, or were you imagining yourself just getting another software job?
Well, no, I mean, it wasn't so much a buyout. It was an actual initial public offering. So I mean, the company did eventually get bought, but that was years after I had left. So no, I wasn't really itching to get bought or to do anything. I mean, it kind of was surprising when it became a possibility that we could go public. We were a very small company. These days, it could not have gone public. So, but yeah, at some point, we went public in the spring of '96, and then several months later, there was a fairly major correction in the NASDAQ. The tech companies were struggling, and I kind of got tired of working there, really, and I just got more and more obsessed with watching our stock, and then started buying books about trading and getting involved in other stocks and dabbling with trading strategies, and just kind of thought, okay, I'm going to leave for a while and try this as an experiment. I could always go back to that company or get a job at a different software company if I wanted to. But then I did fairly well fairly soon, and the experiment went on for quite a while, to the point where it was kind of too late to go back and get employed again.
Any books come to mind that influenced you in the early stages?
One of the earlier books I bought was called Trading for a Living. What's the name of that author?
Is that Elder?
Yeah, Alexander Elder. Right.
Yeah.
And that, I think, just the very title was influential. It didn't occur to me that anybody traded for a living until I saw that book. And then I thought, oh, okay. So that was one. But also, that was just the time when some online resources were first coming available. Like there was a site called thestreet.com that I would read. And there were starting to be some early versions of kind of like online user groups. I think Yahoo had a whole bunch of user groups, so I would participate in some of those. Oh yeah, there was a site called Silicon Investor, I think, that sort of like I might have participated in. So I don't know. I was getting inputs from all over the place and getting interested in trading. So
yeah. So tell us a little bit about your early trades, your early big winners and losers, and how did it go early on?
Well, early on, I did some. I opened a brokerage account and had my restricted shares converted to regular shares so I could start to sell them and have some trading capital, and just started dabbling in some. There was some, I don't remember it must have been some other earlier book that I read that it was more of a fundamental angle of like, kind of rotational investing based on things like PE to growth ratio or stuff like that. I found a way to do some scans for things like that. Online, maybe, or with some. I think I had a piece of software on my desktop computer called Window on Wall Street or something like that. So, I would just put on a trade because I thought it met some criteria that I had heard recommended. Oh, and I was also watching. I think CNBC was just kind of getting started at that time, and so I would watch that. I remember my first big loser. This was in '97 when I was still employed and trading on the side. I heard on CNBC, what is it? Herman Miller Company had beat their earnings expectations, so I immediately bought the stock, like way larger position. I was like, they said it was good on CNBC, so I better take a really large position. And it was one of those sell the news situations, apparently. So I remember having a couple sleepless nights on that one. So yeah, that first year of trading in '97. I think I ended up losing about 50 grand. And then at the end of that year, on that basis, I said, okay, I'll quit my job and trade for a living. I had no idea what I was doing. Well, I was starting to get an idea that I could maybe take a more systematic approach. And I was kind of, I somehow got included into the fact that some people had trading systems and followed them rather than just trying to make discretionary decisions and be right about things, which clearly wasn't working for me. I started corresponding with one person who was sharing some aspects of his trading strategy in a series of articles on thestreet.com, a guy named Gary B. Smith. And we just kept corresponding and became friends and eventually trading partners. And so I followed his systematic. It was mostly systematic. There was some discretion in the selection of which stocks to buy or short, but then the exits were 100% mechanical.
Since you were doing this for a living, did you have any expectations as to a targeted annual income or total return goal?
I had a general concept of, and I remember corresponding with Gary about this and kind of doing a sanity check with him of, do you think I could consistently make 20% a year? And he said, yeah, that should be easy to do. I had about $1 million of trading capital. So I thought if I could consistently make 20% a year, even after taxes, be able to have more income than I had from my former job, and maybe even grow the account a little bit. So I kind of had a goal of being able to grow my account 5 or 10% a year after taxes and living expenses, which now I understand you can't really have an income type goal from trading. It doesn't make any sense whatsoever. You're going to have big swings up and down and so on. But compared to many, I think I was in a pretty stable situation because I had plenty of trading capital, and and I had paid off all of my debts, like my mortgage and so on, when the company went public. So I had no debt, plenty of capital, and a career I could go back to. So it wasn't a huge risk at the time. I just kind of viewed it as an experiment that I was doing. And
that book that you mentioned, Trading for a Living. When I looked into that book, it appears to be a book about discretionary trading. Did you kind of set aside those early books that you got into and then focus more and more on systematizing your approach?
Yes, I pretty much, I had gone through a lot of different books and looking for really clues about how to proceed. And I found clues here and there, but like you said, most of them are about discretionary. There weren't any books there that said, here are all the exact rules of a trading system that's highly likely to work. I mean, I don't know when some of the first books about trend following came out. I don't think that there were many yet back then. There may have been. I pretty much set that aside and adopted the method that Gary Smith was using, and then gradually tried to systematize that method.
In our pre-call, you mentioned that you hate trading. Why is that?
Yeah, I mean, I may have overstated that some, but I don't really have the typical personality of a trader who is kind of enjoys placing bets on things, or likes the challenge of trying to make correct calls about the direction of things, of price going, or anything like that. I mean, I do enjoy it, and particularly did early on in terms of as a kind of puzzle of how can you come up with a strategy that made money in the past and, more importantly, will continue to make money in the future. So I enjoy the kind of research and of that aspect of it, of testing different strategies, trying to come up with ideas and so on. But the actual process of trading, of placing trades, and I mean, I went down that rabbit hole a little bit early on. I even spent about a month doing very active discretionary day trading in NASDAQ stocks in 1997 during that losing period. And I experienced how addictive it could be to, just like keep wanting to put on a trade and see what happens. It's just like a slot machine, really. You get a dopamine hit from the wins, and then it makes you want to just put on another one right away. And fortunately, I was self-aware enough to observe myself in that process and realize that this was going to be dangerous, slippery slope for me if I continued in that direction. So I said, no, at heart, I'm very conservative. I'm not interested in losing a lot of money, and I'm not the kind of person who will ever make a big bet on anything.
Do you think that if you had beginner's luck from the beginning, say in 1997, and had good gains early on, would you have still started the process of moving to a systematic approach? Is that
probably
just kind of in your nature? Yeah.
I think it's in my nature. Yeah. I mean, as I mentioned, that when I started trading with Gary, our method had a discretionary element in that, we'd run a scan well, not so much run, but get the Investors Business Daily newspaper and look at the table of stocks that had unusual volume the prior day. So we would go through the charts of those, and he would make, mostly him, would make some kind of subjective judgment of how the chart looked and kind of rank them on that basis for what are the best entries to take. And I tried to grasp that, what he was doing there, and I always found it sort of arbitrary. So right away, I wanted to be able to test it, and I also wanted to be able to test the exits we were using and see if we could come up with better ones given the set of entries we had actually taken, what different exits would have worked better. So yeah, no, even if I had succeeded initially with some of the discretionary type approaches I was doing, I probably would have written code to test it fairly soon.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
As a musician, do you see a link between musical, reading, and playing skills and systematic trading?
But the things I learned from trying to be a violinist, concentration, ability to stay focused at a task, which didn't come that easily to me, but I worked at it. Just the discipline of practicing every day. There's some overlap there. There's a lot of structure, or you might even say a system behind music. Some of which I learned about in school and so on. There probably make some connections there. I don't know if it's super specific.
Yeah. So let's dive into your early algo trading. Can you share with us a little bit about some of your early algo strategies? Well, you first started off as systematic, right? Were you manually entering in your orders, or how soon did you actually go to an algo approach?
So basically, I started trading with this Gary Smith in February 1998, and we were trading one pair of strategies, basically long and short, kind of a symmetrical, not exactly symmetrical, but it's basically buying breakouts with unusual volume or shorting breakdowns, and then setting a bracket like a target and a stop, and whichever one gets hit first. And the only thing that was a little unusual about that strategy, as opposed to classical trend following, is that the stop is larger than the target. And it had a fairly high win rate, like a 70% win rate. I think we were using like a 5% target and a 7% stop initially. Later I discovered other ways to measure those things, like ATRs, but that's what we were doing initially. And I basically traded that exact system, that one pair of long and short strategies, just with minor variations, all the way until 2015. I wasn't really doing anything else. I kept over optimizing them and tweaking the parameters. The basic concept was the same. So I don't think all the optimizing and parameter changing I did really made very much difference. I could have chosen different parameters and maybe at random I would have had better results or worse results or whatever. But the basic concept was the same. You're buying breakouts on unusual volume and setting a target and a stop. And I think there was also a time stop. So there's basically three components to the exit. So to answer your question, when we first started this in 98, we would actually phone in our orders to a broker. There wasn't even an online platform where like Interactive Brokers is now, where you could actually do that. Schwab maybe started to have and TD Ameritrade. That came a year or two later. When we first started, there really wasn't much. So we were using this online broker. I mean, it was kind of an agency, a small broker in New Jersey. So we would call in the orders. Then, since we were doing this every day, we asked if we could email them the orders. So we started emailing them the orders instead. And then I ended up, writing code to generate those emails. So that was my first automation, was actually code that generated and sent emails to a human broker who would then do the order entry. I actually stayed with that broker until 2013. They were called Trade Managed Capital, and earlier than that, they had been called Yamner. I think we were probably their only retail clients, and all their other clients were hedge funds. But we were sort of behaving like hedge funds, so they took us on. And so they gave us this software, and I changed my code to use that. And then in 2013, I switched to Interactive Brokers just because I was paying too much commissions, basically, with the other people, and the slippages were getting worse. They had been giving us, I think, very good fills early on, but the slippages were getting worse, and decided to change to Interactive Brokers. And then, coincidentally, I went through a rough patch for the next several years, but I don't think it was because I changed brokers. I think it was because the strategies were winding down and not working as well anymore.
So to be clear, for what, since 1999, 2000 era till 2014 or so, I mean, a good long stretch that you were doing two basic strategies, correct?
Yeah, or really two sides of one strategy, you might say.
Two sides of one strategy. So let's dive into that a little bit more. So you're on one side, you're buying breakouts on heavy volume, like double an average
basically
volume.
I mean, in the early days when we would do the scanning, every day after the market closed, after data was available. So you're basically scanning, all common U.S. common stocks that meet like a liquidity criteria or price and liquidity filters for kind of three things that, unusual volume, like at least 2 times average or 3 times average volume, a significant move, not like up 5 cents on 2 times average volume, but up several percent in one day. And then prior to that, it should not have already been overbought. So, ideally it's like a flat congestion area and then a breakout from there. So that's the basic setup. I mean, it's probably the most well-known breakout setup in the universe. There's nothing original about it. I think Gary got it. He started by reading the works of William O'Neill, How to Make Money in Stocks, and basically took the CAN-SLIM method, discarded all the fundamentals, and changed the profit target from 20% to 5%, and that was about it. So that's essentially what we were running. And then he added the short side, which O'Neill wasn't doing any shorting and hadn't even published his book about shorting yet back then. So those, I think the most innovative thing was that Gary had added the short side, where he was looking for kind of an even more big breakdown. He used to describe it as like it should look like you just broke your arm and it was dangling.
So the criteria for entering shorts was more stringent and required a greater gap down on.
He was looking for really, the way he used to say it is that the stock should look broken. Most of these entries would be after a negative earnings surprise or a negative earnings pre-announcement. I mean, that was typically in those days, that was the news that would lead to that pattern.
Yeah. And how long did you typically hold these positions, both long and short? Did you have targets when to get out?
Yes. It's the moment we play, initially we would basically place an order to buy or short at the open at market with an attached bracket of a target and a stop order, whichever comes first. So, one cancels the other kind of situation. And those would be calculated in advance as 5% favorable or 7% adverse. So in the case of a long, it would be 5% up and 7% down, vice versa for the shorts. And that was it. And then you just leave them alone until they hit one or the other, which would typically be in those days anywhere from that same day to a week or two later. But mostly it was within a few days. I mean, it doesn't take that long for a stock that just had an unusual move on unusual volume to move another 5% one way or the other. So yeah, it was really a few days was the average holding period, maybe 3-4 days.
What were your thoughts about holding it for a relatively short amount of time? Given the old adage, the trend is your friend, and did you have a kind of a reasoning for no, let's get out earlier than normal?
Yeah, I mean, our reasoning was that we want to be in what is moving right now, and that keeps changing every day or every few days. Whereas if you buy a breakout and then just hold it until some longer term stop is hit, you might be tying up your money in that one stock for a long time, some of which it's not really going anywhere. Gary's philosophy that I adopted is that your capital is sort of like inventory, and you want to just keep turning it over and putting it in where the action is, within reason. I mean, in those days, that kind of time frame was about as small as you could get, without trading costs totally overtaking. Because remember, back then, stocks were still priced in fractions, and the tick size was 1/8 of a dollar, which is pretty large spread. And the commissions were like, I mean, if we were trading 1,000 or 2,000 share lots, the commission would be $50 or $60 per round trip trade. So
yeah, that's pricey.
So there is kind of a sweet spot where 500 to 1,000 round trip trades per year, was workable. Gary was less conservative than me. So that year, 1998, our first year of trading together, he made 80% and I made 50%. It was a good year for us.
You mentioned in a previous interview that you like to have large numbers of trades to be statistically significant. Do you tweak your system so that it will generate a likely minimum number of trades per year? You mentioned, I think, 500 or 1,000 trades per year. Is that kind of the sweet spot to be statistically?
Yeah, I mean, if I look at a back test, I want to see, thousands of trades to believe that there's an edge to it. I mean, if you see a back test that only produces 50 trades, and there's one or two outliers in there, it doesn't really tell you anything about the rules that led to those trades. So that's what I was typically looking for. Yeah. Again, there's kind of, well, it depends on what data you have. I mean, I've generally always worked with daily bars, that kind of 500 to 1,000 round trips a year. Holding for a few days is kind of as low as you can go with daily bars. I mean, obviously, you can't really model intraday trading on daily bars or even a day trading. There's one day trading strategy you can where you enter with a limit order and exit with MOC. Other than that,
how time consuming is coding everything yourself? Is it? I imagine it's a big upfront investment, but later on, how much time do you spend both in the early stages and later on?
I don't know. I've probably spent many thousands of hours on the coding, but it's not like I'm starting from scratch every time I have a trading idea. I mean, from the beginning, I built a general purpose backtesting program, and then later a general purpose automation program. Most of that time it was in Excel, but now I have a standalone program. So now, I mean, given the software that I have, if I want to test a new idea, I can do it in a few minutes, and if I want to start trading a new strategy, I can do it with very little additional coding because I have the infrastructure. But early on, I mean, it just kind of evolved. There wasn't some big task I had to complete before I could trade systematically. It gradually evolved from mostly manual to semi-systematic to, I think I've started being fully automated from my Excel VBA code at the beginning of 2000. I don't think I've placed a manual trade order since 1999.
Let's go back to the kind of the timeline of you used your first system until how long did you use your very first system without making major modifications to it?
I was always tweaking it. So everything just kind of, gradually evolved. I mean, so we had that very good year in 98. 99, I was really getting much more systematized. I had become disillusioned with the chart judgment process with our eyes, and wanted to make rules for what the data should look like. So I kept changing those rules, and ended up having a fairly mediocre year in 1999, which is unusual because most traders had a fabulous year in that year, except for ones who were exclusively short. I went back and looked at all the times I had changed the rules and realized I would have done better off leaving them how they were at the start of the year. So I made this resolution of, okay, going into 2000, I'm going to trade one set of rules all year and not change it all year. And I actually did that. And as it happened, I had my best year yet. So that worked well. After that, I had many periods where I would frequently tweak things. You fall into I think everybody's susceptible to this. When you're in a drawdown, you say, well, how could I have avoided this drawdown or made it less severe? And you find some rules that would have made it less severe and you put them in place. I mean, I was totally naive. I didn't know anything about overfitting or whatever. I just did that. And sometimes it helped and sometimes it didn't. My usual process would be, okay, I'm in a drawdown. Let's retest and let's see if I can come up with a new idea that would have made the drawdown better or would have made recent performance better and put that in. And then there were a couple times when I couldn't find any parameters that would have done better. And then I thought, oh, shoot, the whole approach is broken now. So what do I do? One of those was actually, I said I had this great year in 2000. And so, of course, I kept running the same rules going into 2001. And I immediately had a 20% drawdown within the first month. And I'd never had a drawdown that large before. So that caused me to, stop for a little while and reevaluate. And I ended up putting something in place that was fairly similar, but I think I changed to that I would get a real-time data service and enter my do my entries before the close rather than at the next open. Because in backtesting, I had figured out that would have done a lot better recently. So I made that change. And then I did an analogous thing when things stopped working again in 2005 of switching to getting in even earlier. So I would look starting about 5 minutes after the open for the stocks that seemed to be making big moves on unusual volume and buy them then. So I ran it that way. And that did well in 06 and 07 were my other two best years besides 2000. And even in 08 was okay. 09, 10 was quite good. 11, 12. 2012, basically the short side, when we got into that decade, especially after starting 2013, the short side completely failed. And and prior to that, more than half of my total profit was from the short side. If I had just been trading my long side all that time, I wouldn't have even beat the market at all. I would have been better off buying and holding long and then just shorting against it. But I didn't know that. Maybe not in 08, but other than that, yeah.
I see. Why do you think the short side was hurt in 2012? What was it about the markets that made that year different?
Oh, I think more and more other traders started adopting the buy the dip approach. Basically, short-term mean reversion became a very popular strategy. So the kind of sharp breakdown pattern that was my short entry signal became a long entry signal for many traders.
Oh wow!
So yeah, they would. So that's what I kept seeing. I would end up shorting it near the low and then having it go against me. More and more often. It wasn't like I suddenly got all these huge losses. It just the stats eroded. The win rate got lower and the average loss got larger than the average win and so on. That's what typically happens.
This by the BTFD, by the dip phenomenon.
Yes.
Did this phenomenon exist?
That is the technical term, BTFD.
Yeah. Did this phenomenon exist in other roaring bull markets of the past, or was it an additional nuance of that particular market?
Oh, I think it was a fairly new thing that started in that around 2012, 2013. I don't remember. I mean, of course, prior to that, there were, value investors who were, would know what stocks they wanted to own and wait for them to be cheap in order to buy them. So in a longer time trading time frame, you might say, sure, dip buying has always been part of, buy low, sell high. That's always been part of the investment landscape. But I think it became a popular short-term trading strategy mostly after maybe even in '08. I mean, I ended up adding mean reversion to what I do in 2014, and when I did the back testing, I found that even the long side would have done great in '08, the long dip buying. So I think it was going on for a while, but it probably reached some critical mass where my particular shorting setup didn't just stop working. But I don't know really. You never can know exactly why. You don't know who else is doing what in the market. So the best you can do is guess why something doesn't work.
Are there any objective or subtle indicators that start to appear when a strategy has stopped working?
No, it's very hard to pin that down. It's really more of a judgment call. Yeah, that's where I'm discretionary is in strategy level decisions. I still have in the backtesting software that I sell, I include at one of my many example scripts is essentially the long and short strategy that I traded from the late '90s through the mid 2000s, like till after 2012. And you can see when you run that backtest all the way back to the '90s how it did very well. And then went flat for a long time. And then it mysteriously did really well in 2022 when most other short-term stock trading strategies did poorly. So you never know when something is going to start working or stop working. Really, it's a judgment call.
So my understanding is that you added a mean reversion strategy to your repertoire of tools.
Yeah, I became aware of that concept in that Stock B forum that I was a member of in 2013, 2014, and did a lot of research and backtesting of it. I think I also was aware of or became aware of the writing of Larry Connors, who's probably Connors and Cesar Alvarez are the people who have done the most publishing on the topic of short-term mean reversion. Yeah, I found some strategies I liked, and so in 2014 I divided my capital in two and kept running my old strategies in half and my new mean reversion strategies in the other half. The old strategies were flat and the mean reversion half had a very good year. So then in 2015, I just decided to abandon the old ones and put everything in this long and short mean reversion strategy pair that I had built. And I had a great start to that year and then a really nasty drawdown.
What was the cause of the drawdown, and what was the catalyst? So was it the mean reversion part of your strategy that?
Well, I was so from the start of 2015, I was just running long and short mean reversion with my whole account. So each position was 10% of my account. No, I take it back. I was still trading fixed shares, not fixed percentage then, but it was on average around that size, 10 to 15. Really, I mean, all it takes for in a typical mean reversion strategy, you're catching a falling knife. You're buying a stock that's dropping or shorting a stock that's ripping higher. But you've based on some calculations that it's already overbought or already oversold, vice versa. And if you try to put stops in those strategies, they don't work at all. You basically have to rely on the stats of, if you take 1,000 trades and that are overbought in this way, on average, you'll make money. But every now and then you'll take a larger loss, and you just manage that by keeping your position sizes small enough so that even if a stock went down like 50% more from where you bought it, you might only have a 2 or 3% drawdown on your account, and that would only happen once or twice a year. So the drawdowns in those strategies happen when there's some kind of market event going on where you get serial correlation of those bad trades. So you get several significant losers in a row, and that's what happened in the second half of 2015, especially in August. I mean, the market was very bad in August 2015.
And that's when you had your big drawdown?
Yeah, it had started. I think it might have started in June or July. A lot of it is random. I mean, I think I had one chunk of the drawdown in June. There was one where I was shorting Chinese stocks that were ripping. There was one where I was buying biotech stocks that were plunging after, I think like Hillary Clinton was running for president and made some announcement that she was going to crack down on the pharmaceutical industry, and the whole biotech sector fell apart. But I kept buying the dip because that's what my rules said to do. And so basically, when you have something like that where there's a news-based catalyst or a feeding frenzy like the meme stock craze that happened later, you just end up having too many large losers next to each other. Whereas when you backtest that kind of strategy, the large you see some large outlier losses, but they're spread out most typically, and so the stats still look really good. But then in real life, when they happen one after the other, and then when you have several periods like that interspersed with flat periods, that all adds up to a significant drawdown. So my drawdown had started in mid 2012 when that was my equity high, the summer of 2012, all the way, and it. I had some recovery periods and then some further losses and then some recovery periods. So basically my equity was in a downtrend from mid 2012 all the way until 2015 and added up to about 45% total drawdown.
Wow. So curious.
Period.
Yeah, curious. How much does a strategy have to erode in performance over time before you look to tweak the system or just dump it entirely?
I pretty much always set a 20% drawdown as my kind of system stop or my off switch where I'll at least pause, if not stop for a while and reevaluate. And, then that happens several times during that period. And then at some point you either say, okay, well, I think I've got a new idea that'll do better, so I'm going to restart. But of course, you're not back. You can't wait till you get back to an equity high before restarting by definition, because you have to be trading to get back to an equity high. So, so at some point you just have to keep, at any given point, you either believe you have something that's going to work and go back in, or you throw in the towel and say, I'm done forever. Which I thought I had done that in 2016, and I stopped for 3 months actually. But then, I've got all this software, all these tools, all this experience, just see what I can do. Put a more conservative strategies with fewer parameters in place. And
so that's how you got out of the 45% drawdown is to simplify your system.
Right. Simplify, make it more, take smaller positions and diversify more. I had just been trading the two mean reversion systems, but then I went back and added, my old breakout systems were still no good, but I found a new long breakout system by narrowing the universe to recent IPOs, which ended up being my best performing strategy for the next several years. And added a new. I did go back to something like my old shorting strategy, but with some differences. In particular, rather than just shorting on the breakdown, I shorted on a little rebound after the breakdown. To get a bit of a better price advantage. So those four together are kind of like my core four strategies that I'm still running, and that they did mostly well since then.
Do you program any of your systems to avoid either highly shorted stocks or any of the meme stocks? And how do you screen these out of your system if you do want to avoid them?
I do have some. I have a upper volatility filter. I actually use it on both sides, which I mean, there's a couple of ways to approach that. I mean, one way is to restrict your trading to a narrower universe, like the constituents of a major index, for example. So some people do that. I've always found I can get better stats by having my universe be all publicly traded U.S. common stocks, and then applying a liquidity filter. But the main difference between this universe and, say, the Russell 3000 is that the broader universe will include a lot of ADRs. So you're actually getting a lot of foreign stocks. Hence my issue with Chinese names that I had mentioned earlier. So, oh shoot, I've sort of lost my thread of thought now. What did you ask me?
Oh, yeah. So the meme. So a few years ago, we had the meme stock.
Oh, meme
rage
stocks, right?
where,
So my volatility filter helps. I mean, I did take a bit of a hit when that first started. I remember. Luckily, I avoided GameStop, but I think BBBY and maybe AMC. I had some significant losing trades in a couple of those. At the same time, my IPO strategy was on fire, so it kind of canceled out. Like, I didn't notice those big losses quite as much as I would have. They didn't cause an overall account drawdown, but that strategy was definitely doing poorly. And I was aware of what was going on and with the meme stock craze, because everybody was. But by that point, I had been marketing my back testing software for a while, and we had a fairly active forum, so there's a lot of conversation about it as well. And we started the first thing we did was to just build an exclude list and a text file of, we're just not going to trade these symbols because they're the ones that these idiots are buying. And so I did that. The other thing you can do that I also do sometimes is look at the brokers, like margin requirements or short borrow rates, and just avoid, especially, I figure if IB says you need 100% margin or more, I mean, I've seen stocks where they want 400% margin to short it.
Wow. That's crazy.
Right. I mean, that tells you that their risk management people have said, this is dangerous. So why would I want to do that? So yeah, you can, that's another thing you can do, is let the broker give you some clues about what's too risky to be shorting.
Right. So tell us about your IPO strategy. How does that differ from your other strategies?
It's so simple that it's stupid. I mean, really, the idea was to just define an IPO as a stock that only has a limited number of days in its trading history, and then buy it when it closes at a new all-time high. And then sell it if it has a 1 or 2 day low, fairly tight. I don't use I've never used stop orders in any of my trading strategies. I use stop rules, but on a closing basis. Basically, I just don't want to be taken out by intraday noise. And also, stop orders have more slippage than any other type of orders. So yeah, I'll get out at the close.
You sell out. You're saying. So how long would you, when you buy the IPO, it's hitting a new high?
Right.
Then how long would you typically hold it if it's running, day after day, going higher and higher?
Well, they typically are. I have a profit target in that strategy as well, so I'll hold it till it hits the target, and then it might have a down day and then make another new high, and then I might buy it again. Now, that strategy worked very well. I started it in 2017, and it worked well enough through 2017, 18, 19, and then it really hit it out of the park in the middle of 2020 through the middle of 2021, when everything was kind of on fire. I mean, practically any strategy worked during that time period, so it's not really saying anything. But since the end of 2021, it's just been flat. But a good thing about that approach is when the market's correcting, there are fewer IPOs because companies just cancel their IPOs. So it kind of has a built-in regime filter of its own. A lot of people focus on trading IPOs. I'm not sure. I mean, part of the success in the 2020 and 21 were all the SPACs, which is kind of no longer a thing. I think there's one I just saw the other day, 3-letter symbol starting with I, where it got canceled and it dropped like 80% in one day after a run-up. Anyway, yeah, I think it's going to be a while before that strategy works. I mean, I'm still running it, but it's just been flat for about 2 years now. It's not doing anything.
So going back to your mean reversion strategy, does your system differentiate between an earnings release gap down on massive volume versus a steady multi-day drop on above average volume not tied to earnings? Would your mean reversion strategy play a big gap down influenced by volume?
It would, only if the stock had already been falling for several days and then had a big gap down. It would be then I might buy it there. That would be like a capitulation type thing. But I mean, the setup I use will typically not choose anything that was like at a new high and then suddenly had a big gap down, which is my old short setup. And those did work well in like 2013 and around there. But I think, I don't know, they might work well now. I have no awareness of whether it's earnings or not. I don't pull in any news, fundamentals, earnings dates, whatever. I mean, I'm literally just taking price history and when price does the thing I'm looking for it to do, then that's my signal. Mm-hmm. So, yeah, I clearly, all of my trading strategies are basically looking for unusual volatility. Like I said, from the beginning, we wanted to be in what was moving at any given time, and so clearly I'll get more trades during earnings season than not during earnings season. But there's some amount of earnings season every quarter. Maybe, the big ones are the usual, March, June, and so on. But April, July. But many companies are on offset fiscal years, so you get a certain clump of earnings every month.
Mm-hmm. You mentioned earlier about curve fitting and optimization. What are the primary kind of dangers one should look out for so that they don't get sucked in by this, attractive shiny object?
Well, the number one is don't even try to build a strategy for one symbol. I mean, there's no way you can build a strategy for a single symbol without overfitting it, in my opinion. And unless you're talking about very short-term intraday, if you have tick data or 1 minute bars and can go back several years, maybe you can find something that works consistently. But and I had that instinct from the very beginning, was I want my system to be modeling a process where I'm scanning the whole market every day for that day's trades, so that it's always a different set of stocks that I'm trading every day. I mean, if I look at, do it like a by symbol back test of my systems, I mean, there'll be fairly few trades in any one symbol in the course of a year. There'll be hundreds of different symbols in total. So that's the easiest way to avoid overfitting, is to do portfolio-based approach, not a single stock approach. What I see a lot of people do is like, I want to find a strategy that would have caught the most possible gains out of Tesla in the last 3 years. Or right now you see people doing that with Bitcoin, which is pretty dumb because it's not going to keep repeating. That was a thing that happened, and it's going to be a different stock or thing next time. So avoid that. I mean, and then other than that, it's just keeping your total number of parameters or degrees of freedom, as the quants would say, small. I don't do optimization for the most part. I'll use the optimizer to go over a fairly small set of parameters, or just kind of study how a parameter impacts the results. But I don't do the classic thing of run the optimization over every possible combination and find the best stats and choose that one. That's the thing I want to run. So basically, you avoid curve fitting by not curve fitting.
Right. So I've read that backtesting, the problems with backtesting, often we backtest a system that will yield much higher returns and smaller drawdowns than typically experienced with live trading. Well, what is it about that process? Why does that happen? Are we not looking at long enough time frame for this? Is that inherent?
It happens because when you backtest, you keep trying different things and discarding the ones that work less well and keeping the ones that work better. And it doesn't take too many iterations of that before you come up with something that works better than is likely to happen in the future. That's kind of inevitable. I mean, I just over the years have learned to assume that my results going forward are not going to match what the backtest indicates. In fact, my rule of thumb is half the return and twice the drawdown. So unless I'm content with that, I typically won't run something. I mean, that rule of thumb probably shows that I'm overfitting as well. But I think there's no way to avoid it. I mean, as soon as you run your second test, you've begun the overfitting process, right?
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
Right. Is there a way to measure different types of bull and bear markets with subtle granularity so we can have an earlier detection of the conditions that could cause drawdowns in our strategy so that we get, different? We don't just simply say, well, this was during a bull market or this is during a bear market. Well, what type of bull market, what type of bear market? How did this bull market and bear market was different from past bull and bear markets? Is there a way to kind of get that unique granularity of that particular market so that we can understand greater what's going on?
There may be. I know that some people have done work in that area. I think Van Tharp had a whole way of classifying different market regimes like that. The simplest is just a binary market regime, bull or bear, like is it above or below the 200-day moving average? But yeah, you can go from there. You can do, I think there's like a 4-way thing of bull with high volatility, bull with low volatility, bear with high volatility, bear with low volatility. And there's probably other dimensions you could add. And then you have to backtest that against, you have to pick a strategy and try it in each of those regimes and see how it did. And is that indicative of what will happen in the future? Maybe. You kind of, if you want to use regime filtering in these kind of systems, you have to kind of decide from the beginning that that's what you're going to do. Start with the regime filter in place and then put your rules on top of it. Because if you optimize some trading rules and then try to apply a regime filter, it'll almost always make it look worse because you've already accounted for that in the trading rules themselves.
Since you were interviewed in the Unknown Market Wizards, say 2023 and so far in 2024, how have you been doing?
Well, basically, my last equity peak was the middle of 2021. I had a bit of a drawdown or end of 2021, and then had a flat year in 2022, and I had another drawdown at the start of 23, and then flat since then. I'm up slightly this year, so basically, I'm no longer achieving market wizard results in the last few years. But then again, there were several years in the past, the period that's documented in the book when my results weren't that great either. I mean, he's looking for overall stats over a long term. So, but the one way to look at it is I had an extreme outlier period from mid 2020 through mid 2021 where I had the best 12-month results I've ever had, and now my equity's mean reverted since then back to its usual trend. Kind of 20% average.
Mm-hmm. So why do you think more traders don't go systematic? Are the barriers to entry or learning curve, are they high? Not quite as exciting as for the adrenaline junkies?
All of those things. Yeah. I mean, it's the old cliche of finding an approach to trading that fits your personality. I mean, the ones more likely to go systematic are the ones who don't care so much about the gambling feeling of putting on a trade and don't care about, wanting to be right, like your typical global macro kind of trader who likes to do all this analysis about what's happening in the world and make the correct call about what stocks, bonds, and golds are going to do and, gets pleasure. It sort of comes down to what gives you pleasure, what makes your dopamine fire, probably. So, for me, the actual trading process of putting on one trade, like I don't even care what my individual trades are. I know I have some positions open right now, but I couldn't tell you what the symbols are. I can't remember. I didn't even look. I literally don't care about an individual trade. I care about the stats. So what gives me pleasure is finding a strategy that feels robust to me and has had good stats in the past, and then putting it on and having it keep working. over time. But more than that, working on the backtesting software and improving the software itself actually gives me more pleasure than anything related to trading. So so part of why my results are flat is I've really been neglecting my own trading system research recently, and putting all my focus and working on my software, because I have over 700 users now who like to use it, and I just really like supporting them. And it's kind of like I'm back in the software business, but I'm still trading too, because I have money to invest and I don't know of another way to do it, so I do it that way.
And so your trading software does what? Helps users do backtesting?
It's a backtesting tool, and then I also have an automation tool that integrates with interactive brokers and places the orders that the software generates for the strategies that have been modeled. Yeah, it makes it fairly easy to build a system that combines multiple strategies and see what the results would have been in the past and trade it going forward.
Yeah, so that's kind of your passion currently, is the tweaking your software and communicating with your fellow members on their strategies and so forth.
Yes, for sure.
Yeah, well, great. Well, thank you, Marcin, for coming on Chat with Traders.
My pleasure. Thank you for having me.
Yeah. How can our listeners get in touch with you?
My website is mhptrading.com. And so that's where you can find out about my software. And actually, there's links to all the other podcasts I've been on, and this one will soon be on there as well.
Great.
I'm on Twitter, also known as X, as Mars10P. That's MARS10P. Those are the best ways to find me.
Okay, fantastic. Thanks, Marcin.
Thank you.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
So if you're wondering who got the best lesson of chasing the freaking disco ball and leaving my job at Goldman Sachs, where I probably had a really bright future, and jumping into this market and chasing the tech boom, at a time when the NASDAQ was about to collapse. And like literally, I was the sentiment poster child. And in the wake of that, while I'm over here learning how to day trade, the book that I'm running at Goldman Sachs, the Goldman Sachs Commodities Index, which is now the Bloomberg Commodities Index, essentially, that thing starts taking off and it winds up going into a 10-year bull market in commodities.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Welcome to Chat with Traders. This is Tessa, and today my co-host Ian joins me live in introducing episode 282. Hey Ian, how's it going?
Oh, great, Tessa. I'm glad to join you here.
Yeah, it's always a treat when I get to chat with you for a little bit before we introduce our guest today. How was your trading day today?
Yeah, I'm doing well. Today was a kind of quiet day in the market for me, but looking for the next opportunity. How's your trading going?
It's going. I have recently started to get back into trading a lot more actively now. And I started intraday trading more, something I never thought I would do because it's just it wasn't my cup of tea. As a swing trader, I normally like to not be at the screens all day, but I've been intraday trading and at the screens more often, but I try to get out after about 3 hours from the open, but it's going well.
Fantastic. Good to hear.
Well, you had the chance to chat with our guest today, Tony Greer, a seasoned trader of 25 plus years of experience in the financial markets. Any key takeaways that stood out for you?
Yeah, well, chatting with Tony was like taking a deep dive back in time. His stories of the dot-com boom brought back so many memories for me of this exciting time. The college students he talked about who would bike into the office, make a few trades, and then go off to their classes, and then come back to trade near the end of the close reminded me of my coworkers at the software company that I used to work for. Who were all infected by the trading excitement of that time. And hearing him describe what it was like being a trader for Sumitomo Bank and Goldman Sachs, the victories of some incredibly stressful times was gripping for me. Actually, it was really fun material to make a movie out of. Actually,
yeah. So, what was it about the part where he talked about the college students that would bike into the office? Reminded you of your time?
Yeah, well, it reminded me of just anybody could make money in the markets that time. It was people confused profits with brains, and so during that time, it was kind of a gold rush, get rich quick mentality that, of course, eventually flipped around and very nasty bear market of 2001 and 2. But it was very kind of memorable, like something you'd see in a docudrama.
Do you miss it?
Yeah, I kind of miss those days. I mean, those days were the early days of my trading, and to see and feel the uber excitement, you could say. People, a lot of my coworkers, they were doing more trading than they were actually working. So
probably not so different than today now. I bet you a lot of people are trading more than they're working, especially those that are working from home.
Yeah. Any quick things that you got from listening to Tony?
Some of the things that stood out for me, and we don't want to give away too much, but I can tell that Tony really admired his dad, and that his dad had a really big influence in his life, with his trading and in his professional financial career. I thought that was that can really make an impact in someone's life when someone close to you is really supportive and has that kind of influence in your life. Yeah, and one more thing that really stood out to me, that he had a survival attitude in the market. That stood out to me because the way that he talked about it, his survival skills, it was just so fascinating and really made me pay attention and see how it can apply to my own trading.
Yeah. He's a veteran with a lot of accumulated wisdoms. So let's dive in.
Ian, take it away.
So, Tony, where are you now, and where did you grow up?
So right now I am sitting at my home office in Atlantic Beach, which is probably about 10 miles from where I grew up in Merrick, Long Island, and went to Chaminade High School, Cornell University. After that, started working on Wall Street.
When did you actually first hear about the financial markets? What was your first exposure?
Yeah, I was a toddler.
Okay.
Quite honestly, my dad traded over-the-counter stocks for Dean Witter for 30 years, sat in the same seat, and he got that job when I was literally a toddler. So I knew what bids and offers were like in junior high school. I really loved the, he was I'd never heard other people, either in my family or my friends' dads, talk about their job like my father did. And he had so much energy and passion for what he was doing. And it sounded so exciting and so competitive. And, I was a mediocre athlete in high school and, tried to figure out what you want to do. And you hear something as competitive as that. And that sounds like such both an individual challenge and a kind of a team sport when you're on a desk, and all of those things appealed to me. So I kind of knew going into college that like I wanted to trade somehow.
So he didn't project an atmosphere of like, oh, this is incredibly stressful, and it was more fun for him.
His eyes used to light up when he made money, and I knew kind of what that was all about. When you ran a book, an over-the-counter book, you were kind of a position trader in 30 or 40 stocks on your pad, and you can have whatever position you wanted on there. I kind of understood that, and I guess understood the buy low, sell high competitive nature of the trading game super early because of that. And I knew that there was like an extra level of like, as I got older, certainly not as a young kid, but as into college and stuff like that, I knew that there was some kind of, I picked up on the fact that there was this very much a little bit of a casino feel to what was going on sometimes, because money was made and money was lost, and there was a lot of money swishing around. That's all I knew. And my dad was like really animated and excited when he talked about his job. And it was definitely really infectious. So that's where I kind of come from, that position.
Did he introduce you to any books or any educational material early on?
Nah, man, my dad didn't go to college.
Oh.
He was all street smarts, and like PhD level street smarts, like nothing that I can even describe. And so when he got this job at an official firm, literally he had a job like parking cars.
Mm-hmm.
And because of his personality, a guy that worked at a big shop was like, I'm hiring you. And the personality also applied to, being open-minded and a free thinker about trading. And like my dad was like, one thing that I've been able to adopt as a trader is that my dad was not dogmatic about anything. It was like, oh, maybe this is going up today. Maybe it's going down tomorrow. And I got to be long to make money one day. I got to be short to make money another day. Like I am, anything is game. So that's some of the things that he instilled about it. I don't want to get too far away from the question. Oh, so there were no books. That was it. Everything was street smart. And he didn't get his education from reading anything. He got his education from watching the tape. And so I learned at a young age that there was a tape that I should be paying attention to at some point when I could figure that out. He was an old school tape reader, street smart guy that had a really, really successful career on Wall Street because of that. And I also love the fact that he was, he didn't have a high level of education and was out there, competing with guys from the Ivy League,
mm-hmm.
And for seats and positions like that. And in the end, he wound up getting a couple of better positions, and it was because he was better at what he did and had a better personality suited for that job. And so I kind of learned that kind of at an early age and thought that was a cool meritocracy to live a professional life under.
When it came time for you to go to school, did you get a college degree? And if so, what did you get into?
I did. I went to Cornell University, and I studied business management in the agriculture school. The ag schools was a cool place to go at Cornell because you kind of learned about markets from a commodity perspective, from the position of a farmer, from the position of a producer, You know what I mean? Like whether it be an egg producer, a milk producer, cattle farmer, you kind of learn that angle of the business in the ag school. And I was really attracted to that. Like I kind of felt for the first time in my life that I was getting my first handle on how the world worked. When I really got down to the nuts and bolts of seeing how, food was grown out of the ground and sold, and the ground is culled over and then prepared for the next year and done over again. And, and then markets change. And so that was a cool lesson to learn to get along this sort of college path.
So while you were in school, were you envisioning yourself wanting to get into the financial markets because you were learning how the commodities traded, and maybe wouldn't that be cool to get involved in a job like that?
Yeah. Oh, yeah. The holy grail was to get a job with one of either the sales and trading or the investment banking program, associate program for kids out of college. And that was the holy grail. And those firms would come to school, and you would come up to school and you would go to their presentation. Usually it would be done by somebody that graduated from Cornell, that worked at Morgan Stanley or Smith Barney or Dean Witter. And they were like, this is what the program is at our school. And man, everybody wanted that job. Everybody in the world wanted that job. And it was kind of like, if you didn't get into the investment banking program or the sales and trading program for trading, it was like you were going to have a really rough time trying to find a job on Wall Street, supposedly. But I was pretty adamant I did not get one of those sales and trading jobs, associate programs for one of the big banks, or get near the banking program. Like my grades weren't good enough and I wasn't nearly competitive enough for that. So that sucked. But then I learned that, the network is a lot more important. And when my dad was able to, put me in front of 10 or 15 guys, that all said, I don't have a seat for you, but I'll keep you in mind, until somebody had a seat for me and kept me in mind, and I started off at work. My first job was at Sumitomo Bank on the 104th floor of Two World Trade. And that was a really cool job on an FX desk, trading desk there. And I was really determined to get a job on a trading desk. And that's kind of what I was waiting for. I didn't want to take any other position. Like I didn't want to work in the back office. And my dad was pretty adamant about being behind me on that. He was like, nah, I think you can start, he was certainly like, if I started on a desk out of high school, you can sure as shit start on one out of Cornell. So that was kind of his attitude. And so that worked out. And that was a great place to start at an international bank in the currency markets, in the up in the sky in the trade center. And it was a really, really awesome place to get acquainted with moving markets and hearing broker boxes and figuring out where your liquidity is and things like that.
So was there a lot of training and education that you had to go through their internal school to before they would set you loose on the trading desk? Or
no, it was baptism by fire. I had a crazy 34-year-old Japanese guy named Dave Shindo that I worked for, and he was an absolute madman that you couldn't outwork, and you couldn't get to work before, and you couldn't stay as late as, and he was really intense, and he would literally belittle you all day long about, whatever it was, about not knowing his position or not knowing the market or not being aware that news was coming out or whatever. And that was like nom for me, coming out of college and having this, slight but sturdy Japanese guy now running my life, and he's 5'4", 120 pounds, and I'm 6 feet and 200 pounds. And this guy is actively yelling at me and belittling me and calling me a dumbass and everything like that. And so I was managed to make some friends, and the friends that I made there was like, just stick it out, if you can, because you're going to get a good education here. And I wound up improving my attitude and focusing on learning and things like that. And it was really worth it. It was really worth it.
And how long did you stay at Sumitomo Bank?
Sumitomo Bank. Yeah, that was like one of the 5 major Japanese banks at the time. I was there for 2 years, and then I went to UBS for 2 years and did kind of the same job where I was, basically a spot or forward FX trader. I traded the dollar Swiss book back when, there were, all individual currencies in Europe and things like that, and the dollar mark book. And it was a really, really exciting time to be in FX trading. Like there was volatile, there was like central bank action, hedge funds were just starting to play in that market in the early 90s, and it was a lot of fun. And I wound up being able to quote a really large client through a broker because we happen to have a really good credit line with that large client. And I made really competitive prices to that large client through the broker. And eventually that client wanted to take me out to dinner to say thank you for all that. And so I met him through the broker, and that was the trader that ran the desk at Goldman Sachs, and he wound up hiring me.
Oh, wow.
Yeah. So that was the kind of segue to work there I spent 6 years there, and they were like the best years of my trading life. Like that was like joining the Yankee team of traders. And the analog, it was a great analogy to the Yankees in the late 90s when I worked there, because I don't know if you remember, but they used to win 100 games a season. And I used to feel like I was on that team as a trading team, like the trading team at J. Aaron, which was the commodity trading arm of Goldman Sachs. Like you were known as the best in the business. And I got to learn from those guys. And that was, I mean, those guys are still my network today. And I learned pretty much everything I know about trading there at that shop. And, everything that I learned there is plays right out on the screens in front of me today. And, like I said, is part of my intimate network. So that was a good stop on the street.
What were just a few things that they taught you that you hadn't yet learned at working at that Japanese bank?
I would say that there was a new level of rigor about trading. There was a new level of intensity and preparedness about trading. There was something that we used to do where we used to make sure we knew all the known knowns about the market that we could know, and whatever it was, right? We used to just basically diagram it out. Like, how big is the gold market? How many clients do we have? How many trading counterparts do we have? What's our liquidity? What's our liquidity if we need a lot of liquidity? What are our P&L swings? And, when you really get scientific about running books like that and figuring out where you have leverage or you have a bit of a view or an edge in whether it's an interest rate market or a currency or commodity market or something like that, and learning how to exploit that edge in your trading book, that was the next step to learning how to become a prop trader and, really get paid for making money as a trader. That was the cool part about Goldman Sachs, was that no matter what book you ran, and I ran the gold book, I ran the Platinum Group Metals book, I ran the gold options book, I ran the GSCI book, all while I was there. If you were able to outperform your budget, you would get paid for that. And the idea there was to figure out where you could exploit edges in your book and, make more money than the book was entitled to. Like, what was your alpha on the franchise? The franchise had a certain value to it, and they had a certain target for what your P&L should be on the year in that book. And, if you were able to double that, certainly you were going to get an unbelievable bonus, right? Like things like that. So that's literally what people were looking to do there. And everybody in there was so focused on making money that it was unbelievably intense. And you had a set of salespeople that knew what calls to make at the right time. And you had traders that would anticipate moves and be ahead of things. And it was just really, understanding the way to do it at the absolute highest level.
It sounded like you traded a whole bunch of markets at Goldman, or did you focus on in particular?
Yeah. Well, it was all in the commodity desk within the commodity arena. The heads of commodities at the time were Gary Cohn and Lloyd Blankfein, who went on to run the firm for several years. Those were the guys that I reported to. And I was on the precious metals desk and the GSCI desk for my 6-year term there, right? Like, you kind of intermittently, a little bit back and forth. The desks were back to back. And so if, something changed where personnel changed, you could turn around and, sit and trade that book if you needed to, or you could trade the gold book for, a year and a half like I did, which was a pretty unbelievable experience. It's like driving the Millennium Falcon, trading the gold book at Goldman Sachs in the 90s. No, it really was, because you were quoting everybody from the South African Reserve Bank to the Bank of Japan to Newmont Mining. And, when they're asking for prices in gold, it's a big deal, and you have to make a competitive price, and you want them to do the business through you. And, your salesperson is competitive and you're the trader, and you want to be competitive and win the trade. So you see the flow and get paid the commission and, eat the whole piece of pie. We were really good at that. And so we got to do it a lot, and we got some pretty big jobs. I got to witness, when our base metals desk had, the job of squaring up the Sumitomo debacle bank on their desk, and seeing what that was all about and how intense that was. And that's where the trader Yasuo Hamanaka got caught at Sumitomo, basically hiding trades and risk in the drawer. And they offloaded the dismantling of that extremely, extremely expensive book of metals that he had. And so seeing that unwind and things like that were literally like one of the most unbelievable experiences of my life. And trading the gold book and things like that. So there was really, that was where you learned the next level of rigor, the next level of anticipation, the fact that, just because it's your job doesn't mean you're not doing your homework, and just because it's, we used to say that our job was from bell to bell and our career was after the bell, and that meant going out with guys in the markets, going out with guys at the firm, learning more about the firm, learning more about your risk boundaries and what other things you could do to contribute, whether it was on the desk or somewhere else at the firm. The place was really efficient like that. And so that was like the education of a lifetime, and it overlapped with the internet boom and bubble kind of thing. So that was an integral part in my career as well.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So, well, speaking of the internet boom, did you or your colleagues get swept up in the .com boom and possibly buying into the mantra of the day, which was this time it's different?
Yeah, I have the best story in the world for you on that, by the way. I bought into the tech boom hook, line, and sinker because I was a music guy from the start. And I was sitting at Goldman Sachs. I probably started there. I was there from, I guess, late 93 to 2000, first quarter of 2000 or so. And so that was literally the time when Amazon was born and the time that you were transferring your music files onto a device and listening to them on the device rather than carrying around a portable disc player. And, I was able to catch on to that really fast. And I was like, okay, I just ordered my favorite 10 albums that I haven't been able to find in a store from Amazon, like so that I can now get those home, record them, and have those to listen to. And I'm like asking around, I'm like, are you guys doing this? Like, are you guys buying this stuff on Amazon? Or this is really convenient. Like this stuff lands at your door. And they're like, no, not at all. What is that? And I was like, okay, I think I get it. Like I don't think anybody has any clue what's going on now. And so I was able to invest in a lot of those different companies, like, the equipment makers, the chip makers, whatever it was. And I did rather well because it was timed well. It was timed with a time when I had some expendable income that I could invest, and it timed with the bull markets and the music thing happening and that really working for me and understanding it. So I was hook, line, and sinker into the tech boom. I was buying those stocks at Goldman Sachs, worried that I had a 30-day holding period and being like, oh man, who knows what could happen in 30 days? Like, I don't know if I'm comfortable. And then the 30 days would be up, the stock would be up 30%, and I wanted to buy more.
Well, so the 30-day holding period, was that a regulatory requirement because you worked at Goldman Sachs, right?
Yep. So, it was also something to kind of keep you from day trading, essentially, right? And that kind of third rail to kind of slow people down from just being on the phone with, their personal account all day. But where I was like, oh, so that was, for me, it was something that I was profiting in my PA, and the desk was doing great, and it was really bountiful time for me as an earner. And I was about to get married, and I always wanted to work for myself. And I got the opportunity. Somebody offered to partner up with me and somebody else and start our own trading firm and dig into this tech boom that was going on. And the timing was such that the firm went public in 1999. So we basically, we were able to get an IPO award for working there. And, I kind of got set up well financially. And I looked at it like at my wife or my fiance at the time. And I was like, this is my bubble. This is my sort of like my sleep at night money. You know what I mean? Like this is really good platform for us. And now I can go try and start this business on my own. And so to make a long story short, I sat down in March of 2000 after leaving Goldman Sachs's commodities desk to trade the bull market in the NASDAQ, which had literally peaked as my ass hit the chair and was about to get halved. So if you're wondering who got the best lesson of chasing the freaking disco ball and leaving my job at Goldman Sachs, where I probably had a really bright future, and jumping into this market and chasing the tech boom at a time when the NASDAQ was about to collapse, and like literally I was the sentiment poster child. And in the wake of that, while I'm over here learning how to day trade, the book that I'm running at Goldman Sachs, the Goldman Sachs Commodities Index, which is now the Bloomberg Commodities Index, essentially, that thing starts taking off, and it winds up going into a 10-year bull market in commodities.
That was back when gold was less than $300 an ounce.
Yes,
right?
sir. Yeah, gold was probably $250, bid at $350 in price. Silver was $5 an ounce. Gold, oil was $10 a barrel. $10 bid at $12. Nobody cares. That's what the oil market was. 10 bid at 12. Nobody gives a rat's ass.
So just curious, your colleagues at Goldman trading the precious metals. Often precious metals advocates are often known for being rather conservative. They kind of more value investors. They don't believe this tech bubble hype. Did your colleagues, did they buy into the dot-com bubble?
Well, my colleagues were, in the commodities markets then, I would kind of beg to differ that it was the sort of buttoned up, slow moving investor. I mean, that may be the investor, but the trader at the bank that's running the book is trading in the literal Wild West. Because compared to the equity markets, there were no rules in the commodity markets, essentially, right? I mean, there are people in jail today for breaking Fugazi rules that I think that they wrote after we all traded in the market, something called spoofing.
Oh yeah.
And so that's something that went on. Like you were getting spoofed left there. It was just part of the deal. It was just like, oh, I thought this guy was a buyer because they're buying came into the exchange. Turns out he's a seller. We got clobbered, things like that. So, you see buying come into the exchange, you show a better bid because you figure maybe this is the way this guy is going. All of a sudden he's a seller. He hits your bid, and guess who the buyer was on the exchange? The guy that was selling you the gold, right? So it's it was that kind of thing where, you had no idea what was going on, right? When a client called and needed a quote or whatever, and you heard the floor trade, and you were like, I don't know what that flow is attached to necessarily. But my point being was that, I guess to answer the question, the traders were able to live in the Wild West. So not all of them were as I guess, taken by the tech bubble as I was, really, and I did spend an inordinate amount of time, like, kind of following those stocks when I probably could have been spending that time following commodities and trading my book more. But when you're sitting in front of a Bloomberg, you're just doing research on everything that moves, right? And you're trading and et cetera, et cetera. It's just part of your day to day. But they weren't looking, none of them were like jumping ship to go trade in this market like I did, and probably wound up being thousands of times more successful than me for, some of them stayed and became partner and things like that. And so that was the lesson for me, was like the life lesson was like, wow, like I just left this pretty cushy job at Goldman Sachs, making a ridiculous amount of money for a guy my age. And I wanted that money allowed me to do something on my own, because I really didn't love reporting to a hierarchy of type A dudes my whole life. And the lesson was, though, that, you left that valuable seat and you went on and tried something on your own in a market that you literally painted the top tick in and collapsed. Right. And then a bull market started on my desk that I was just essentially in charge of the book of. So God knows how much money I could have made in a 10-year bull market as a bull market trader in that book, And so that was like, I mean, it took me half a decade to get over that decision.
Wow. So you had regrets for years
Fuck
to come?
Yeah.
Oh,
I
yeah.
thought, I thought I, blew my life up. I literally,
wow.
I was like, and there were people at the firm that were like, nah, I don't, you should stay here, man. And I was like, what? Like this market, this bull market, like all I got to do is invest in these stocks for another 5 years and I'm done working, so I'm going to go pay closer attention to it and make money on the way and be done working at like 35. Like, you guys don't understand. Like, this market is going NASDAQ 10K down view. And, so you can imagine what an expensive lesson that was. I mean, that whole lesson and that the imprint that it left on my life, that plays into every decision I make today in trading, in my professional career, in my business, in my day trading. Like, that was a valuable lesson, and you don't learn from that unless you go through it. Like, I could tell you guys and you can play it for your audience and they'll be like, wow, that's kind of interesting, or not. But it was really valuable for me, having lived through that and the day-to-day of that and the actual thing, from this big giant paycheck at Goldman Sachs to no paycheck at this trading firm for the first year until I figured it out. And then we made some money. And then it was like, this is not going to be the way forward.
Yeah, so let's dive into that. So from 2000 to 2005, I think you said you were at this firm. And what
about 2000? No, this was a 2-year venture from 2000 to where it was basically a 2-year break-even operation where we tried to set up a desk of 4 or 5 traders, levering $5 million of capital, to the hilt, and learning how to trade in this market, just like we saw. At the time, you got to understand, day trading was like a business, and there were people setting up shops for day traders to come in and sit down and trade the markets, and they provide the seat and the platform for you, and you pay them commission for the trades that you're putting through their electronic system, and they're making a fortune. And a lot of the times the traders were making a fortune. And I knew that I had walked into some kind of a bubble when I learned. I sat down. We put our office basically on the same floor as this day trading firm. And that was partially because we struck a deal with them where we could use their pipes for trading for a super low discount and didn't have to pay the same prices as the other guys for a couple of different reasons. And so we start learning who's who in their trading room. And, when I learned that 2 of the 5 most profitable traders in the room were college students, active NYU students that rode their bicycles down to the trading room to trade the open, and then rode their bikes up to NYU to go to class, and then rode their bikes back down to trade the close. And when I saw those guys making like $30,000-$40,000 in a day, I was like, oh man, like no exaggeration. There were college kids making $30,000-$40,000 in a day.
So did you know what they traded, and could you?
Yeah, SDLI and Netscape and WorldCom and all of the big tech bubble names at the time is what they were trading. And they treated the trading montage like a video game, and they got really good at the video game. And they had balls of steel, these two kids. And I think it's because they were at an age where they were like, yeah, we're like really good at asteroids and Pac-Man and this game. And so when we're really good at this game, it pays us. So we just keep playing this game, and we keep playing it aggressively because we know what's going to happen. And like there was a period of time when that was actually the truth, where like you could look at the trading montage and you would see Morgan Stanley is the high bid in this tech stock all day long. Right. And they would bob around, but you could see the trader, Morgan Stanley, representing himself as the high bid, buying stock all day long. And sometimes it was all week long, and sometimes all month long. And it doesn't take even a college graduate to figure that out on the screen. Right. Oh, there's Morgan Stanley again. The big buyer in this name is back. Guess what I'm going to do? Right. I'm going to be long in front of him, and we're going to watch this thing go up. Right. And so that was like, what was that?
Oh yeah. So were you, were the rest of you there, tempted to just simply copy what these college students were doing? And what were they going both long and short?
No, everybody was a bull market trader there. Right. I mean, this was low hanging fruit. You know, like you don't remember the sensation if you weren't sitting there, but it used to be the bell rings at 9:30 and they're off. You know, and this one's running this one's up 5%, this one's up 3%, this one's up 2%. And that went on for 5 years. And so like if you caught on after the first year, or if you were slow and caught on after the second year, you were like, I think I get it. Right? Like I think this is a bull market. You know, and like you were able to identify that. And then if you participated heavily along the way in, you know, from call it 96 through 99 with the right view that this shit is going up, this is what makes people confuse money and profits with brains, right? Because they go in, they buy a stock, it goes up, and guess what they are? A genius. Right? Not just, you know, XYZ $1,000 richer, they become a genius. And so that in itself is the hubris that is the bubble, you know. And so that's kind of one of the signals that I understood about sentiment, that when I got to this shop to set up my business, I was gung-ho everything until I saw this kid double park his 10 speeder in the office and sit down and take off his backpack and start trading and be the best trader in the room. I was like, oh boy. I was like, this is a sign of something, and I don't know what, but it ain't good.
And so how long did these college students come in and make this money and before things started to fall apart?
Yeah, literally like 9 months later, the market was knifing lower and they were not coming back. And it's because they were like, you know, like at that point, you know, at the trade shops, you know, the word was out that the market's shit. We don't, you know, this ain't working anymore. You know, there's no reason to go in every day. Maybe we'll go in for the Friday trading, or, you know, it's just too choppy. It's too hectic. And that's when our business was like, you know, struggling to make money, or if we were making money, we were barely covering our commissions. And, you know, it was good because it was volatile on the way down, but it's just infinitely harder to make money in a bear market, right? A bear market takes everyone's money. And that's the hard part about it, even the bears. So it's like, you know, that was like, we got to a point where it was like, okay, let's just stop breaking even and let's move on to something. And so that's when I segued into the sales side of the business.
So what were the key things? What were the key things that you learned during those tough years there that has made such an impact on you even to today?
I fine-tuned my survival skills in the markets, right? I learned and knew and demanded of myself that, you know, I was no longer trading Goldman Sachs. I was no longer trading Lloyd's money. It was what we used to call it. So it was now my money. And so it needed another level of rigor of that Goldman Sachs bulletproof, I'm a step ahead of everybody rigor. And so I became a Navy SEAL survivor. of a trading day, of a trading month, of like I was always like, there were guys on my desk whose P&L was like C4 explosive, right? They'd be up 35%, they'd be down 50%, and I'd look at them and be like, I don't know how you live like that, because now this is you're eating the money this is eat what you kill. And so if you're not making money, you're not paying the bills and stuff like that. So it's like, it's really challenging. And I guess that survival, live to trade another day, was, I had it printed on a piece of paper that was on top of my computer. That was like the mantra. And that's, it should still be the mantra, but I think that training is why I'm still in the markets today with, a successful trading business and a great trading book. And that's my life now.
So before, you were more of a kind of a buy and hold, just ride the wave, the bull wave up. And then during the bear market, during those tough years, did you turn more into a day trader?
No, actually, like less, I was like, I invested in a lot of stocks during that time. And like anything else, I always had a level that I would be out. Right. And and it was, I was lucky during the .com bubble that, my trailing stop loss was still a great profit that I would be totally happy with, and when you see the trajectory of the things that were going up like they were, you were like, okay, I get it. This thing can go back down just as fast. And I don't want to get left holding the bag. I've made this nice money over my life in my late 20s. And like, this is, or my early 30s. And I was like, this is what I should be doing. And I was able to sort of, sell the invested stocks money on the way down and be like, okay, that one, we clicked the stop loss area. We're gone. That's it. We made some nice money. We gave back a shit ton from the highs, but we're out. And whoa, that turned out to be a good idea. So I managed to preserve that. And then that was in the time that, it got really focused on trying to day trade and trying to trade from the short side and, figure out how to stay alive there. And sometimes it was like buying Friday expiration put options on Monday morning and just staying out of the fray and just seeing if like that $5,000 or $10,000 investment paid off in spades or if it disintegrated to zero and you tried something the next week.
Mm-hmm.
But it was better than getting chopped up $2,500 a day and not having a shot, so we kind of changed our modes and we survived a little better. And so those lessons I really took with me in trading, and I kind of still employ those in my day trading today. Like I'm good at making donuts. Like a lot of times I can have no position, no view, see a stock, see a story, see a dislocation, understand which way it's going from there, trade it, and make money at 4:00.
Uh-huh. So what are you looking for? Like, what are the kind of the key setups, both from a technical indicator point of view and fundamentals that trigger that realization, okay, now's the time to get in?
A lot of the setups are pure pattern recognition.
Mm-hmm.
Pure pattern recognition, right? Like my favorite pattern that I've seen, if you bunch them all together, it would be a big stack of them, but it's probably like happens like once a quarter or once a month or every 2 months. But, you'll see a stock that's in a bull market trend and it'll pull back to a reasonable, maybe a 50% pullback and consolidate and consolidate and consolidate and kind of lull people to sleep. And then a headline will come out, or maybe not a headline, but there will be a series of large magnitude moves that I'm very good at monitoring with my proprietary screen setup. And that causes me to sit up in my chair, right? That's to me saying they're ringing the bell on this bull trend continuing. And nobody really has the answer why there's this large magnitude move, but it just broke the range. And that's a trade that I can go with. And like, that's something that I have seen 1,000 times if I've seen it once. And, or otherwise, my other favorite that I always set up, I look for is, be a bull market trader and buy things that are rallying from the bottom left to the top hand right corner of your screen, right? Figure out a spot in there that you can buy it when they're selling it and have the trend resume and you make money, right? Like, and so literally I've made a living watching things pull back into trend line support that I can draw, or moving average support that gets drawn for me, 50-day moving average, 100-day moving average, 200-day moving averages. God forbid a bull market security pulls back into where moving averages are crossing. That usually forms an unbelievable like cradle of support. And sometimes it's a self-fulfilling prophecy, but it works a lot. And at least it gives you great risk reward, right? Like the odds get stacked more your favor if you can line that trend up with the moving averages and put your stop on the other side of it where the trend is no longer the same intensity. And there's your trade.
What kind of time frame are we talking about? Are you looking to take positions over a period of many months, possibly, and just kind of ride the wave up?
So that's when it goes perfectly, quite honestly, right? I run a view matrix in my newsletter, and the view matrix is a set of positions that I timestamp myself to the close. And I say, I'm bullish the S&P, I'm bullish for these reasons, and I'm going to be long the S&P basis today's closing price. And it goes right into the spreadsheet. Boom, we bought the SPY, closing price of this day, this price, et cetera, and I manage the P&L from there, right? And I do that many times with many trades during the course of the year. And I don't manage a portfolio. I capture percentage points in trades, right? So if I buy something and it goes up 10% and I sell it, I made 10 percentage points. Right. So I take the portfolio management out of it because I don't want to know how much money you have or what you're trading or what your risk profile is. I don't want to know anything. I'm just going to show you where the money is. Mm-hmm. Right. I'm not sizing your positions for you. I'm not your risk manager. I'm not your wealth manager. I'm going to point you to where the money is. So in the view matrix, I go into those with the idea that I'm going to buy it here. I've got a 3-to-1 risk reward ratio. I'm going to stop out at this level, and here's my target. Mm-hmm. And so if I get it right, I have I move my stop loss level up to break even as quickly as I can. I kind of manage that. And sometimes you can keep moving your stop loss level up and the thing keeps trending higher. Right. Mm-hmm. So now that's where, like, sometimes I'm in a position for 2 days and I get stopped out. Sometimes I'm in it for 2 years because I just never got stopped out.
Oh, wow.
Right.
Wow.
My stop loss was below the 200-day moving average, and we never saw the moving average for 2 years. Freaking thing did nothing but rally. Right. Mm-hmm. So now my stop loss is going higher and higher and higher with the markets, and we're locking in profits at that point. And, that's kind of how I'm hunting in the markets.
Mm-hmm. So share with us, if you can, what were your most memorable losses and gains?
Man, that's a tough one because I've had a lot of those across, trading books is something else. When you have a big win or a big loss on a trading desk, when you're running a book for a big bank, the sheer magnitude can be like enough to make you sweat, literally. So I can think of one day where on the desk we were running, it wasn't necessarily my pad, but it was my partner's pad, and I was responsible too. Essentially, to make a long story short, we were quoting clients in silver before Good Friday's close on the Thursday. Silver was rallying up through $5, and we kind of decided that there was a resistance level and we could go home short. And a client called us after the bell and asked us for a price and a huge amount of silver. And we kind of read him as a buyer, meaning we showed a high bid and a high offer so that we wouldn't get shorter, if you know what I mean. Like our position wouldn't get much shorter. And he paid us anyway. So meaning he bought silver from us anyway, and we were way shorter. And then after the exchange closed, Fibro exercised like 5.25 out of the money calls before the Good Friday holiday. So we got caught short like a couple of million ounces of silver through a long weekend close. And the first thing that we did when we figured out how big our position was and how long we had to wait until the market opened again was we went to the bar and we did a shot of Jack Daniels just to sort of calm down a little bit, because it was harrowing, right? You've got career risk at a certain level. That thing opens up at 550, you lose X, Y, Z $1 million, and you are out the door, man. So that stuff we traded out of it. We traded through the whole thing, starting off with a horrible P&L the next day in Tokyo and, kind of chipping away and making some money back. And the market came back in and we covered a huge part of it with like a much smaller loss than we would have had. And we didn't get piggy with that because we knew that we were buried if we had to take a really bad loss. And, came out of it as, that was just another thing that could happen to you in the wild, wild west. But that was harrowing, and that was millions of dollars at risk. Every penny silver traded over a weekend and into the next day. And it was a lot on my heart. If I die 5 years earlier, I'm going to blame that trade. Yeah. And then some of the best trades, Ian, were like, during the .com bubble, if you were early and hungry and you kind of realized, all right, that's going to go up because it was an offshoot of another tech company, or they were making a component that was going to this company that you thought was really big, and you kind of buy a couple of thousand shares of these companies at single digits, just because you're like, I think this is going to go up. Like, that was literally the reason. You're like, they're serving Dish Network. Dish Network is getting huge with all the networking, et cetera, that's going on. And this company's going to be big. And next thing you know, like, I had a couple of stocks that I had in the single digits that I sold over $100.
Wow.
Yeah. And so that's really like empowering. And if you want to talk about something that makes you feel smart, that's it. And you kind of just take it as it comes, but you do feel like a little bit of a genius. And especially if you just take your money and run when something goes from, so you buy it single digits, goes to triple digits. I don't care where it's going from there. You know what I mean? I got lucky enough and stayed in it. And so you're able to make, like huge returns on money, and you start thinking that that's what the market is. And that's what it's always going to be. And then over time you get the lesson that that's not the case. And it's, markets go through regimes and periods, and sometimes they're great and sometimes they suck, and sometimes they're bulls and sometimes they're bears. And all of that goes on for way longer than anybody can expect. So that's kind of the nature of it. And being on this side of the business now is kind of my favorite seat of all time. So that's been a great transition.
So would you say that extended bull markets can develop some really bad habits in traders?
Well, I think that it's up to the trader, right? It's on the person to understand what that market is, right? And a young person will think, like I did, that that's what the market is. And for example, somebody with a lot of experience like me can recognize that the first time Bitcoin got up to 70K, and everybody on Twitter had laser eyes, and everybody that I knew was leaving their job and going into the Bitcoin market. And a wrestler from high school that I knew that made $1 million trading Bitcoin walked into a store in New York City and bought a Rolex and Instagrammed it and put it on his Instagram story because he bought a Rolex with cryptocurrency. I knew that we were around the highs when that was going on. You know what I mean? And so, but these kids that are in the market are like, dude, are you kidding me? This thing just went from 10K where I bought it to 70K. It's going to $1 million. You don't understand. Like, you do not understand. And I would go, okay, cool. And just say, okay, fine. But it looks like I've seen something like this 5 times before, and I'm going to bet you that it ain't going to $1 million next. So, and then, and then see the crash. And, put it this way, I'm not claiming to have made a nickel on that call because I was not short Bitcoin. It was just an example of me being an outside observer going, that's fucked up. That's fucked up. That's completely insane. And markets don't do this. And so this is not going to last, and that's the difference between the experienced guy and, that's in the ring and the the novice guy is in the ring, and they both have their moments.
Mm-hmm. Yeah. In one of your earlier interviews, I heard you say consistency is a moving target. Why is this, and how do we become more consistent?
Well, consistency is a moving target because in the same way that markets trade in regimes, right? And markets have their moments in the sun and had their moments where they're asleep. So the same thing is with consistency is a moving target. If you're making money in a certain way one day, that's probably not going to be the way that you're making money again in a year from now. Or in these names or in these sectors or using this methodology or using this technique or trading on this system, whatever it is, like markets are like forever dynamic and extremely dynamic. So to say that consistency is a moving target is to understand that you are in a constant state of adaptation and growth and studying and analyzing and changing. And if you're not, you're going to get run over because consistency is moving, right? You want to be consistently good, you better be changing what you're doing, because the minute you stop changing and keep doing things the same way, the market changes and you're trading the wrong market. You know what I mean? Like I lived through that. Where I was going into this bull market and something was changing, right? And I walked into the frying pan of that bull market was over, right? Because I didn't see the signals around. And then another bull market started and I could have seen those signals too. But, I guess all of that comes a little bit with hindsight, a little bit with experience, but, understanding that you've always got to be growing and changing as a trader and as the world changes, that's really important.
Another quote from you, you said in the past, learn the reverse harnessing of emotion. What is that?
Yeah, so that is the easiest way that I could describe that is sort of, if you're ever in a position with somebody, like I have a Slack channel where we talk about trading all the time, and sometimes we'll get long something and it goes our way. And everybody in the Slack channel will be like, nice job, guys. Like, we nailed this one or whatever, right? And my point is always, if you're high-fiving over a position with one hand, you better be making sale with the other hand. Because it has happened to me time and time and time again, where as soon as I acknowledge something with somebody in the markets that I have a same view at, we're both bullish gold's trading at the highs of the day. You look at somebody and go, look how smart we are. That's the high of the day, and it's going to cost you 5% from there just for saying that. Right? I'm the most superstitious human being on earth. Okay, Ian? Like, you know what I mean? I'll wear the same shoes if I made money yesterday. That kind of thing. But I guess that's where the other way to express that is, I used to be stopping out of long positions in the stock market when the VIX went to 25, 30, and there was a huge breakdown of technicals, et cetera, and everybody was panicking, and the markets went from greed to fear. And that's when I was always like, oh shit, I got to get out of this and get out of that. And then I learned that that's when you should be buying, right? And was able to change my trading world around to be positioned, because I learned that whenever I was selling with the VIX at 30 and the fear and greed index at fear, that was always a bottom. And so I had to figure out how to be more sentiment conscious and sort of flexible with that. And so it's like knowing when we're going to be in a position when that's going to happen, I have to be flat and ready to buy everything. Like when you see the VIX tick above 30, you'll know that I'm over here wailing into the stock market with both hands and feet, right? Just because that's how I've always made money. And since I've learned this sort of method, and which is mostly since I've started my business, I got really conscious of that, where no matter what, you try to be flat for the event, but even if you're a little long, but definitely if you're short, when volatility is picking up and fear is pervasive, that's generally when you want to spend a lot of time buying. And sometimes it won't be the dead ball bottom in price, but it will in time. And the next thing you know, you'll be in the money on those purchases anyway. So that's sort of, for me, flipping emotionally, where I used to be like throwing in the towel alongside everybody else, saying, this is when you throw in the towel, and realizing that that's all the selling that you want to be scooping up, because once it's done, there is no more, and the stock market goes back to resuming trend. So that's kind of what I mean when I talk about, like, I guess being, I don't know how you quoted it, but being flexible, like that way.
I see. So do you keep a decent cash reserves as standby, ready to pounce?
Yes, in my trading account, I always keep a certain amount of cash there in case there's a absurd spike in volatility. Even if I get called long the other stuff, I know that I have something for the VIX 30 fund. That's just sitting there. Whether I buy a SPY call or what I do with it, I decide kind of on the spot, or just buy SPY or buy the NASDAQ or buy a stock or whatever I think I want to do. There's always something sitting there for that.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
You also in the past have mentioned in this quote, the path to financial literacy is a constant process. And you made references to a book called No Worries by Jared Dillian. How's this book influenced you?
Well, let's talk about those two things a little bit separately, if that's okay. The book is great. I got to read an advanced copy of that. When Jared wrote it and before he published it. And when I read it, I was like, the first takeaway was like, man, I wish I read this when I was 18 and again at 25 and again at 30 and probably again at 40. And in there is just, a boatload of wisdom about everything from everyday decisions to the big decisions that you're going to make in your life. And Jared really boils it down to, if you get your college education, your house and your car right-sized for the life that you want, you can probably live a pretty stress-free financial life. And I believe that's totally, totally true. People put themselves in as much financial agony as they want is essentially the answer, and so there's a little bit, the book was really, really impactful, and it's just timely because I have, kids graduating from college and from high school right now, and it's a good time to enlighten them on how to approach their finances as they kind of take them on their own. So there's just tremendous value, and I'm not just shamelessly plugging the book because Jared's one of my best friends. It's really valuable. Like there's valuable stuff in there for young people and old people alike. That like I read that and there were adjustments that I made in my finances at 55 years old.
Oh, wow.
And I was like, yeah, like I could do this better. Let's fix that. And so that's really, really valuable information for me.
Yeah. What struck me from the book was kind of the idea to structure your investments to fit your stress level.
Exactly. Exactly. The one thing that Jared taught me that is totally true that I never really would have believed until I kind of started paying attention to his view of it is that people are as rich as they want to be. And that is the absolute freaking truth, right? The people that are wired to whatever, not go full throttle all the time are going to probably, have the desire to earn a little bit less, and the people that are wired to be like, no, like I can take it on, like I want to go for the gusto. Those people wind up getting rich, and the people that are chance takers wind up getting rich first. And, it's not shocking to see, in the end, when you look back on it, I do believe that you can be, you have hours in the day that you can put them towards whatever you want. And people that want to be rich put a lot of the hours towards making money, no matter what it is. They figure out how to ring the bell and have the money land in the account, and they just keep ringing the bell 24/7.
So in kind of summary, is there any particular piece of advice you would recommend traders to kind of concentrate their focus, their attention on?
Yeah, there's so many lessons in trading, like life. The number one is the survival skill. I still have to say, I guess because I'm fortunate enough to, I maybe stared at the abyss of not having a Wall Street career anymore, or maybe thinking that I didn't want one, and being able to reinvent myself to a spot where I've still got one and I can still earn a good paycheck. And a lot of that comes from survival skills and, and mental flexibility. And understanding that if you're going to survive, that, the market's going to be changing and the roles are going to change. And the one cool thing to keep in mind is to let things play out, even when you think that you might be losing. Because there's always another piece of information, and that's important in life and in trading. And, it's like, there's always something that can come around and help you, where things go better in the 11th hour and sort of maybe the end result isn't as bad as you thought it was going to be because time went on and sort of something happened and this went better than you thought. I don't know. That's kind of a lesson that I take away from. I guess it has something to do with sort of, the outcomes are never as bad as your worst fears or as great as your wildest dreams. They're always somewhere inside that. So I guess that applies to trading too.
Yeah, definitely in life. So, kind of to wrap things up, what do you struggle with most as a trader?
I would say, I guess the axe that I still grind is staying selective. I guess at my pace and sort of level of risk appetite, I probably think things are going to work out more often than they do. And so I guess maybe that, that prepares me to take losses. I'm really open-minded to taking a loss. Like when I put something on a trade on, I take all the emotion out and I say, when it goes here, I sell it. And when it goes here, I sell it, and so that's like, I don't really buy and sell things and get overly emotional about them. So that's been really helpful to my process. But the hardest thing is to sort of, stay under control and, a lot of time here's a good example, Ian, where like, I'll be in a stock and make some money on it and have the right view. And the next day get distracted by something else. And the next day get distracted by something else and look back at that thing that I was in on the first day. And like, man, that idea is still working. Like this is still playing out. And like, just because it was kind of a short-term trade, I kind of ditched it. And because I thought it was over and this thing is still working. So, and that has to do with sort of staying selective too. It's like, I'll get in and out of something. And then there's something about me that wants to just close that chapter and move on to a different topic, and a lot of times if you sort of stay on the same topic and be like, no, there's more here. There's more to do here. Like just because you got in here and out here doesn't mean that this move higher is over. Like, like have some faith in your call. This is what you jumped into. Like, why just make 7% and leave? Because you think you might be able to make 10% in this thing today, or this week or whatever it is. So that's something where like I get fickle and I wish I hadn't, and I wish I kind of, sometimes if I put that position on and just left it on, with my usual, tactic thing, but I kind of just decided to take it off because it made money, and it's a little bit second guessing, but staying in confined in because I really like to limit the number of securities that I both trade and invest in.
Is that because you like to do the research on it and find the compelling reason to go long or short, and concentrate your attention on knowing a lot about a few securities?
It's very much like that, and you'd have to throw in where I'm also a price action junkie. Like my favorite book is Reminiscence of a Stock Operator. I probably read it 5 times, but that's like my strength, where over time, if I limit myself to understanding and knowing the price action and becoming familiar with the prices of these things that I'm trading, then I could be at the mall or I could be at the fish store, or I could be having lunch and I could have a position on my pad and you know what? I got to sell some here. Right. This is a good price for this thing. They just rallied this thing. It's been sitting here and all, you know what? Or I got to get out of this thing. And I think just having a fewer number of securities, being intimately familiar with their sort of volatility capabilities, what they can do in a day to hurt you or not, and understanding kind of the levels in certain securities and just knowing them like the back of your hand. To me, that's that's for me the way to be the most comfortable in a trade. So that's kind of how I direct my resources and my time.
I see. And that helps create comfort for you to hold on to them for a longer period of time.
Yeah, like kind of along that note, a lot of like my view matrix is my, view of positions that are kind of more suited for kind of longer term trading, not longer term trading, but not day trading, like, multiple weeks or months, or usually the length of time that I wind up having these positions on the pad. And when I do, and those are kind of in my long term views, I'm also probably in those names trying to trade those from the long side as a day trade opportunity, like as a short-term trade opportunity, right? To kind of lever up that idea that may be working. And, maybe this day you can be long a lot of it because it's the right setup. Or into the weekend, that was a great Friday close. It broke up above this level. Like, let's double up on this thing that we're right and we're bullish and it's going up and we've got, we're comfortable. And so that's where there's a lot of value, right? Like that's where, you get your alpha essentially on your own portfolio.
Quite often I hear other investors throw out this term called the super cycle and say, oh no, you got to buy into this commodity or this crypto or whatever, this stock, because it's part of this new super cycle. Do you ever look at super cycles, and how would we know when it's a start of a super cycle? Are there any key indicators?
I mean, a super cycle is everything going up at once and just going up because there's a buyer. Like when I left the commodity desk at Goldman Sachs, we went to a 10-year commodity super cycle. And what was that? That was call it from 2000 to 2010, when China was literally acquiring the lead, tin, steel, copper, iron ore, and aluminum that went into the army that they have floating around in the Pacific and driving around in tanks wherever they have them. And so that was a super cycle. That was one country saying we are inherently short natural resources and we are about to change that. So I feel like there's super cycles in that. There are super cycles in things like, the tech bull market. I feel like we may be in like an AI super cycle now that can go on for years, but they're really hard to identify until the late stages. Like, you're always like, oh, this is just a trending thing and it's, just going to go back and forth. And you're like, wow, it's still trending. It's still trending. So it's hard to really like identify that while you're in it. It's kind of just something that's kind of shocking you, and you don't really know until you look back and you're like, this is going on for years now. So it's not something that I go hunting, just maybe rather to identify kind of thing,
Well, Tony, I want to thank you very much for coming on Chat with Traders.
Yeah, Ian, I'm honored to be on here. I really am. Thanks for thinking of me, and I hope the audience likes this conversation.
Yeah, and how can our audience reach you?
Yeah, you can. My website is tgmacro.com. There are some samples of my newsletter on there. You can email me directly. Your audience is welcome to email me at tony@tgmacro.com, and I'm on Twitter @tgmacro.
Fantastic. All right, thanks again.
Awesome, Ian. Thank you very much.
Yeah.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
And he was just telling me how crazy it is that I'm able to do this, right? Like I was able to compete at the highest level and then basically fell from the top, I guess you could say, in the NFL, and then started back over and am now competing at the highest level again in a different field. So it's just it's crazy to think about.
Markets, speculation, and risk. This is the Chat with Traders podcast.
It's Chat with Traders. We're all the way up to episode 283. How's it going, traders? If you're new to our podcast, a big welcome to you. Our listeners are from all over the world, and we are so honored to have you continue listening episode after episode, and we really appreciate you. You keep us motivated to continue bringing new episodes of interesting chats with interesting guests. I'm Tessa, co-host and producer of the podcast, and I love introducing our episodes to you. And I hope that you've been enjoying our host, Ian Cox's inquisitive chats with our great guests. He's been doing a great job. And if you want to learn a little bit more about Ian, I did interview him on episode 244. Let's see, a couple years ago now. Time flies. And maybe it's time for an updated one. We'll see. If you love Chat with Traders, be sure to give it a great review and share the podcast with your friends and family, especially with those who trade or want to get into trading. Don't leave them out of this, okay? That is probably the best way to keep us motivated to continue doing what we're doing. And we're also open to feedback and suggestions. Just hop on our website, chatwithtraders.com, and send us a voice message, say hello, or email us at hello@chatwithtraders.com. Thank you. Now, meet our guest today, who simply goes by Michael, a former college football player who was on the journey of becoming an NFL athlete, but after a sports injury dashed his football dreams, Michael turned to day trading, teaching himself the ropes. His trading strategy evolved over the years, focusing on short selling, highly volatile small cap stocks after discovering his knack for it in 2021. His discipline, honed from years of football, helps him execute trades like a sniper, waiting patiently for the perfect setup before striking. Now let's dive into this awesome conversation with Michael. Here we go.
Well, hello, Michael.
Hey, how's it going?
Good. Yeah. Welcome to Chat with Traders.
Hey, yeah, thank you for having me. I really appreciate it.
Yeah, so let's dive into your background.
So I played football for about 4 years. I had a shot at the NFL. The Chicago Bears actually invited me out to be a free agent for them.
Oh, wow.
And yeah, so I went for the summer of 2017 and, I got sent home basically because I was hurt. I had a groin issue, sports hernia in my groin. And so they send me home. I'm devastated. I'm like, man, I blew my shot at the NFL, everything like that. And then I'm trying to find something that can bring me the same amount of like money and lifestyle, if you will, as the NFL would have. And so I'm looking online and I start seeing day trading everywhere.
Uh-huh. What year was this?
2017.
Okay, great.
Yeah, so I start seeing day trading videos everywhere on YouTube, And I joined a couple different gurus, but I taught myself how to trade small caps. And then I became proficient at it. Probably in 2021 is whenever I started short selling. When I set up my first account, I was probably 23, 24.
23, 24. Okay. And were you playing football at the time, or were you still in that phase of working with the Chicago Bears in some manner?
Yes, I was still in that phase. I actually did the spring league. It's the NFL spring league is for like guys that are still trying to make it to the NFL, but for whatever reason, they didn't land on a team. They didn't get drafted. So I did the NFL spring league. I actually got some offers to play in the CFL, but I turned it down to pursue day trading instead.
Oh, wow. So were you getting some kind of income at that stage from football?
No, nothing at all. Yeah.
And so did you have any jobs beforehand? I mean, you saved up your money, saved up some kind of money to open an
Yeah.
account? Uh-huh.
Yeah. So my mother has always been a big supporter and entrepreneur herself. So coupled with, I think my mom gave me about, my first account was with an offshore broker actually, back when I guess SureTrader was around. I'm not sure if you're familiar. We funded it with like $2,000. And at the time, I was also working food delivery, and I was doing food delivery to save up some money. So I, paired the money I'm making for the food from the food delivery with the money my mom gave me, and I think it came about $2,000 to $3,000. And I fund my first trading account at SureTrader.
So when you got the account set up, were you eager to just jump right in and start trading?
That's exactly what I was. I was too eager. I was over trading. Long story short, I ended up blowing that account. That was my first account. I think 2 months in. So August of 2017 is whenever I funded the account. And I think by October, the account had already been blown to zero.
Wow. What did your mom say about that?
She told me to take it slow. I have other family members that believe that it's gambling, but my mom, she's not one of them. She's always been a huge support. She dabbled in some investing herself, so she understands that with the right skill and strategy, you can actually have edge in the markets.
Nice. And so her support was what a good inspiration for you to keep going despite blowing up your first account?
Correct. Yeah, it was everything. I was devastated, but I knew that I could do it because there were other traders in the community that I was a part of that were making it happen, that were growing these tiny accounts into millions of dollars. So I think by the beginning of 2018, I funded another account, this time with about $5,000. Probably 6 months in, I ended up blowing that account as well.
Oh, wow.
I was just longing breakouts, and that wasn't working for me.
I see. So were you choosing the same strategy the second time around as you did the first time around, or did anything change?
It was the same strategy. Nothing changed. I hadn't even looked into short selling yet because I was too intimidated at first from the short side of things. I didn't understand the concept of shorting yet. And I also didn't understand how you have to locate shares and how you can owe the broker money and things like that. So it scared me away from it initially.
So what did you learn? What was your kind of key takeaways from going long breakouts that ended up blowing up your account? What did you learn from that?
I learned that I shouldn't be doing that.
Well, why is that?
I didn't find an edge in going long for me, and still till this day, I haven't found my edge in going long. I found my edge in strictly. I'm currently 100% short seller. I'm short biased. All I do is I short these parabolic moves.
What kind of stocks were you originally going long on the breakouts? NYSE, NASDAQ, or?
No, it